option are in the room here at BFC in NYC. Thanks for coming, and we hope you enjoyed the event. We'll see you in Hong Kong.
All right, everybody, welcome back to another week on BFC Live. Lots to talk about today. Today, I am joined by two very smart gentlemen. Every week, I get to talk to people about Bitcoin. They're a lot smarter than me. This week is no exception. I'm joined by Mason Foard, who is the director of Bitcoin strategy at Meluse and also a founding member of True North, and Allard Peng, our head of research and insights here at Bitcoin for Corporations. Gentlemen, thanks for joining me today.
Thanks for having us, Jake. Appreciate it.
Good to be here.
All right. Lots to talk about today. Bitcoin is getting a bid. Treasury companies and equities are getting a bid. Scott Bezant had some news to share that the market enjoyed. But I want to start with BIP 110 for a second, Allard. Quick question. What is a BIP 110 and what do I do about it?
Yeah, I mean, like from the corporate level, and I think it also translates over to just anyone that uses Bitcoin. So to begin with, it was a soft fork. The soft fork happened on August 8th, and then it didn't really get anywhere. And the supporters of it are, I think, a population of those supporters they're now thinking about like doing a hard fork. So I'll just go over some terminology. So soft fork is a restriction of the network rules. And in this case, like BIP 110 meant to restrict certain rules to do with the, like restricting the transactions that are within the op return. And this is meant to amend a change at the mempool policy level with Bitcoin Core V30. So like the short answer of it is like it's meant to be this movement that node runners could run this soft fork, and it would give them some kind of say over how the network should run. And what ended up happening is like the discourse got very much wrapped up in a lot of heated debates. I think a lot of it, like you could probably ascribe it to, just bear market makes everybody pretty angry about things and they feel like something needs to be done. Yeah, like in terms of what people need to do about it, like it's really just where you stand on what you think like is the best course of action for you as a node runner. So if you're a supporter for the soft fork, then you have that right to run the software on your node, and therefore start signaling BIP 110. Of course, we have gone past that activation window, so now you're at this point where that fork is now no longer really in play. But it was just an event where people could have participated if they wanted to, And if you didn't want to participate, then you can just not really do anything with your node. One of the luxuries of Bitcoin is that your default action can just be do nothing, and normally you end up being okay, right? So that's the main thing. Like the real action is just based on whether you supported it or not, and if you didn't support it, you didn't really have to do anything.
So ignore it, business as usual, back to building in the bear market.
Well, I think I think there's definitely a longer conversation that could be said about it. In general, I think like the supporters of BIP 110, and I wouldn't call myself someone who was like anti BIP 110. I was very much neutral. Like I didn't run it myself, but I just thought that the node runners have a right to do what they do on their node. But ultimately, I think like what I definitely disagree with is the hard fork discourse. Like trying to advocate for a hard fork to brick the proof of work algorithm and replace it with something else. Like that part, I think that has crossed the line. But otherwise, like doing a soft fork, or at least attempting one at the node level, and then trying to get consensus for it, that there's like in principle nothing wrong with that. So yeah.
Okay, thanks. I appreciate the explanation. Switching gears here, Mason, before we started the stream, you had mentioned that Scott Bessent came out with some news on capping the yield curve. Want to hear a little bit more about like functionally, what does that mean? Let's assume like what does the yield curve even mean? How does that affect Bitcoin? Bitcoin is obviously getting a bid right now. Yeah, I want to hear your thoughts.
Yeah, so this morning, Scott Bessent of the U.S. Treasury announced that it's going to be doubling the size of its long-term U.S. debt buybacks. And this has followed kind of a rapid surge in Treasury yields, particularly the 30-year, which I believe in the middle of June, it was around 4.8, and I think it reached as high as 5.3. So a really rapid surge in yields. And so they announced that initially there was a program of 2 billion will now be increased to at least 4 billion. And the wording that they use is the move is intended to provide liquidity support for bonds maturing in the 10 to 30 year range, and this is as the U.S. debt nears around 40 trillion. So essentially what they're doing is yield curve control, which the yields were rising, and on this news, the yields have, or the 30-year has dropped to around 5.19. So instantly it lowers because there is some buy pressure from the Treasury. Now, the Treasury has the ability to, and this is a simplification, they have the ability to essentially print money, right? And that is how the market is interpreting this, that the Treasury and will not allow the yields to go higher because it makes the interest payments and the debts that the U.S. governments owe particularly untenable. And as they get higher, the interest gets higher, and it can lead to a debt spiral. And this is really why we are seeing hard assets today. And let me check, so we're up to date. Gold is up 3.77% today, which is a huge move for gold. Yep. And Bitcoin is up 6.23%, which is also a significant move after Bitcoin has been ranging in the low 60s, high 50s for about 6 months now. And this looks like it's real first momentum, and a potentially a short squeeze. There was a lot of people who thought Bitcoin was going lower, and they get squeezed and they have to buy back at a higher price. And What's particularly interesting is equities like MSTR and ASST, which is Strategy and Strive, who are amplified Bitcoin, are also squeezing significantly today, with MSTR up over 14%, and Strive now at 15.5, which is really an incredible move. And I think that's also due to a short squeeze. But to sum it up, and I'm sure Allard will have some more insights here. The market is, or investors, macro participants are rushing into hard assets, things that represent the quote unquote debasement trade, because the Cent really sent a message today that similar to Lindell, and that nothing stops this train of debasement, of continuing money printing and financing the debts of the U.S. Let's pass it over to Allard. Allard, anything else there?
I think you got the main points. Yeah, and at least for Bitcoin, right, there's definitely a capital rotation angle over here. We're kind of closing in on that 1 year mark for the bear market, and there might be let's just call it like a jitteriness in the market to try to front run that event of the bottoming. So that might be some element of what we're seeing today. I think like just within the spectrum of macro assets, Bitcoin has been extremely oversold, and it's by far the worst performing one in the last 18 months. So you have, you have like basically any capital rotation from here, Bitcoin becomes probably the core possible and potential benefactor of a capital rotation. And I think these kinds of macro events, they could very well become catalysts that trigger that kind of thing. So I think that's another part of what we're seeing.
I'm curious. So is this move from the Treasury? You mentioned Lynn Alden's famous quote, "Nothing stops this train." Is this move from the Treasury, was it inevitable, or are there other options that the Treasury and the wider federal government have in in light of where we're at with rising debt?
Yeah, that's a complex question. I would say beyond austerity, something like Doge trying to reduce the spending of the government, which we've seen kind of fail spectacularly because there's very little political support. I think realistically, the mechanics of what they can do, they have a whole tool bag of things that they can do, whether it's QE, yield curve control, helicopter money, like we saw in COVID, swap lines, loosening regulations, etc. There's many things that they can do to quote unquote support liquidity, but at the end of the day, there's just going to be different acronyms or different mechanisms for creating more monetary units and perpetuating the debt-based fiat system that we currently are in, and that needs ever constant expansion. And if you understand this at a very high macro level, that's why people are so into things like Bitcoin and gold, because they protect you, as gold's inflation rate is very low, around 1 to 1.5%, and then Bitcoin is trending towards zero over time, and I think currently has a lower inflation rate than gold. So yeah, I mean, in my mind, this was always inevitable, right? Nothing stops this train. And it's a mix of just understanding kind of human behavior, incentives, and game theory. The government has the option to print money. They will never default on that debt. And I don't think that they are going to be able to bring in the revenues or the receipts that they need to diminish it significantly, or the debt to GDP. So yeah, I think printing is kind of the end result here, no matter what they do or no matter how long it takes.
I'm curious, Allard, you said Bitcoin, you said that that might be the core benefactor. Um, Mason kind of touched on that, but I want to hear a little bit about why you think Bitcoin, maybe gold, might be the core benefactors of this new like money printing and all these different measures that the federal government's taking.
Yeah, sure. So to be clear, when I said core benefactor, I meant like, it's the most oversold. Of all the macro assets,
Ah,
this one's the worst performing. So as soon as you have a capital rotation, like where is the money going to go? They're gonna like the smart money is gonna be like, okay, I want to buy low, right, and sell high. So, well, in terms of relative lowness, it's Bitcoin that's the most low, right? So that's why I say it would be a core benefactor of any kind of capital rotation along that logic. But for your broader question is like uh, inside this kind of long-term macro events, you're kind of at the tail end of a long-term debt cycle, and there's probably going to be some kind of restructuring of the U.S. dollar. Like these kinds of restructurings happen every 40 to 70 years or so, right? And we're kind of closing in on that timeline. Like if you look at United States history, that's been how it is. If you look at how long-term debt cycles last, that's usually how long they tend to last. And debt usually is a main catalyst for these kinds of big threshold events in history. So in those moments, right, you normally see that hard assets do benefit. Hard assets that are not beholden to any kind of country or any kind of like corporate balance sheet or anything like that. Like hard assets that are truly neutral and truly scarce, quite frankly. So of everything in the world, like Bitcoin basically fits that bill the best, right? Because at the end of the day, we're entering, well, we have already entered into a digital age, and this is a scarce digital asset. This is like the only digital asset that is, provably credible and scarce and all of those things. So that's why I think like just in light of the macro, Bitcoin could definitely stand to benefit the most from that. Yeah, and then just overall, you have the adoption that has popped up at the corporate, institutional, and soon we'll probably see like more nation states, right? So all of those are potential tailwinds that really bode well for Bitcoin.
so for the Bitcoin operating companies, whether they're a treasury, infrastructure provider, whatever it is, if we're in this regime where there's now tailwinds, I'm curious, what's the view on, we'll say, we'll think in cycles. What's the view in the next couple years for the companies that are holding Bitcoin on the balance sheet, like Milieus, like Strategy, Strive? I'm curious, Mason, you're a director of Bitcoin strategy, so like, what's your view as you guys hold Bitcoin on the balance sheet?
Yeah, I mean, I think we think of it as a long-term capital asset that helps us save energy into the future. And of course, Bitcoin, as you said, it's very cyclical and volatile. And if we are following a cycle model, which I don't totally buy, but it does seem that way, right? Kind of the psychology of the market might make it so it is a cycle potentially, which is it kind of self-reinforces itself. But
Yeah.
yeah, then the next few years are presumably incredibly bullish because we're nearing kind of the 1 year mark of the start of the bear market, which was I think October 10th. And right now it's August 19th. And I think Allard made an astute observation that there might be many people who are trying to front run the quote unquote bottom. And I really think if you look at the first major low that we had was in February, and we retested it again this summer. But we've really been consolidating for the past 6 months in this 60 to 64 or 58 to 64 range. And I think that's a significant number because that was really the top of the last bull cycle in 2021. It seems like we've come back and we're sort of retesting it. We're also at the 200-week moving average right now. We're bumping up against it, riding it. And historically, that's been a really consistent, beautiful place to buy Bitcoin and hold it for a few years. I don't think there's been a time where if you've bought it at the 200-week moving average that you haven't been up at least 100% in the next few years. So yeah, I think we are incredibly bullish, and having an operating company, we've been able to really dynamically ride this bear market out, and our equity has since October has really consistently outperformed Bitcoin because of the fact that we have an operating business and we're able to buy back shares. And in October 2025, we announced that we were going to start buying back shares, around 10% of the free float. And we just announced 2 weeks ago in our Q2 2026 earnings call that we had completed that buyback and that we were going to continue another buyback. And we're doing that for a few reasons. As the Bitcoin market is weakening, we think that we do have an operating business, and our operating business in October was severely undervalued. It was valued around about 10 million real, and that's an operating business that spit out around 40 million real in the past 12 months, right? So it was severely undervalued. So just from a valuation standpoint, we thought that it was a better opportunity as Bitcoin was beginning to kind of go into a bear market to buy back our own equity than rather try to catch Bitcoin while it's falling and buy back our operating business at a really cheap discount. And we've seen that in kind of our equity outperformance. Since October, we're up around 13%, while Bitcoin is down around, I guess, 40-ish% now. And that's kind of like a 50-point delta between what Bitcoin has done and a operating business stacking Bitcoin and also increasing Bitcoin per share by reducing the share count. So we're just one example, and there's many different models, right? Like Strategy and Strive, their equity is designed to be amplified Bitcoin on both the upside and the downside, and we've seen that. Frankly, they both had kind of brutal drawdowns, but I think most investors understand that amplification works both ways. In a bull market, if you're bullish on Bitcoin, you will, in my mind, likely outperform because of the amplification embedded via the preferred equities.
Yeah.
And that is a model that we really haven't seen in a bull market. We saw a little bit towards the end with Strategy announcing, Strike, Strife, and Stretch, and I believe Stride before the last top, but I don't think it wasn't as nearly a robust strategy, and kind of the clarity and kind of the operational scrutiny that they have now is they're just in a very different place, and I would argue much stronger. But Allard, I saw that you posted a kind of report yesterday on MSTR, and I was able to read a little bit of it, but I would love if you went over it again.
Okay. I mean, Jake, do you want to go through that or like
Yeah, I
I don't
want
know,
to
is that
hit
what
that.
you
We're gonna hit that for sure, but I've got some follow-up questions here. So,
Okay.
okay, Mason, you mentioned the front running that's happening in the market or perceived front running.
Hmm.
It seems like, help me understand and maybe help the average Bitcoiner understand that what's actually happening in markets, because it seems like Michael Saylor sells $15 a Bitcoin and then it drops 30%. He buys half a billion and the price doesn't move. So like I'm curious, who who's front running the market right now? Who's actually buying Bitcoin? Is it a bunch of retail like cramming in? Is it institutions? And like what's actually moving the price here? Yeah, who are these participants that are front running right now?
Yeah, I mean, I think today's the first indication of any front running. I think if you look at the past 6 months, what it's really been is a consolidation period, and it's not necessarily who's buying Bitcoin. It's the sellers and the buyers kind of meeting at a fair value price. And I think what people all consider the buyer's point of view, I don't think they often consider the seller's point of view, which is if you're a seller of Bitcoin, um, you want the highest price possible, right? Like I think that makes the most sense. And I think if you're a seller of Bitcoin, at this point, you might say, hey, um, I don't think we're going to go much lower here. And in fact, I think we might go higher. And so they might start raising the price that they want to sell at. And of course, it's a market, so there is a dynamic, but I think there's really been a negotiation the past 6 months. And I think maybe the sellers are looking at percent and the buyers as well and saying, hey, the buyers are like, hey, I need hard assets. And the sellers might be, hey, maybe I want to hold on to my hard assets.
Mm.
And that's how, the price goes up. And it could also be, trading momentum, leverage. It's so multifaceted and dynamic. It's really hard to pin down. But I think if we're looking at it kind of from a broad, big picture view, it is always a dynamic of a buyer and a seller and a negotiation.
Allard, uh, Mason also mentioned the prefs, and this is a question that I asked you about previously, but I want to ask it again so our listeners can hear you kind of unpack it. This is going to be the first time in like a real bull cycle we have these digital credit products. And you spoke to me about the reflexivity and how how this affects, what the price that Bitcoin's trading at. Tell me like your view. How do these digital credit products fuel the bull market, and how do you think they'll perform, especially given the pressure that's been on Stretch lately?
Yeah, sure. Yeah, we could probably talk a while about that. I guess the bottom line up front is like all of the pieces are being set into place, and that's really how I would frame things. Like every digital credit instrument out there, every way for other pools of capital in the capital markets to go into Bitcoin, that's all like a piece of um, like infrastructure, if you will, to just ultimately pipe more money into Bitcoin. So in a bull market scenario, uh, those those pipelines that allow money to flow through into Bitcoin um, will probably run hotter than normal, right? It's just because people feel good about the asset and people feel good about all of the derivatives that are on that asset. So digital credit would obviously be included within that category.
Yeah.
So people just feel good about buying these things, and then now the issuers can run those ATMs and they're able to raise more money, pile that money into Bitcoin. Okay, so does that actually have an impact on the Bitcoin price? I would say that at this moment and at these volumes and at these buy rates per week, definitely not. Okay, like definitely not. It's not enough money to really move the price, because ultimately, like Bitcoin has a huge amount of volume, and if you look at how much, like, so Strategy's biggest buy week ever um, it was like Q4 of 2024. It was right after the Trump got inaugurated. No, not inaugurated, like elected. And you had that huge run up, and they were able to buy like 55,000 Bitcoins in a single week, right? That was their biggest buy week ever. Not necessarily like in dollar terms, but like just in Bitcoin terms, right? But
Yeah.
maybe in dollar terms too. I'm not completely sure, but in Bitcoin terms for sure, it was their biggest week. And if you look at the Bitcoin volumes, trading volumes for that week, just on exchanges, so not even counting like all the OTC stuff, just on exchanges, it was a very small percentage of total trading volumes. So that right there tells you that like it frankly is not enough capital to really be driving the price. Same thing with them selling. When they sell like 30 Bitcoin or 3,000 Bitcoin, or if they sold 30,000 Bitcoin, that isn't something that would move the price, just given like how much their volume occupies over how much like total volume occurred over that week. So that's, I want to caveat things by saying that, right? But that being said, right, like, could we imagine a scenario where these instruments are at a level of growth and maturity that eventually they in fact do become reflexive? And I would say the answer to that is probably yes, because at some point, with all of this financial engineering and with all of this like structured credit and with all of these instruments that are just built on top of Bitcoin, um, eventually you can reach this state where Bitcoin just becomes this uh, default go-to place that people want to park their capital, right? And this can be a very natural progression of like how things be. Like right now, it starts with a few companies that put it on their balance sheets, and then it starts with them issuing digital credit, and then it starts with people building on top of digital credit, and then it starts with banks issuing like high amounts of loans against that Bitcoin that they have custody within the banks. So you can see like this, it's a step-by-step progression. And when we get to, there will come a time when we get to a point where the volume of capital that moves into it actually does impact the price, like materially. So that is where I would say the reflexivity comes to be. On a more micro level, like the reflexivity can definitely materialize within the equities of any of these companies that have Bitcoin on the balance sheet, right? So I'll take MSTR for instance, right? Can reflexivity happen on just the equity, like to be localized to equity? Absolutely. And the way it happens is like if Bitcoin goes up, MSTR tends to go up quite a bit more, right? It's like a convex version of Bitcoin. And then from there, you're going to have options markets that are on that MSTR equity. And there's going to be like these second order Greeks that start moving into crazy parameters. And at that point, it forces other market participants to have to buy. And I'm, of course, referring to just options market makers, like their default behavior when they have to like hedge out the risk that they're dealing when they trade these contracts. So when you have a huge amount of call demand, right, a lot of directional options traders want to buy calls, for example, well, that actually creates this impact wherein the dealers, the market makers, have to hedge in the spot market, and then they will be buying shares. So these kinds of things definitely happen, and they're the chance of them happening and the magnitude of a move becomes much higher during those kinds of isolated instances. So, and that's another form of reflexivity. Like certainly when we're talking about a short squeeze or a gamma squeeze or anything like that, like that is definitely by definition reflexivity, right? So that's kind of how I would answer that. Like I wouldn't say reflexivity on the Bitcoin side is something big right now. It's certainly possible in the future within much smaller assets like MSTR. Obviously, MSTR is much smaller than Bitcoin, right?
Yeah.
So within smaller assets like MSTR or maybe ASST, like that totally can happen.
I want to talk a little bit more about strategy. Well, particularly MSCI. Real quick, Marshall, not Marshall, Allard, could you talk a bit about what MSCI is, what the recent decision they made is, and kind of go back to how BFC engaged MSCI earlier this year, and why, why we're even having a chat with them in the first place. Allard?
Oh, that's for me. Okay.
Yeah.
Okay. Yeah, like I guess with MSCI, it started off with like this was around end of last year where they were saying like, hey, we have a consultation on digital assets. And at the time, they specifically called out digital assets and companies that were holding digital assets on their balance sheet. And I mean, at BFC, like what we did were we basically gathered together a coalition of entities, like including corporations, like DATs, institutions, and like individual retail investors. Right, we had a huge like signature sheet and everything, and we really petitioned against that, and ultimately we won. Like they decided to like withdraw that consultation, and basically digital asset treasuries were not affected by that consultation at the end of that conclusion. What's
Real quick,
happened?
real quick, explain for someone listening that doesn't know anything about MSCI, just real quickly, what MSCI is, and then what decision they made and how they kind of course corrected after we, along with strategy and a lot of the other partners, petitioned with them against them or against that decision rather.
Sure. MSCI, it's like what Morgan Stanley Capital International. They are a pretty big, like they're like very central to financial services and especially within the context of financial markets. So one big function that they have is creating these indices for tracking the aggregated performance of different assets, right? So they'll make equities indices, for example, and within an equity index, you obviously have a bunch of equities from different companies. And one thing that they were thinking about doing, which is the topic of this discussion, is they were thinking about like having a clause within their index construction that would cause companies that hold digital assets on their balance sheets to be immediately removed from index inclusion. Now, there's obviously some thresholds within there, so I'm not going to go into the details of that. I don't completely remember the details from like last year. But at the end of the day, like what we did is we basically gathered together the folks in the industry that would be affected by something like this, and we were able to push back against that, right? So we made an argument based on, well, first off, the main argument we rode with was just like, okay, it doesn't really make sense to just single out digital assets because you have certainly other assets that can be on the balance sheet and other assets that are not being singled out by this type of consultation. So like that was the main thing, right? Like not singling out companies just based on the composition of their balance sheet, which has never been done before. Like it's frankly never been done ever. And also they basically, through that consultation, if it had gone through, they would have effectively created a new classification of companies. Let's just call that classification DATS, okay, digital asset treasuries. And this classification would have been unique because if you look at how finance and capital markets has always been done, companies have always been classified based on how they generated their revenues. They've never, ever been classified based on like what they have on their balance sheet. It's never happened, right? So you might have heard of like GICS, right? Now, GICS is basically the sector classification of a business. And there's like traditionally 11 sectors in the economy, right? So you have like financial services, you have technology, you have industrials, materials, real estate, like those are sectors, right? And you know, all those sectors are based on, okay, this is the core business someone does, and this is how they generate money, right? So that's revenues. So you're always classified based on your revenues. You're not classified based on what you have on your balance sheet. So by them trying to do something like that, they would have created this brand new classification, and it just doesn't make any sense because it's never really happened like that before. And then, of course, the final thing is, hey, if these companies are legally corporations, like legally C corporations, like why are you trying to why are you trying to basically go against the law and say, oh, they're not actually C corps, they're actually investment funds, when they're not legally investment funds. So those were kind of the structure and rundown of our arguments, and I think they were very strong arguments and very sensible arguments, and so that we ended up winning for that one.
Mason, so for companies like Melius that have, you know, an underlying core business that, you know, functionally operates outside of the Bitcoin space, but then you also have this treasury strategy. I'm curious, what are your thoughts on, you know, MSCI and how they view, you know, what they call DATs? You know, do you think it's short term? Does this hurt, you know, the Bitcoin operating business space? Or is it a long-term view? It's like, doesn't really matter. We're going to keep building and keep, you know, focus on, you know, what we set out to do with Bitcoin.
Yeah, I think the latter is true. I think long term it doesn't matter, but it is a kind of arbitrary attack on Bitcoin and companies who want to store their value in Bitcoin. And I think, you know, a lot of the companies that they pointed out actually, and I think a lot of their reasoning was they don't have operating businesses, and that's just fundamentally untrue. And you can't classify what is and is not a operating business. Like Melius, we have a cashback service in Brazil for e-commerce, and we have 54 million users. Strategy has a ginormous software business, ginormous relative to, you know, every other software business in the world. Maybe not Microsoft, but still it's a multi-million-dollar, if not billion-dollar software business. And then a company like Strive, sorry guys, there's an ambulance or something going by. A company like Strive, they are selling, and now Strategy, of course, they are selling a financial product, and that is their preferred equity. And it's not a typical product, but it is a structured finance company in the same way that an insurance company is selling you a contract. The preferreds are a different type of model, but they are still an operating company. They are raising capital and have liabilities and have obligations and shareholders, etc. And then they also have a asset management business. So no matter how you slice it, there is still some like fundamental operating business, but it is also kind of a maybe a little bit hard to comprehend at first what these new models are. And sure, there are some actually I think a lot of the other Bitcoin treasuries, and there's now kind of a sea of them, do have some kind of business attached. Like Nakamoto or Naka has UTXO and the conference, I guess that's BTC Inc. and
Yeah.
BFC, which we are currently hosted on. And so I think a lot of these tax are incredibly arbitrary. And honestly, I think any rational participant, outside observer, is going to side with the quote unquote DATs every single time. But again, I think long term, this is not a big deal. It's just kind of a growing pain of trying to be understood by the market, and maybe having some enemies for whatever reason. They maybe just don't like Bitcoin or crypto broadly, and that's okay. But I think we will win, and history will look upon them as kind of we'll look at them poorly as kind of anti-innovation.
Yeah. Yeah. So is this just a misunderstanding of what? Well, is this just them not understanding what Bitcoin is? I mean, Allard, you had these direct conversations. Do they get Bitcoin? Do they understand? And I guess the follow-up question is, does the broader finance, institutional, traditional finance understand Bitcoin?
Yeah, I mean, okay, so when I talked to them, right, like, frankly, it was a good conversation. They really just wanted to hear us out. I did not sense any kind of antagonization against Bitcoin or anything like that. I didn't even sense any like uh sense of like snobberiness, like they're looking down at Bitcoin, or any contempt whatsoever, right? Like, so I just want to be fair over there, right? And yeah, like I thought it was a good conversation. And the other thing is this, like I don't think the framing of saying like, hey, do these institutions understand Bitcoin, yes or no? Um, like who really, okay, this is gonna sound weird, but like who really understands Bitcoin, right? That's a quite complicated thing.
You
It's a
guys
very
do. That's why you're on the
technical
show. That's
topic.
why we brought you guys on the show. You're supposed to understand this stuff.
Oh yeah, I mean, like I think I understand many aspects of it. I wouldn't call myself a Bitcoin expert or anything, right? So like, like what do we mean by like, do they understand it? I think at the end of the day, what benefits Bitcoin is more people recognize that this is a place that they can put their money for the long term. It's a long duration store of value asset. And also with the optionality of using it as a medium of exchange. I think that's also extremely important. Um, and as long as like those two things are fine, yeah, then as more people recognize it, and that's good for Bitcoin. Um, for a fund, right, for an institution, they don't have to understand it. Like they just have to like feel like this is something that they need to hold. If they feel that way, then we're good. Like we don't need to say anything else after that. Like I think then like we've already met the goal that we set out to do. Um, when it comes to MSCI and why they would put out a policy like the ones that they've suggested, I think it really comes like I don't want to automatically jump to assuming malice. I think it could definitely be that there probably is like, let's call them enemies of Bitcoin that have a lot of pull and sway over things, right? But ultimately, like those aren't the only incentives that are present. I would say most of it is just out of a genuine concern to properly execute their duties as fiduciaries of some sense, right? Like if you're going to create an index and a lot of capital is going to follow your index, you better make sure your construction methodology is sound and at the very least agreeable to the average institution that's going to be referencing your index. Because if it's not agreeable, then well, they're your customers. You have to keep your customers happy, right? So that's kind of where the incentives truly sit. And I think at the end of the day, it's not even that much of an education thing. It's like when some consultations might cross the line in terms of being unfair, which it did like last year when they first rolled it out because they were singling out digital assets. Then the industry, like we can push back on that, right? But if it's something more like now, I think like now where the most recent consultation, like digital assets was not even mentioned in their deck. Like I don't know if like anyone watching this, like if they go and actually read the deck, you won't find the word digital assets in there for that consultation. I'm talking about the second one, right? The most recent one. You won't find digital assets, you won't find crypto, you won't find Bitcoin. It's just not in the deck. Like, it's not meant to really call out one asset. And frankly, even though strategy and Metaplanet will be thrown out of the index, it's not just companies with Bitcoin on their balance sheets. Like they're also going to throw out one that has uranium on their balance sheet, right? So it's certainly not singling out something this time. So I think this time around, they're not doing anything that's clearly unfair, and so it becomes much tougher to argue. But that being said, right, like we still have like really good catalysts going on the Bitcoin side. And I do agree with what like strategy put out that ultimately we don't really need MSCI. If you just look at the numbers, how much of their shares is actually like tracked within MSCI tracking indexes. Like, it's not that much of the float anyway. So yeah, like that's where I stand on that.
Okay, I want to talk about, at the top of the show, we played a video about Metaplanet forming Superplanet. And so they seeded 2,100 Bitcoin into an American company. And so now they have two engines running, Metaplanet in Japan, Superplanet in the United States. I'm curious, Mason, what does this signal for Metaplanet, Superplanet? What are they trying to accomplish here by investing their Bitcoin in an American company?
Yeah. Well, I've heard Dylan speak before about the differences of the capital markets of Japan and the US, and he often points out, and I think it's broadly true, that the US is the best capital markets in the world, and it has the best regulation, and is one of the more efficient capital markets. And I think what this points to is that they view, I think the plan here is to create a preferred using this new entity, and that's why they seeded it with the Bitcoin, and create another type of perpetual, preferred or digital credit in the US to compete with Stretch and Strive. And I think it's great. I think it's great for the kind of broader ecosystem. And it also might point to some of the kind of regulatory challenges that they are having in Japan. I don't think it's quite necessarily that, but I think they are going to try to do both, operate in the US and Japan. And frankly, I think if they are able to do it, I think it's a great idea. I think we need more digital credit issuers, in the same way that there are thousands of banks, there's thousands of insurers, there's thousands of financial institutions. I think we need more providers of digital credit in the US. And I think Dylan and Simon obviously are great executors, and more than anything, they know what they're talking about. So, I mean, Dylan's a machine. That he knows he knows more than 99.9% of people about this space, even people who are in the space. So, yeah, I think it's really exciting news, and I think their timing is perfect. Hopefully, they'll be able to get a preferred up in the next year or so, and hopefully that coincides with a bull market. And who knows, they might do something creative, try to differentiate themselves from strategy and strive. And what does that ultimately look like? I don't know, but I'm sure they're thinking about it deeply.
Okay. Allard, thoughts on recent moves from Metaplanet to form Superplanet here in the United States?
Yeah, I mean, I like it. I think what they're doing is great. I do think like a lot of the details here matter. I've been looking into it, and so it seems like they have. So I mean, they've seeded the U.S. entity with 2,100 Bitcoin, and then if they're going to issue digital credit from that entity, like the collateral base, I shouldn't call it collateral, but let's just say asset base. It will be only the assets within that entity, right? So it's not going to be Metaplanet's entire 43,000 Bitcoin stack. So that's one detail that matters. Like, to what extent do they actually back it up, right? So those things, those things we'll have to see the filings, and then we'll have to go through them, and we'll know, right? I think it's interesting that they got the warrants. So they have warrants to continuously inject more capital into it, and that's a good point of optionality that they have, and I think that was a good move overall. The idea of like, okay, so here's something that I kind of wonder. So this is something I do wonder about beyond those other things. This is going to be a USC Corp. So anytime you get money into a USC Corp, you can't really get it back out really easily. Now, of course, the argument is like this would just be permanent capital, and Metaplanet, the Japanese entity, holds 95% of like SLE's shares, right? So like they are 95% owner. And I guess over time, you can exercise the warrants and buy more shares. And of course, that would also offset the dilutionary effect from the common equity offerings that they're probably going to set up, right? So all of those things match up quite well. I wonder if, I mean, I expect that the angle is probably to just keep it there as permanent capital. And now Metaplanet just has another company on their balance sheet as well as the Bitcoin on their Japanese side. Certainly, if you were to liquidate, like let's say this SLE thing, this SUPA thing gets like really, really big, right? You couldn't then liquidate it and like bring the Bitcoin back to Japan without taking a huge like tax cut from like trying to move it out of the C corp and like liquidating it. So I think that's one. It's basically saying like whatever Bitcoin or capital that Metaplanet commits to this thing, it's permanently staying in the U.S. now. Like that's like something that I find to be quite interesting. Theoretically, the model is like, if you had enough Bitcoin, you could probably pull up anywhere and seed a mini MSTR, right? Like I think that's really what's going on at the end of the day. They're just seeding a mini MSTR. So now Metaplanet is basically like, not a one-to-one example, but Metaplanet is now like a Michael Saylor, and then they own a good amount of the shares, and then now like the Superplanet in the US that is going to start growing, raise more capital, and your wealth, at least on Metaplanet's balance sheet, that expands by virtue of the fact that Superplanet just gets bigger from its capital markets activities. So, yeah, I think I think there's a lot of details to iron out there, but overall, it's definitely a very positive development, I'd say.
Well, we're at the top of the hour. Mason, real quick, let's fast forward a year from now. How does Bitcoin look? How does it look for these Bitcoin operating companies? And yeah, what are we all driving Lambos in a year from now?
I think I said earlier, I think it's really hard to be bearish at the 200-week moving average. I
Yeah.
think historically that's been a great place to buy. And um, yeah, I mean, I think there's a lot of opportunities in the market for those who are paying attention. And um, is this time different? You know, potentially there can always be a black swan or something that's happened, but I think Bitcoin's been pretty beat up, and there's been signs that this is the bottom, with sailors selling, the cold card attack, kind of a lot of infighting among the Bitcoin community around BIP 110, and then just general, price capitulation, and then time. Um, it's kind of the classic signs of um, a bear market. And one thing about Bitcoin is the bear markets are, relatively short. I don't think we'll see a 10-year bear market. So yeah, I'm feeling bullish.
Where can our listeners hear more from you? Where can they learn a little bit more about Use, and
Yeah.
how do they connect?
Yeah, if you just go to my X account at Mason Foard, Foard, you will see my page, and then you could click on the Use account. It's in my bio, and check out the website, read our earnings report, uh, you know, look at our deck. I think we provide a unique option to the market when it comes to an operating company, a public operating company, buying Bitcoin. It's a different risk reward than maybe some of the other treasury companies, but I'm really proud of what we're doing, and I think we're setting an example for not only the world, but specifically Latin America, which more more than most has dealt with severe currency debasement and a long history of it. So yeah, we're excited. We're going to continue to keep building, and really the thesis has not changed at all.
Allard, what about you? Where can our listeners learn more? Where can we read your reports and our articles?
Yeah, just go to bitcoinforcorporations.com. Also publishing on Bitcoin Magazine as well, and follow the Bitcoin for Corporations Twitter page. Like that's I'm gonna put out more content through that. Yeah.
All right. Well, gentlemen, thank you for joining me today. Appreciate the conversation, and yeah, I hope you guys have a great rest of the week.
Thanks, Jake.
Yep, you got it.
Bye, guys.
Good day, everyone. My name is Adam Livingston, and I am the Bitcoin Wizard. Today is yet another fun day. Bitcoin up another 3%. MSTR only up 7 or 8% as of filming, and I must say, the bears are getting totally destroyed. Honestly, it's not really surprising in the slightest, because on this channel, we have been breaking down the math throughout the entirety of the bear market, literally since October 6th. Nobody here has lost any faith, because here on the Bitcoin Wizard channel, we are based in actual reality. We don't deal with FUD, schizo, lunatic, doom-posting clown bears. And a lot of people have been doubting Bitcoin for a very, very long time, but sorry to say, it just rocketed north of $72,000. It's up $3,000 overnight, and there's been some developments and the story about the U.S. Treasury announcement of buying back the long-term debt. Yes, indeed, Bitcoin is just surging on the news that U.S. Treasury Secretary Bessent says that Treasury buybacks announced yesterday could now more than double, exceeding $4 billion per operation. Bessent said buybacks will increase by at least double, adding, "We have a big toolkit, so we will see." Now that's really hilarious government speak, at least double. Did you pay attention to that terminology? By at least double? That's hilarious. Is it gonna triple? Is it gonna quadruple? What are the buybacks gonna do when they start on September 9th? But this is the meat and potatoes of the story here. This comes just hours after the US 30-year Treasury yield erased all of its decline following Wednesday's announcement. Yes, indeed, this is the rundown of the situation. The US 30-year note yield hit the highest since June 2007, which, to be clear, is 1 year before the Great Financial Crisis. And then we saw, of course, the US Treasury just announced an intervention yesterday, and as a result, the US yields dropped extremely sharply. We saw the yields plunge to a 5.19%. So we saw the US Treasury boost the buyback to $4 billion, and then we saw the yields just skyrocket again, right back to pre-buyback announcement levels, literally within 24 hours. So what's this telling you? Well, it's telling you that government intervention needs to increase to tame this monster. And of course, this is an expression of why we're all long Bitcoin and short fiat currency. The interest on the $40 trillion national debt is going to be $2.5 trillion per year within the next 2 years. The US national debt will probably be around $50 trillion by the time that Trump leaves office in January of 2029. It's very clear with what we're seeing with Japan, what we're seeing with the United States right now. Fiat currencies are failing, the debt-based monetary order is failing, and there is one way out, which is monetary repression, devaluation of the fiat currency. And this is why we are long Bitcoin, short fiat. And what I love doing when I'm investing, when I'm thinking about how I'm going to get rich and retire my bloodline, I want to take the most short fiat, long Bitcoin positions that I can possibly find. And we're going to be doing some moon math calculations because I want some bull fuel today. I'm sure that you guys probably do as well. If you guys could do me a huge favor, like the video below, subscribe to the channel on YouTube. That way you can support me spread the orange gospel of Bitcoin to the masses. The satanic central bankers are getting absolutely wrecked. There is no stopping the great orange singularity, so I would really appreciate your support. And look, everyone, if you are listening to the Bitcoin Wizard, I'm going to go out on a limb and assume that you think Bitcoin or MSTR has the chance to be one of the best performing assets over the next 5 years. What if you could get more than half of that upside with full principal protection? That is exactly what my friends at Solvana are building. Every single dollar of your investment is secured by a title-insured recorded lien on U.S. real estate, and you split the upside with the property owner whose home equity is backing your own investment. If you've been waiting for the right time to buy Bitcoin or MSTR that allows you to sleep at night, this is it. And honestly, what better time to lock in a 5-year position? Use the QR code on the screen or go to solvana.io/capital. Click the link in the description below to get started. Do not delay. This is a sweet deal, my dearest little children. And you know how excited I get about Bitcoin treasury companies and this ongoing institutional adoption of Bitcoin. But do not lose sight of the fact that the #1 strategic reserve of Bitcoin is your own Bitcoin and 100% self-custody with zero counterparty risk. This is the real revolution, and my friends at the Bitcoin Way are standing by to help you be your own bank, to help you run your own node, to help you be a sovereign Bitcoiner. The Bitcoin Way, their client funds lost $0.00 worth of Bitcoin during this latest cold card hack fiasco. The Bitcoin Way has the Bitcoin Wizard seal of approval. I highly recommend that you go to thebitcoinway.com/Adam, scan this QR code right here, schedule a 100% free introductory call with the Bitcoin Way today. Do not delay, your freedom depends on it. So Bitcoin is absolutely mooning today. So is MSTR. Let's have a look at Strategy's balance sheet right now. The stock is trading at $112.51. The reserve up 2.76 billion just as of 11:07 a.m. when I'm filming this. Are you kidding me? And this is my favorite part because I want to dial into this little thing that the bears continue to miss. There are a lot of MSTR bear clowns out there. A lot of Bitcoiners, in fact, that still don't understand this, even though I've explained it about 1,000,000 times. There is a good reason why MSTR is blowing Bitcoin out of the water over the past couple days. And we can look at two metrics on Strategy dashboard right here, and it tells us why. We have their reserve number right here, which is essentially the value of their Bitcoin reserve as well as their USD cash reserve. They have about $4.8 billion of cash right here. And obviously, when you just crunch the math, this means that they have over $60 billion of Bitcoin. Now, this is the important part. To the right, you will see the net reserve. This is the Bitcoin reserve plus the USD reserve less the out-of-the-money notional debt and preferreds. And this updates every 15 seconds, guys. You can look at this on strategy.com whenever you want to. But I'm noticing something very, very funny here. It's something called amplification. And this is why I'm not only buying MSTR hand over fist, I am being a proper degenerate and I'm buying out-of-the-money call options on MSTR because I want giga sensitivity to Bitcoin, okay? I want mega giga sensitivity to Bitcoin, and that is because I don't want my children eating cricket paste for $40 a pound in 2032. You see, the net reserve is the residual for the MSTR shareholders. As an MSTR shareholder, this number right here is what I care about because obviously Strategy is issuing debt, they're issuing their preferred stock to buy Bitcoin, but I want to know what my residual is, okay? I am an MSTR shareholder, and you can see that same $2.7 billion is hitting the reserve and the net reserve. That nominal number is hitting it equally, but there is a higher percentage net reserve return right here, and that's for me, the MSTR shareholder. You can see that expressed as amplification. That is 1.39x the BTC reserve divided by the net reserve, representing the total Bitcoin as a multiple of the portion left after the debt and preferred claims. And because the debt, the outstanding convertible debt, is fixed in dollar terms, thankfully we get to see that stay fixed in fiat while the Bitcoin NAV goes up in value. And that value accrues to you, the MSTR shareholder. It's pretty nice. Now, this is important. This is a big deal because we are seeing Strategy's net leverage go down to 3.2%. That's correct. It's now down to 3.21%. So this is the debt less the USD reserve divided by the BTC reserve. So clearly all of the bears that have been claiming that Strategy is absolutely screwed, that they're going to be a forced seller of Bitcoin because of the debt, there is literally 3.2% net leverage right now. So clearly throughout a bear market, not only have we seen Strategy have their best year of Bitcoin buying ever, over the last calendar year, they raised more than $10 billion from STRC to buy Bitcoin. They're raising capital at the fastest pace in company history. Year to date in 2026, we are now seeing the net leverage of Strategy down to 3.2% after what has been the narrative this entire year, that Saylor is on the brink of a death spiral collapse, that he's going to be a forced seller of Bitcoin, that there's going to be a sub 1x MNAV death spiral. All of the bears have been totally declawed. Literally, what is their last remaining argument? I don't think there is one. I continue to come to my desk every single day, try to use the CEBE framework to try to break MSTR, and I literally can't. Yet, it seems like half of the Bitcoin community, they think that Strategy was on the brink of destruction. I saw clowns calling for Saylor resigning by end of year. What are we even talking about? And that leads us to the next most bullish indicator that I'm seeing so far. Remember, I'm just filming this and the day's not even halfway over yet with trading, yet I'm seeing something very interesting. Let's have a look at the trading volume. As of filming, there's about 3 hours, 45 minutes left of trading today, and Strategy is already double their average 30-day trading volume. Now, why is this a big deal? It's a big deal because their capital raising when they sell MSTR, a huge advantage of their ability to do this is derived from the liquidity of the common stock. When there is a lot of trading volume, you can issue shares into the market like crazy because this is why. It hardly affects the price when you have this much trading volume. There is tremendous liquidity. It is droplets of water in an ocean. Now, who knows what the trading volume for the rest of this week is going to pan out to be? It appears that on Monday, just under 17 million shares traded. Yesterday, 49,175,000 shares. And actually, I'm remembering that Monday was actually the 17th, so there's an additional 20.3 million shares traded. And then we assume we're about halfway through Thursday. We don't even know what Friday is going to do, but let's crunch some math real quick. This is just napkin math, but I just want to illustrate for you what strategy could do here. 49,175,200 plus 16,911,030 plus 20,353,420. So in the first 3 days of this week, that's about 86.4 million shares traded. And let's just say that the strategy team wants to ATM 4% of the volume. I don't know what they're actually going to do, but that's just a good guess. That could be 3.4 million shares sold, and who knows what the average selling price was. Let's say it's $100 because obviously we saw the low 90s. Now it's a little over 100. Let's just do $100. Just like that, that's $345.7 million potentially raised in the first 3 days of trading. Now, obviously, with this level of trading volume, I would assume that they would want to be hitting the ATM right now, making sure that they are selling those shares into this strength, because that small percent of the overall traded volume, that could boost their USD reserve to over $5 billion. That could increase the credit quality of STRC. The credit investors might like that, and Strategy has come out and said that is their number one opportunity. And remember, I'm not even counting their trading volume for today or for tomorrow either. And who knows, maybe Bitcoin goes to 75,000. You gotta like the momentum. And there might be some of you that are thinking, wow, Bitcoin is dominating. Yes, therefore the math dictates that MSTR is dominating more, but I'm not so sold on Bitcoin right now. I think this is just a counter trend rally, and we're still going to 40K in October, bro. I'm a basement-dwelling troglodyte in my mom's house, just scared that Bitcoin's actually gonna go up. I'm gonna wait to buy the dip, bro. As if I couldn't possibly be giving you guys any more bullish indicators for Bitcoin, let me give you another one. Yeah, I'm rocking the clickbaity titles for my posts here because I do think the Bitcoin bull market may be confirmed. Not only have we seen a lot of seller exhaustion, but check this out, kids. We have seen a breakout of the 200-day moving average. Now, whenever you buy Bitcoin here throughout history, it always tends to be a really great idea. This is exactly what that chart looks like. The yellow line here is the 200-day moving average. This is from about 2023. Whenever you see the breakout, Bitcoin always goes up and to the right. Quite literally, whenever you see that green candle breakout, this is a buy signal. And of course, today, what are we seeing? We are seeing a sizable breakout above that exact 200-day moving average line. Now, if you want to know what Bitcoin's forward returns look like from those points in time, don't worry, I got you covered. Check this out, January 2023. 1 month, up 9%, no big deal, but that'd be close to 80K Bitcoin. 3 months plus 52%, that would get us over the 100K mark over the next 3 months or 6 months, and then the 1 year mark. This would indicate that we would blow past the Bitcoin all-time high. That's over 140K Bitcoin. If we look at the October 2023 breakout, it's even more bullish. You saw a plus 33% return on the 1 month time frame, plus 46% over 3 months, plus 125% over 6 months, and plus 135% over the 1 year time horizon. The October 2024 breakout was a bit less bullish, but still positive numbers. You gotta love it. All positive no matter which way that you slice it. And then when we get to April 2025, obviously this was 6 months before the bear market started, but still some positive returns over the next few months. So basically, I'm seeing 16 total return numbers here, one of them being negative, which was the April 2025 1 year forward return. So when you look at the median forward returns, every single one of them was sizably positive. Remember, this is not the average, this is the median, kids. Plus 26, plus 45, plus 41, plus 93. Every single previous breakout was 1, 3, and 6 months later. And this is what I gotta say, is Bitcoin really this easy? Literally just buy whenever this signal flashes? Is it really this easy? crazy. And if you're telling me, Adam, that sounds good, but history doesn't always rhyme, I'm not quite bullish. Well, guess what? I have another fun one for you. Check this out, kids. I made this very delicately titled post called "Coin is about to melt everyone's faces off." Now, for those of you who don't know, Bitcoin has been in a bear market not only in US dollars since October of 2025, but it's been a bear market in gold for 610 days, literally since December of 2024. This is back when people were using ChatGPT for only poetry, okay? 610 days. So basically, we have seen 3 completed cycles of Bitcoin bear markets priced in gold, and we have reached this same milepost before today, which is 610 days into the Bitcoin gold bear market. But obviously, I know that you're gung-ho about USD returns, okay? You want NGU in fiat terms. Don't lie to me. I know you do. So let's crunch all of those Bitcoin bear markets priced in gold into a median number, a median return number. And let's look at the forward returns in US dollars from whenever we run forward from the day 610 mile marker. The 6-month median return plus 40%, 12-month plus 115%, 18-month, year and a half plus 269%, and the 2-year return a plus 333%. To be clear, that would indicate over $250,000 Bitcoin within 2 years. And guess what? Every single cycle tripled inside of a year and a half. Every single one. The weakest of the 3 still paid 225%. And if I extrapolate that number, what is that? Bitcoin $72,346. It keeps going up as of filming. This is fantastic. But we're going to multiply that by the 3.25. That would imply a $235,000 Bitcoin price within 18 months. So this is yet another bullish signal that is being fired when you look at the Bitcoin priced in gold and the bear markets and the forward returns. Now, this is what that chart looks like, my dearest little rat children, just in case you're not bullish enough, kids. Now, the white line is the 2013 cycle peak. What you'll see is that after the 18-month mark, absolute face-melting returns. This is when Bitcoin was in its infancy. And then in 2017, that was the one time where we really didn't see immediate positive returns, but within a year, pretty much everything was golden, no pun intended. And the purple line is 2021, the cycle peak right here, which was pretty much up and to the right from this point in history. Now pay attention to the orange line. This is the median right here, marking all of the median returns throughout all of these cycles in Bitcoin's history. Now, this is my favorite part of this chart, is that at the 18-month mark, all of the results are clustered around 18 months. Every single cycle saw very similar return percentages at that 18-month mark. That's very interesting how they all kind of clustered around 18 months. And every single cycle tripled within 18 months, which would indicate north of 200K Bitcoin. So my dearest friends, if you're not bullish after all of this, you probably need to check your pulse. And if you do feel your heart beating through your chest because of all this excitement, kind of like I am, perhaps you should get your estate planning done. We still have a long way to run. The government is going to print so much money, it's going to juice the risk assets. But we know Bitcoin is the least risky asset in the world, but unfortunately, we have to be the crazy ones for now. But it's very clear to me that the tide is turning. We hit the Bitcoin priced in gold low on February 28th. That was almost 6 months ago. We have seen a 34.8% return off of the low. And if we just make the return to the Bitcoin gold ratio that we saw in October when Bitcoin hit the US dollar all-time high, that would imply a close to a doubling of the price, $140,000 Bitcoin. I wouldn't want my money in anything else right now. All signs are a go. I'm not so sure that we've totally escaped the bear market, but I am 98% sure. If I had to put a confidence factor on it, that's probably my probability number there, 98% likely in my humble Bitcoin chicken gizzard lizard opinion. Anyway, guys, that is the show. Thank you so much for tuning in. I hope that you were as bullish as me. If you guys could do me a favor, please hit the like button, subscribe to the channel on YouTube. That way you can support me spread the orange gospel of Bitcoin to the masses. Have a very terrific day, everybody. Do not party too hard. Class dismissed. If your business partner, spouse, or whoever controls the money isn't quite as bullish on Bitcoin or MSTR as you are because you have seen the math That is okay. My friends at Sovana have you covered. Tell your board, your wife, your husband, whoever. With Sovana, you can now buy Bitcoin or MSTR with full principal protection. That is right. Discussion over. Time to buy Bitcoin and MSTR because the worst case scenario is your investment stays flat, while the best case scenario is the bullish moon math and asymmetric upside we all know is possible. Scan the QR code on the screen or go to sovana.io/capital to learn more. The Sovana team will be happy to answer your questions and walk you through how it works from start to finish. Win the debate once and for all by removing the downside completely. Thanks to Sovana, you can now buy Bitcoin and MSTR with full principal protection. And you know how excited I get about Bitcoin Treasury companies and the insane levels of institutional adoption of Bitcoin that we are seeing. But don't lose sight of the fact that the most important strategic reserve is your own, Bitcoin in 100% self-custody with zero counterparty risk. This is the revolution. My friends at the Bitcoin Way will train you to be your own bank using the best open source tools. They will turn you into a node runner. They will make you a sovereign Bitcoiner. Go to thebitcoinway.com/Adam to schedule a free introductory call and get started today. Do not delay. Your freedom from the fiat system depends on it. Good day, everyone. My name is Adam Livingston, and I am the Bitcoin Wizard. Welcome to the most American financial story imaginable, kids. The government continues to borrow obscene amounts of money. The bond market is starting to charge adult prices, and Washington is getting visibly uncomfortable. The Treasury today is reaching for the plumbing tools that are necessary, and of course, Bitcoin immediately levitates like it just heard the words open bar. Bitcoin up 7% today. Yeah, MSTR up more than 14%. Somewhere, somebody with their 60-40 portfolio is hyperventilating. They're seeing Bitcoin at $68,000. And they are starting to freak out. Because today's story is a lot bigger than a green candle, kids. It is about the market discovering the approximate yield level where Washington starts to feel chest pain. The Treasury doubled the maximum size of the large and buyback operations, and Bitcoin moved before anything began to even function. The market is smelling the reaction function today, and Bitcoin is mooning. MSTR is taking that Bitcoin move and amplifying it. All of the Treasury companies dominating today. And the reality is that we are just being proven correct time and time again whenever Bitcoin goes up and to the right. This is the thesis playing out in real time. Bitcoin is going to the moon. So is MSTR. You guys are going to love today's video. We're going over everything. If you could do me a huge favor, like the video, subscribe to the channel on YouTube. That way you can support me spread the orange gospel of Bitcoin to the masses. And look, if you are listening to the Bitcoin Wizard, I'm going to go out on a limb and guess that you think Bitcoin or MSTR has a chance to be the best performing asset over the next 5 years. Now, what if you could get more than half of that upside with full principal protection? That is exactly what my friends at Sovana are building. Every single dollar of your investment is being secured by a title-insured recorded lien on U.S. real estate. And you split the upside with the property owner whose home equity is backing your own investment. This is an amazing model. If you've been waiting for a way to buy Bitcoin or MSTR while being able to sleep at night, this is it. And honestly, what better time to lock in a 5-year position than when Bitcoin and MSTR are sitting in a bear market that's heating up faster than the money printer. Use the QR code today. Go to sovana.io/capital to get started on this amazing opportunity. And you guys know how excited I get about Bitcoin Treasury companies and this ongoing institutional adoption of the Apex asset, but do not lose sight of the fact that the #1 strategic reserve is your own Bitcoin in 100% self-custody. Eliminate counterparties, run a node, become sovereign. You can secure your Bitcoin position with the Bitcoin Way today. These guys lost 0 of their client funds during the latest cold card fiasco. If you want to be your own bank and become a sovereign Bitcoiner, my friends at the Bitcoin Way are standing by to help. You can schedule a 100% free introductory call with the QR code right here, or go to thebitcoinway.com/Adam. Do not delay. So this is the head headline that pretty much changed the tape today, Treasury unexpectedly increased its long and liquidity support buyback capacity immediately after the long bond had been testing multi-decade yield highs. They are increasing the long and liquidity support buybacks from a maximum of $2 billion per operation to at least $4 billion. Now, this is my favorite part of their phrasing. The beautiful phrase is "at least." At least is what your contractor tells you when he's working on your kitchen renovation. At least is what the Pentagon says before a printer catches fire. At least just turns a number into a lifestyle. So that's my favorite part of the government lingo, using the term "at least." Now, specifically, these enlarged operations that Treasury is announcing begin on September 9th and run through early November. So the larger purchases are still weeks away, yet the markets immediately reacted. This has been a very common theme on this channel if you guys have been paying attention. You need to understand that Bitcoin is the asset with the most hypersensitivity to liquidity, to what the Fed's going to do, to what the Treasury is going to do. This is proven empirically. So Bessent and the Treasury, they're just watching the long-duration government bonds just getting beaten to death behind a strip mall. They're looking at the 30-year yield that is north of 5%, and we've all been waiting for this. I think that all of us knew that some type of intervention was going to happen, and then today it did, and then of course Bitcoin reacted immediately. So essentially we are at the time where Bitcoin is running out of sellers. If you're looking at all of the on-chain metrics that I have been posting on X, it really seems like we've seen a lot of seller exhaustion, and that is a lot of dry kindling, and a story like this is the match, because what happens is that Bitcoin sniffs this stuff out. It's always the first to react in size to news of this magnitude whenever it's relating to government spending or increased liquidity. Now, $4 billion, that sounds enormous because most human beings compare $4 billion to their mortgage. In Treasury market terms, though, $4 billion is different. The broader Treasury market is around $31 trillion, so the direct flow is tiny relative to that ocean of government paper. Yet you got to remember, the price is set at the margin, and expectations always move before flows arrive. The market learned that when duration pressure gets ugly enough, the Treasury has tools and a willingness to use them more aggressively. So policy regimes are always revealing themselves through very tiny adjustments like this. The technical releases, the sentences that are just buried in debt management language written by people who regard exclamation points as a controlled substance. And then the dollar, the DXY, has been awful today. And then of course bonds rally, and then Bitcoin jumps 7%. Now this is where we preserve our IQ points here, because a lot of people on social media are failing to make this very simple distinction here. Treasury buybacks operate through debt management, okay? The Treasury cannot create bank reserves. Treasury retires selected older securities and finances government obligations through the rest of the issuance machine. So the useful lens here is this concept of duration, okay? Because the private market has been being asked to warehouse a gigantic quantity of long duration government risk. This is what's been happening. Now that inventory carries interest rate exposure. When buyers demand more compensation, that just means that the long yields rise, and those long yields, those bleed into mortgages and equities and real estate and every single CFO's blood pressure. So what they're doing is the Treasury is relieving some of that pressure by buying the less liquid long bonds, and then they're shifting their financing toward the paper that the market absorbs more easily. So think about this absurdity of modern finance. We have, number one, the United States about to cross $40 trillion in national debt, and the civilization is now depending partly on whether a money market fund in Connecticut prefers a 3-month bill over a 27-year bond issued when TikTok still had a different CEO. You see, duration is plumbing. Liquidity is the water pressure. Today, somebody is touching the valve here, and every single risk asset hears that. And now to explain it one more time, because people are asking, oh my gosh, why is Bitcoin going up? Well, it's going up forever because the government will just continue to print money hand over fist, because let's be honest, the politicians are never going to fix this problem any other way. except through monetary repression and the devaluation of fiat currency. We all know this. But when you are seeing that long end with that stress right there, the 30-year yield pushing 5.3%, this is, the highest that yield has been in, 2 decades or something. The Treasury's going to respond, and then they're going to increase their buyback capacity by at least 2x. And then bonds rally, the yields fall, the USD softens, and of course, when the USD softens, Bitcoin goes up. That is the anti-fiat, short fiat, long Bitcoin trade that we all know and love. You see, Bitcoin trades 24 hours a day, free of all of the committee calendars, the investor relations choreography, and 40-page memos explaining why this thing happening directly in front of you is just transitory. Bitcoin just reprices. It is the feral macro asset. It lives behind the dumpster of the global monetary system and can smell policy food from 3 countries away. And yes, it sniffs it out because the operations begin September 9th, but Bitcoin moved on August 19th. The reaction is always forward-looking. Bitcoin is always the signal. And this candle is enormous at a plus 6.9% move. Today would rank as the second largest positive Bitcoin day in the last 12 months if of course this move holds in to the daily close here. And this is arriving after a period where Bitcoin volatility got compressed so hard, the chart really started to look sedated, like it was a tranquilized cow. You see, Bitcoin spends weeks convincing everybody it has become a municipal bond, and then it suddenly adds thousands of dollars in the blink of an eye. You see, confirmation always arrives through the windshield, kids. I can dive into this right now. I can show you that I actually called this last night. No, I'm not joking. So before we get to the volatility though, I do want to talk about the seller exhaustion because I did mention that earlier in the video. But the last time that holders were this underwater, Bitcoin was $16,700. This is using the print from June 30th, the local Bitcoin price bottom that just happened, 49 days ago. And actually, that's now 50 days ago because I remembered I calculated this last night. But it was very simple. I just took the long-term Bitcoin holder supply and loss, and then I found the cycle bottoms every single cycle, in 2015, 2019, 2022, and 2026, because the bottom was on June 30th when that metric specifically touched the floor. I moved 49 days into the future. Then I measured up some median returns, and the numbers are pretty crazy. A median path across all of 2015, 2019, 2022, when we have hit that exact same level, $105,000 Bitcoin in 6 months. It would imply in about a year and a half, $168,000, and in 24 months, almost $750,000. Now, I'm not saying that Bitcoin's going to be $747K 2 years from now, but that is what the median number is for 2-year returns throughout all of those other prior bottom cycles, with the long-term holder supply being at the same point that we're at today. What's crazy is that the floor across 3 cycles was a 4.3x, and that's the 2-year return. That's the floor. And that would imply, roughly $250,000 Bitcoin, the worst case 2-year scenario. This is what that chart looks like, and it's pretty ridiculous. So, you have a lot of these crypto trader bros that are saying that we're going to bottom in October, and I'm just looking throughout history, and I'm like, well, you look at the long-term holders, that supply and profit and loss hit a low on June 30th of this year. And then I indexed the start to 1 for all of the cycles, 49 days past that cycle peak in the long-term holder supply and loss. This yellow line is the median. Now, obviously, you do have this blue line here. That's the 2019 cycle. But regardless, you do see that all of them pretty much started going up and to the right immediately. So this seems like June 30th was the bottom, at least with this indicator it does. So then I woke up this morning and I wanted to check in on Bitcoin's volatility. Now, specifically, I looked at the volatility of Bitcoin's adjusted MVRV ratio. And if you guys want to know what that is, this is the description of this on-chain metric here. It removes the realized cap of old age cohorts measured in days, treated as lost coins, and then recomputes the MVRV using only the active supply. And the MVRV ratio itself basically explains Bitcoin's market cap to its realized cap, okay? How far the circulating supply is above the realized cost basis here, which is the aggregate on-chain cost basis of the entire network. It's the market cap divided by the realized cap. And so I wanted to know the volatility of the adjusted MVRV, adjusted for lost coins. And I found some pretty striking details. So you want to talk about bottom signals? Here we go. The volatility of Bitcoin's adjusted MVRV ratio collapsed to a 0.3rd percentile reading since 2017. That means that 99.7% of Bitcoin's modern history was more volatile than this. But this is the important part when I look through at all of Bitcoin's price history. When does the volatility compress? And what does that mean for the forward returns from that point whenever things get this coiled, when things get boring in Bitcoin? So check this out. Look at November 2018. The reading was 1.27 to 1.45. So the 60-day volatility identical. And the adjusted MVRV was 0.02 off November 2018. Now you compare that to today. Extremely similar readings. It is uncanny. These were Bitcoin's historical median forward returns from those two historical setups. Pretty crazy, small sample size, absolutely, but it's very easy when you look at Bitcoin's decreasing volatility. When it gets this compressed, history just says that the forward returns of Bitcoin always come when we are this compressed in the volatility here. 6 months, 82% return. A year, 83%. 18 months, 136%. 24 months, 246%. So whenever we've seen the spring being this compressed, things get boring, and that's when you need to be bullish. You have to reverse your psychology about being excited when everybody else thinks that it's bored. That's how the money is made. And I went ahead and plotted this on a chart that's really cool. On the y-axis, I do have the 60-day log volatility, and then on the x-axis, that adjusted MVRV. Now, of course, you are seeing those three prints here showing you the volatility versus valuation. And obviously we are an outlier on the data point right there. And these are just the forward returns from whenever we have matched that same exact reading. How can you not be bullish on Bitcoin after reading this? And then also on top of all this stuff, what's really cool is that we have just seen the tech stocks, the AI super cycle. It's been blowing Bitcoin away, especially when you measure it from the Bitcoin all-time high. But some good news, today's Bitcoin day is the second best day versus the QQQ since October 6, 2025. Very cool. And actually, it's the best day on a QQQ down day. So it's either one or two, depending on which way that you look at it. But obviously, this is amazing to see because this breaks a trend that we've been seeing. 10 straight months of getting dragged behind the shed by the mega cap tech. Yeah, Bitcoin is ripping while the QQQ slipped 0.04%. Now, obviously, that relative outperformance is crazy. Only February 6th was bigger, and that was the snapback after the largest Bitcoin price correction in nominal terms in the history of the asset. Anyway, yeah, it's just super cool here to see a green candle of this magnitude because we have been getting beat up, like literally 2 good days this year. I mean, look at this trend since the all-time high. Obviously, if you're going to measure from the all-time high, it's not going to look good in a bear market, but regardless, it's just really nice to get a win today. Now, I do want to talk about the MSTR bear clowns out there because a lot of these people, man, yesterday, I was telling some people this in a group chat, but I was like, today feels like the capitulation event for the MSTR shareholders. It like really did yesterday because if you guys don't remember, I know that we all have short time horizons here, short memories, but MSTR was down like 5% yesterday when Bitcoin was roughly flat and people were losing their minds. Actually, Bitcoin might have been up 1% with MSTR down 5%. And of course, you had the flood of MSTR shareholders that are like, whoa, I'm getting diluted. I can't handle this. I had to emotionally handhold like 8 or 9 people yesterday, and I just got fed up with it. I'm fed up with the people staring at a 70+ volatility asset on the daily chart, wondering if the thesis is broken. And what poetic justice for today to happen after yesterday, which was probably the biggest emotional outburst I have seen from grown men in the history of me being in the MSTR trade. But I do want to illustrate something to you because this is really funny. We've been seeing all these Bitcoiners claiming that Bitcoin is going to outperform MSTR on the way up. And then MSTR, you know, casually has a plus 15% day, you know, just casually 2.5xing Bitcoin Bitcoin's returns on the second best Bitcoin day of the year. So let me pull up Strategy's dashboard because I'll actually break this down for you. It's very simple. So we're going to keep it easy. Just look at two numbers. Obviously, Strategy has a Bit reserve. Now that's pretty cool. They also have a USD reserve too. And the sum of their Bitcoin reserve and their USD reserve is $62.28 billion. That's pretty solid. Today, it's up 3.4 billion. Now, obviously, if you adjust for the outstanding debt and the preferred stock and the USD reserve, you account for everything. You know, I've talked a lot about CEBE on this channel. Strategy is using a net reserve metric, so you are accounting for everything. And you can see the definition right here. It includes everything, updates every 50 seconds. That's great. Now, if it's adjusting for everything, what do they mean by net? This is the residual reserve for MSTR shareholders. Now, what do you witness here between these two numbers? Can you actually tell me what you guys notice? I see plus $3.449 billion for both of the numbers, but I see a percentage difference there. That's weird. The reserve is up 5.84%, but the net reserve is up 9.29%. It's almost like MSTR is amplified Bitcoin and you get the spread between the fixed senior claims and the Bitcoin going up. And what's funny is that the MNAV moved a little bit today. The MNAV is up 3%, but look at the net reserve. It's up 9.25%. This is literally proving that MSTR can outperform Bitcoin even if there is zero MNAV expansion. If I have to explain this one more time to the moronic Bitcoiners who show me the chart of the MSTR share count going up and crying about dilution of a stock that, number one, they don't own and they don't understand, I think I might have a stroke. So anyway, these people are totally stupid. MSTR is greatly outperforming Bitcoin today. Shocker, surprise, I know, up only 12% as of filming. The net leverage is down to 3.4%. That's hilarious. The debt is not even an issue anymore. Well, it actually never was, to be clear, but regardless, 3.4% net leverage is hilarious. And then you have ASST up 13.28% today. I mean, just dominating, firing on all cylinders. How do you not like this? SATA is 10 cents from par. Digital credit not dead. Bitcoin not dead. MSTR not dead. The bears are bloodied, lying out in the street waiting for death, and these people are just ridiculously stupid. I did say I will continue to take the most short fiat long Bitcoin positions I can possibly find. This is a fun little screenshot of my fun Robinhood side account, and man, all of those call options looking pretty damn good today. Bitcoin is the hurdle rate. I refuse to subject myself to the purity tests of the clowns out there. It's not that hard. The governments will continue to print money forever. Bitcoin is going to $1 million and beyond. Therefore, I want to take an amplified rocket ship on the journey there, kids. My name is Adam Livingston. I am the Bitcoin Wizard. If you guys could do me a huge favor, like the video, subscribe to the channel on YouTube. That way you can support me, spread the orange gospel of Bitcoin to the masses. Have a very terrific day, everybody. Do not party too hard. Class dismissed. If your business partner, spouse, or whoever controls the money isn't quite as bullish on Bitcoin or MSTR as you are because you have seen the math, that is okay. My friends at Sovana have you covered. Tell your board, your wife, your husband, whoever, with Sovana, you can now buy Bitcoin or MSTR with full principal protection. That is right. Discussion over. Time to buy Bitcoin and MSTR because the worst case scenario is your investment stays flat, while the best case scenario is the bullish moon math and asymmetric upside we all know is possible. Scan the QR code on the screen or go to sovana.io/capital to learn more. The Sovana team will be happy to answer your questions and walk you through how it works from start to finish. Win the debate once and for all by removing the downside completely. Thanks to Sovana, you can now buy Bitcoin and MSTR with full principal protection. And you know how excited I get about Bitcoin Treasury companies and the insane levels of institutional adoption of Bitcoin that we are seeing. But don't lose sight of the fact that the most important strategic reserve is your own Bitcoin in 100% self-custody with zero counterparty risk. This is the revolution. My friends at the Bitcoin Way will train you to be your own bank using the best open source tools They will turn you into a node runner. They will make you a sovereign Bitcoiner. Go to thebitcoinway.com/Adam to schedule a free introductory call and get started today. Do not delay. Your freedom from the fiat system depends on it.
Welcome. This is BFC in NYC, the premier institutional Bitcoin adoption event. We are here with over 300 decision makers from across the industry. We're excited to welcome you, and let's get into it. So the people in the room are what makes today an incredible event. The top companies who are allocating Bitcoin to their balance sheet and leveraging Bitcoin to run their businesses are all in the room, having conversations and making deals happen. All the decision makers from across the Bitcoin ecosystem who have anything to do with corporate adoption, institutional adoption, are in the room here at BFC in NYC. Thanks for coming, and we hope you enjoyed the event. We'll see you in Hong Kong. Welcome. This is BFC in NYC, the premier institutional Bitcoin adoption event. We are here with over 300 decision makers from across the industry. We're excited to welcome you, and let's get into it. So the people in the room are what makes today an incredible event. The top companies who are allocating Bitcoin to their balance sheet and leveraging Bitcoin to run their businesses are all in the room, having conversations and making deals happen. All the decision makers from across the Bitcoin ecosystem who have anything to do with corporate adoption, institutional adoption, are in the room here at BFC in NYC. Thanks for coming, and we hope you enjoyed the event. We'll see you in Hong Kong.
According to regulatory filings, the world's largest corporate holder of the digital token sold more than 1,600 Bitcoin for more than $108 million total. Strategy sold the Bitcoin at an average price of about $64,200. It's the second consecutive week the company has sold and marks the seventh week in a row it has not made any Bitcoin purchases. Let's find out what the plan is. Joining me now in a Fox Business exclusive, Strategy CEO Phong Le. I get the selling for the moment because you got to raise some cash, because you've got the preferred shareholders that you need to make sure you pay their dividend. But why no purchasing of Bitcoin at all?
Yeah, let's start with some perspective, Liz. We now have 840,000 Bitcoin. Since the beginning of the year, we've bought 175,000 Bitcoin and we've sold 7,000, so about 25x more. And in the last 3 months, we've gone from being the number 2 institutional holder of Bitcoin in the world to the number 1. Right? So I think we've bought a lot throughout the course of the year. We've increased our holdings 25%. I've said we're now the JP Morgan of the digital economy. And we'll get back to buying more Bitcoin throughout the course of the year.
What, does the price have to go down, or you want to see it go up? Right now, it's at $63,950 per Bitcoin.
Yeah, it's not really price related. What we've been doing over the course of the last few months is adding to our US dollar reserve, right? So we've added 175,000 Bitcoin this year, sold 7,000, and we've actually increased our US dollar reserve to 4.75 billion from about 800 million. So that's been our focus over the last few weeks, and then we'll get back to buying Bitcoin at some point in time. And it's not price related, it's about whether we can do it accretively to our common shareholders.
It was last October that Bitcoin hit 126,000. Obviously, it's been cut in half, 64,000 at the moment. This has lasted kind of a long time. It's come up off the floor. But that said, how much longer do you anticipate this, and would you call it a crypto winter?
Yeah, I think it's reasonable to call it a bear cycle. It's been about 8 months, right? And if you go back to 2022, the last time we had a prolonged bear cycle, that started in about May of 2022. And it really went into the beginning of 2023. So a 8 to 12 month down cycle is not unusual. But what you find, and if you go back and look at the 18-year history of Bitcoin, every time there's a down cycle, Bitcoin comes back stronger the next time.
We've seen that, absolutely true. Never guaranteed, but that has been the history of it since the birth of Bitcoin. The question becomes for investors who bought MicroStrategy at more than $400 a share, and now we look at it, it's at $97 a share. What do you say to those investors who are out there saying this is a sign of financial distress, that strategy is selling, is actually selling Bitcoin?
I look at the underlying characteristics of the company. We have 4% leverage. We have now 2.7 years of dividend coverage. We have $55 billion worth of Bitcoin on our balance sheet. None of that signals financial distress. I understand, to our common shareholders, the stock has been down. I look at the history since we've been buying Bitcoin. Since August of 2020, Bitcoin has been up 33%. We've been up 42%, right? And so anyone who's investing in Bitcoin knows that it's a long time horizon asset, which has high returns, high volatility. If you're going to invest in MSTR, which is amplified Bitcoin, we have higher returns, higher volatility. And those who are looking for a shorter duration asset with lower volatility, that's why we created Stretch STRC. And it is, you do have to have the stomach for the volatility and longer duration to be a common shareholder of ours.
Yeah, it's sort of a buyer beware. This is a rough ride. It is not smooth. Michael Saylor, who of course is the chairman and had been the CEO, he recently posted on X this, and it was a picture of Bitcoin strategy reserve value with the caption, quote, "doing business." Can you interpret that for us? What did he mean, doing business?
We've been doing business every week for the last 6 years related to Bitcoin. The big difference between our business 4 years ago is we were basically buying Bitcoin, issuing debt, and buying more Bitcoin. We were levered Bitcoin. What's changed now is we have a lot more options. We can sell US dollars, we can sell Bitcoin, we can sell our prefers, we can sell our equity, and we can buy all of those things. So business is just a lot more options.
Is it a decision made between you two about whether to sell some Bitcoin each week, or is it you? Is it Michael Saylor?
We talk 3 to 4 times a day.
Okay.
And we consult with our finance team and we listen to our shareholders. But we talk quite a bit. So it's a joint decision. And of course, the board has guidelines around what we can do.
We've just got not too much time left, like 30 seconds, but the Clarity Act. What are you hearing? The Senate has not passed it, and it would give some much wanted guidance and regulation to the industry, which is actually asking for it.
Yeah, look, I think having clarity coming from the government, especially from Congress, would be positive right now. And it looks like they're going to vote for this come mid-September. So I think there's positivity comes out of that. Regardless, there's good rulemaking coming out of the SEC that will progress Bitcoin clarity.
Phong Le, CEO of Strategy. Great to have you. Thank you very much. All right, here comes the bell, everybody. And it looks like it's just, as we said, kind of a meandering, mealy-mouthed Monday. Lots of red on the screen, but nothing too deep. We'll see you tomorrow with Jan Hatzius of Goldman.
Good day, everyone. My name is Adam Livingston, and I am the Bitcoin Wizard. Ladies and gentlemen, Metaplanet has announced something very, very exciting this morning. They looked at Japan, and they decided that one capital market simply does not provide enough financial weaponry for its Bitcoin accumulation campaign. So they have crossed the Pacific. They have ended up in the United States of America. They found a tiny NASDAQ-listed gaming advertising company called Super League, and then they opened the hood to Super League Enterprise. They removed several years of corporate sadness. They are stuffing 2,100 Bitcoin into the engine compartment, and they have announced that this thing is going to be renamed Superplanet. Yes, Superplanet. And the ticker is going to be SUPA, S-U-P-A, not FUPA, SUPA. Now, this company is being designed as Metaplanet's American Bitcoin Treasury platform. Superplanet gets the NASDAQ, but Metaplanet keeps Tokyo. Suddenly, Simon Garovich now has 2 separate entrances into the global capital casino, and both elevators go directly to the Bitcoin floor. So this is a huge deal. The announcement is saying that they are seeding this company with 2,100 Bitcoin, and they want to issue perpetual preferred stock, digital credit Metaplanet is the business plan. There are lots of exciting things about this. Specifically, another thing, management. Literally, Metaplanet is going to own 95 to 96% of the float of shares. This thing is going to be convex as absolute hell. So this is very exciting stuff. I wore my Metaplanet hat yesterday. I think I actually somehow preempted this spiritually. I foresaw this coming. But things are going to become beautifully, deeply deranged. I'm talking a return profile that is going to be rocket fuel once Bitcoin actually starts to move. There's lots to cover today, so let's get into it. If you guys could do me a huge favor, like the video on YouTube, subscribe to the channel as well. If you're not subscribed, what are you doing? Hit the thumbs up below and say thank you, Daddy, for the content. I love you. I want you to type that out in the comments below. And look, if you are listening to the Bitcoin Wizard, I'm going to go out on a limb and assume that you're bullish on Bitcoin over the next 5 years. Well, what if I told you that you have a chance to buy Bitcoin or MSTR if you want to be a proper degenerate like me? You can buy either of these with full principal protection before the bull run gets here. That's correct. What if you could get more than half of the upside with full principal protection? That is exactly what my friends at Solvana are building. Every single dollar of your investment being secured by a title insured recorded lien on U.S. real estate. You split the upside with the property owner whose home equity is backing your own investment. If you've been waiting for a way to buy Bitcoin or MSTR that allows you to sleep at night, this is it. And honestly, what better time to look at this when we're sitting near the 200-week moving average? Scan the QR code to get started today. Go to solvana.io/capital right now. Have fun, kids. And you guys know how excited I get about MSTR, Metaplanet, Bitcoin Treasury companies, institutional adoption of the apex asset of Bitcoin. You cannot lose sight of the fact that the most important strategic reserve is your own. I'm talking Bitcoin in 100% self-custody. And my friends at the Bitcoin Way can help you be your own bank, be a sovereign Bitcoiner, and do it the safe way. My friends at the Bitcoin Way, they lost 0 client funds during this latest cold card hack fiasco nonsense. You can go to thebitcoinway.com/Adam right now, scan the QR code on the screen, and guess what? This gets you a 100% free introductory call. That's correct, 100% free. So what do you have to lose? Take your family's financial future seriously and schedule a call with the Bitcoin Way today. I'm not asking you, I am telling you. This is a command from Daddy Wizard, kids. So this is the announcement. Metaplanet, like I said, is contributing 2,100 Bitcoin to seed the company, also $2.5 million of cash, and they are assuming strategic control of this enterprise. In return, Metaplanet gets 44,859,400 common shares, preferred stock, and a metric ton of warrants. The common shares are being issued at $3 per share, which creates roughly $134.6 million of initial investment value based on the Bitcoin pricing methodology laid out in the agreement. So imagine trying to explain this to somebody in 2019. Yeah, there's this Japanese hotel company that turned itself into a Bitcoin treasury company. They decided to issue shares, and then they stacked 43,000 Bitcoin. Then they bought control of an American gaming media company, and then they renamed it Superplanet. The guy would have assumed that you suffered a traumatic head injury somewhere around Japanese hotel company, yet here we are. So Super League is already trading on the NASDAQ right now under the ticker SLE, but remember, it is becoming SUPA. Once the transaction closes, the ticker will become SUPA. The closing is expected in Q4 of 2026. What does that mean? From October, best case scenario, yeah, literally 2 months from now, to December, which would be a bit of a longer wait. But regardless, it seems imminent, kids, and Wall Street naturally has reacted with the emotional stability of a raccoon on amphetamines. And this is the good part. This already is an existing NASDAQ company. This isn't a SPAC reverse merger nonsense that we've seen with a lot of other Bitcoin treasury companies last year. They are explicitly describing this transaction as a strategic investment investment into an existing NASDAQ-listed operating company with cash flows. So the gaming media business is going to actually survive. The brands are going to get their advertising campaigns. The gamers are going to continue to stare at their screens, especially when GTA 6 comes out. And somewhere, a 14-year-old playing Roblox is remaining blissfully unaware that his advertising analytics provider has become part of a multinational Bitcoin treasury empire. The operating company in this company, Super League, now gets an entirely different Bitcoin financial purpose. The Bitcoin treasury is obviously going to become part of the primary driver of long-term shareholder value now. Not financial advice, this is financial entertainment. I just gotta say, they probably entered into this agreement with good reason. And this is the part that matters more than anything else in this announcement. Metaplanet will continue to raise capital in Japan, and MPJPY, it's still trading at 85% of the value of the Bitcoin. Right now, we're seeing Bitcoin touch $65,000 today. It seems like the bear market might be over, actually. And guess what? You can still get cheap Bitcoin in the form of the equity of Metaplanet at a big discount. So regardless, I don't think the market is pricing in what Metaplanet's going to do in the future. And then we are seeing these plans today. Now the stock is up 5%, but still that residual discount that I'm seeing to the Bitcoin holdings, man, MPJPY still seems extraordinarily cheap. But regardless, we have Metaplanet raising capital in Japan. You guys just saw my video about Bitbonds, how bullish that is, issuing capital at a 4% cost of capital to buy Bitcoin and rolling those bonds over every few years. Are you kidding me? If Bitcoin goes to $1 million over 10 years, I broke down the math in that video that's like raising equity at a 10x multiple. Yeah, that's the economic equivalent at $1 million Bitcoin. Go check the math in that. So you have Metaplanet, Metaplanet Securities over here dominating in Japan, and then you have Superplanet raising capital in America. This is going to become greater than Pizza Planet. And you got to understand that both of them belong to the same consolidated group here. They have effectively created a listed Bitcoin capital markets engine operating in the two largest financial markets on Earth, Tokyo over here, NASDAQ over here, Bitcoin sitting in the middle like some enormous orange financial black hole, consuming whatever securities bankers are willing to manufacture around it. So when we look at the ownership, Metaplanet is going to own approximately 95.7% of Superplanet's common stock. So basically, Simon Garovich isn't showing up to a quarterly earnings call with a polite suggestion box. Metaplanet controls everything. The preferred shares also provide important voting rights, including the ability to designate a majority of the board. 5 of the initial 9 directors are expected to be Metaplanet people. So when I describe Superplanet as Metaplanet's American Bitcoin treasury platform, I mean that literally here. After the assuming outstanding pre-funded warrants, this is 93.6% ownership. So this is ultimate control of the company, and the public investors, they get access to the common stock. Metaplanet has the bridge from America to Japan right now, and guess what? That low of a float for you to invest in, they own 95.7% of the company. This thing is going to be convex as hell. So now let's get to the part here, because we gotta crunch some math. This is going to get a little bit complicated because of all the warrants, because of the launch treasury, the implied effective shares. This is my initial read. Double check everything with AI, do your due diligence, but this is my crunching the math here, because right now the thing is trading like crazy. It opened at $3 and then it went up to like $6, $8, then it went down to $5. It's trading with a lot of volatility. We want to answer the question, how much Bitcoin does each share actually own here? Well, Metaplanet, remember, they receive 44.85 million shares using the company's 93.6% ownership figure after the outstanding pre-funded warrants. That gives us an implied effective common denominator of roughly 47.9 million outstanding shares. And if Superplanet begins with 2,100 Bitcoin, and then if you just do that basic division problem, that means it's 4,380 sats per share of common equity Bitcoin exposure. That is $2.80 per share of BTC NAV at 64,000 Bitcoin. So this is the number that I am using to judge every future financing decision around it. Does Superplanet issue securities and increase sats per share? Wonderful. Does management raise capital in a way that destroys sats per share? Straight to financial jail. And that's all exciting, but we must get to the part of the announcement where somebody apparently spilled cocaine on the capitalization table. Metaplanet is receiving 10-year warrants for up to 381 million additional common shares. Yeah, 381 million, and Evil Fund is getting 10 million. So that is 391 million possible shares. That is the total new warrant stack here. This looks like dilution from hell. But remember, you need to read the next layer here. It's the same thing with Strive. They have the outstanding warrants that expire in October, but guess what, folks? If they are exercised, the company gets the money. The company gets operating capital. So instead of asking how many shares get created, if you are a long-term investor, you have to think how much value enters the company for each share created, and how much Bitcoin can Superplanet purchase with that capital. That distinction is everything, because a share that is issued for nothing, that destroys you. And yes, when there are shares being issued, the market has to absorb those new shares hitting the tape. There's no way around that. But depending on the Bitcoin price, if they issue shares, if Bitcoin is cheap, if Bitcoin's expensive, there are a lot of variables happening in the marketplace, but they could increase your common equity, Bitcoin exposure, the NAV value backing each common share. And this is important. You have to remember that the bears out there, they always talk about these like they are dilution, but you cannot ignore the fact that they are literally a funding mechanism. And remember, Bitcoin is scarce. There's only 21 million of them. We are in a digital gold rush. It might seem like a good idea to exercise warrants for Bitcoin. Obviously, depending on when you exercise them, that is the big question. But CEBE, common equity Bitcoin exposure, it can rise even as the share count explodes. So you have to model this in to your investing decision. So imagine that Superplanet has 4,380 sats backing each share, but then somebody exercises a warrant and then they hand Superplanet enough money to purchase 5,000 sats for every new share created. Congratulations, the share count increased, Bitcoin increased even faster. Now, obviously, because the new shares can hit the tape and it does something to the float, that means that the price could come down, but remember, conviction in Bitcoin, at least for me, that's my backstop. I like to be directionally long amplified Bitcoin over long time horizons. So my common equity Bitcoin exposure, that matters a lot to me. That's why I'm still bullish on Metaplanet despite the hyper volatility. They are literally increasing the asset that I want per share that I own over time. Now, if I think Bitcoin is going to $1 million, I can crunch the math, and obviously the math works out well for me. I've only done that every single video on this channel, 400 plus videos of content. If you guys don't believe me, feel free to crunch the numbers yourself. So the warrants are this weird thing where they can be extraordinarily powerful, but at the same time, yes, the market does need to absorb that new share issuance. But if conviction in Bitcoin is your long-term thesis and you have more Bitcoin exposure per share, that's kind of the name of the game, isn't it? I'm not in this for a cool 2-month flip trade, and I'm not going to cry over spilt milk if the MNAV collapses from a 1.7 to a 1.2 and I have the time horizon of an ant. Bitcoin is the foundational monetary architecture of the new breakaway civilization, and that's why I'm buying Metaplanet and probably Superplanet stock. And this is where the elegance does become dangerous, because the lower the warrant strike, the less capital Superplanet receives for each new share. That means the low strike warrants, they need especially careful timing. Suppose each existing share owns around 4,380 sats. A $3 exercise would bring $3 of new capital into the company for a newly issued share when Bitcoin is is cheap enough, that $3 can purchase more than 4,380 sats. CEBE goes up. If you let Bitcoin rip dramatically higher before the exercise, suddenly that same $3 buys fewer sats. You have to take nuance when you are looking at this warrant package here. It is containing an embedded race between the Bitcoin appreciation and capital deployment. So that's very fascinating, but there is a lot of nuance here. You have to understand the entirety of the capital structure. So do your own research. This isn't financial advice. This is financial entertainment. This is fascinating because Metaplanet, obviously, they want Bitcoin to appreciate because they own a mountain of Bitcoin, 43,000. But the Superplanet shareholders, they also want Bitcoin to appreciate because Superplanet owns Bitcoin. Yet rapid Bitcoin appreciation can reduce the CEBE efficiency of the lower strike warrants that remain unexercised. So those later tranches of warrants could become truly explosive if Superplanet maintains a healthy equity premium and management converts that premium into Bitcoin intelligently. So there is that whole labyrinth of the warrants here. It's complicated. You guys got to game it out with AI. I'm telling you, don't just listen to me. But on top of the warrants, we also have digital credit and preferred stock. What if they come to the punch with daily dividends, and what if they're competing with SATA at a 13%? That's all I'm going to say. Remember, Metaplanet has a controlling stake of this company, so all of the value that accrues to Superplanet, it is under the umbrella of Metaplanet. What do you think this looks like for dividend coverage, for BTC rating? Metaplanet has close to double the Bitcoin that Strive does. Is the market gonna like the safety profile of a daily paying preferred stock issued by Superplanet? Perhaps more than Strive? I don't know. I'm not saying that it will. All I gotta say is that competition is good, and this is really pretty radical. Personally, I think there needs to be more digital credit issuers because Bitcoin is still in its infancy. Bitcoin will be built around for the new financial infrastructure, so I want more players play in this game. Their announcement literally explicitly discusses perpetual preferred stock as a way to raise permanent equity capital without directly increasing the common share count. Now remember, if you are a listener of my content, you understand that if you issue preferred stock that is senior to common, you raise $100 million of a perpetual preferred equity. You take that $100 million, you go buy Bitcoin with it. That doesn't immediately accrue to you, the common stockholder. You have to wait for Bitcoin to go up for it to outpace that fixed claim, that fixed senior claim above you in dollars, and then that value accrues to you, the residual after those senior claims are satisfied. And of course, the market does price that claim with MNAV fluctuations, so it's a complicated thing. But regardless, what's my point here? I want them to issue the preferred stock while Bitcoin is this cheap. I am really happy. I am really hoping that they can get this deal closed on by February. I am really hoping that they can get this deal closed, it's finalized, and they can start issuing prefs as soon as absolute possible because Bitcoin is still really cheap right now. I do not want them to be doing it when Bitcoin is at 90 or 100,000. Now, regardless, even if they did do that, that would still be great. That's bullish because I think Bitcoin is going to $1 million. But as a holder of Metaplanet stock, I would want them to issue preps while Bitcoin is cheap because that will increase the convexity, increase the returns of the common stock. You want to add amplification when Bitcoin is cheap. But it's really cool to see Metaplanet wanting to issue digital credit in the United States. Competition is good. Now, what's really cool is that Metaplanet now has something that Strive doesn't have, and they have something that Strategy doesn't have. They are the first global Bitcoin treasury company. And yes, Strategy did issue Stream on a Luxembourg stock exchange, but that's really low liquidity. That's not as big of a deal as this. Not even close. Metaplanet now has US capital markets access as soon as this thing is finalized, and they're also running the Bitcoin treasury strategy in the capital market that probably needs it the most with the decaying Japanese yen, with the canary in the coal mine of the fiat system, the Japanese government, the Bank of Japan. Good heavens, what a disaster. The Japanese populace needs Metaplanet right now. And when you really look at the big picture of Metaplanet building out that new emerging Bitcoinized infrastructure in the capital market that needs it the most, and they have access to the US capital markets, how is this not the most bullish story in Bitcoin treasury companies today. America possesses the deepest capital markets in the world. You have preferred investors, institutional equity, convertible securities, warrants, credit, retail meme stock speculation, ETF infrastructure. Metaplanet is now playing the US game, children. And this is why I think focusing on that small 2100 Bitcoin as some exclusive part of the story, it's missing the forest for the trees, kids. The 2100 Bitcoin is the seed crystal. The real product is going to be the capital formation around that seed crystal. And with that low of a starting point, that small of a float, this thing is going to be convex as hell, the volatility is going to be insane, and the architecture itself is quite fascinating. So this is the takeaway. A Japanese Bitcoin treasury company has effectively taken control of an American gaming media company, filled it with Bitcoin, renamed it Superplanet, handed itself enough warrants to make a small country finance minister sweat, and then they built the foundation for a second Bitcoin capital markets flywheel because apparently one wasn't enough. There are sober ways to describe this. I have rejected all of them because this situation by now is objectively hilarious. Remember, 16 years ago, Bitcoin started off as a 9-page white paper sent to a cryptography mailing list. And now 16 years later, Japanese corporations are acquiring NASDAQ gaming companies so they can issue perpetual preferred securities and warrants against an institutional multinational Bitcoin treasury company. Satoshi wanted peer-to-peer electronic cash, but capital markets have responded. The best I can do is a cross-border, dual-listed leveraged Bitcoin accumulation Voltron with 391 million warrants. Checkmate. And somehow I love it. I'm giga bullish on Metaplanet. How can you not be? I will be covering Superplanet because obviously this is a huge story. There's a lot to wrap my head around, but it's going to be very fun. I think it's going to be a very volatile common stock equity. My heavens, it's going to be a lot of unpacking, but I'm very excited for it. Metaplanet is the mothership, and now they have an underling that can likely acquire Bitcoin with digital credit issuance in the US. Like, obviously, this is complicating things, but good heavens, how can you not be bullish on Metaplanet, kids? My name is Adam Livingston. I am the Bitcoin Wizard. Thank you so much for tuning into today's transmission of the Orange Gospel. If you could do me a huge favor, like the video, subscribe to the channel on YouTube. That way you can support my mission of spreading the Orange Gospel of Bitcoin to the masses. Have a terrific day, everybody. Do not party too hard, my dearest little goblin rats. Class dismissed. If your business partner, spouse, or whoever controls the money isn't quite as bullish on Bitcoin or MSTR as you are because you have seen the math, that is okay. My friends at Sovana have you covered. Tell your board, your wife, your husband, whoever. With Sovana, you can now buy Bitcoin or MSTR with full principal protection. That is right. Discussion over. Time to buy Bitcoin and MSTR because the worst case scenario is your investment stays flat, while the best case scenario is the bullish moon math and asymmetric upside we all know is possible. Scan the QR code on the screen or go to sovana.io/capital to learn more. The Sovana team will be happy to answer your questions and walk you through how it works from start to finish. Win the debate once and for all by removing the downside completely. Thanks to Sovana, you can now buy Bitcoin and MSTR with full principal protection. And you know how excited I get about Bitcoin treasury companies and the insane levels of institutional adoption of Bitcoin that we are seeing. But don't lose sight of the fact that the most important strategic reserve is your own Bitcoin in 100% self-custody with zero counterparty risk. This is the revolution. My friends at the Bitcoin Way will train you to be your own bank using the best open source tools. They will turn you into a node runner. They will make you a sovereign Bitcoiner. Go to thebitcoinway.com/Adam to schedule a free introductory call and get started today. Do not delay. Your freedom from the fiat system depends on it.
If you understand why gold is good, that's why you would want to be in Bitcoin.
Is it that the governments always just want inflation because they want to just keep stealing from you and pay for wars, or is it now baked into the system and then that's what makes it certain?
I think you can kill inflation. Theoretically, it's possible. Politically, impossible.
it might make sense, instead of paying off my 30-year mortgage early, I'm buying Bitcoin instead, and thereby performing a speculative attack on the currency. A lot of Bitcoiners are against debt, though.
At a certain point, governments will turn around and say, you can't borrow to buy Bitcoin. If you hold Bitcoin, you can't borrow. You can't have everybody win at the casino. If everybody wins at the casino goes out of business.
It's a trade-off. It's a trade-off, right?
And it's a bad trade-off. We don't have to go to the world where everybody's using their own node on-chain for all transactions in order for us to kill inflation. And that's what matters for me.
A lot of people today make it seem like Bitcoin is the end, but is Bitcoin just one of the means to the end? All right, Saif, first thing, good to see you. Thanks for joining me for this conversation. I'm excited to have it.
My pleasure. Thank you for having me.
There are millions of people who have read your books. Of course, myself, one of them. Michael Saylor, famously, of course, one of them. And there's millions of people that are investing who did what they were seemingly told to do with their money. Worked hard, saved money, bought a house, invested in stocks, the retirement account, all of those things. But somehow they still feel like they're falling behind, and they don't understand why. So give us an understanding of what's going on with their money that's causing them to look like they're winning, but they're not.
Yeah, I think the basic problem ultimately comes down to the fact that fiat money just loses value over time. You're constantly declining in the purchasing power, and so you are essentially having to run to stay where you are. You're running on a treadmill and you're wondering why you're not getting anywhere, because it's a treadmill. It's taking you backward. So if you just hold on to money, that money loses its value, probably something like 7% in terms of the devaluation. If you think of it in terms of the increase in the supply, which I think is the best way of thinking of it, because the supply is increasing, and so the purchasing power is being diluted. Now, granted, the increase in the supply of economic goods and services is itself going to make these goods more valuable, and it's going to increase the purchasing power of your money. Sorry, it's going to make the goods less valuable and make your money more valuable. But that then just means that that's going to reduce the amount of value that is being taken away from your money, but it's still money that's being taken away from you. And so the way out of that is to find a way to run faster than the treadmill. And that just makes life so much harder for everybody. It's you're not supposed to be going through life with a treadmill underneath you that makes it harder for you to get anywhere. It's like you're running on an escalator or on a travelator, whatever they call it, all through your life.
Yeah.
But, you know, in a world in which we have good money, money that's not made to rob you, money that is not designed to make you poor, in that kind of world, you'll see that we are having, you're just able to maintain the purchasing power that you obtain by just holding the money. You don't need to be a hedge fund manager in order to increase your wealth over time. You just hold on to your money and it increases in value over time. And that's normal and natural because money is selected in the market precisely for being the thing that loses value the least or gains value over time, because it is the thing that increases the least in supply. Historically, gold is money precisely because it increases in supply the least of all commodities. So you hold on to gold, the supply of gold increases at the lowest rate, but the supply of apples and oranges and cars and houses and all the things that you want goes up faster than gold. So the purchasing power of gold goes up. And that means that you just need to hold on to the gold and you can transfer the purchasing power into the future and get a little bit of a bonus for your delaying gratification. But when the money is made to rob you, when the money is constantly losing value, well, then you're in a different situation. And now it becomes much harder for you to beat that. It becomes much harder for you to keep the value of the money that you've already earned. That's why I like to think that with fiat, you have to earn your money twice. So you could go out there, work a real job as a doctor, an engineer, an athlete, a musician, whatever it is, and you've earned the money and you're trying to focus on your craft, you're trying to get better at it, but you need to be a part-time hedge fund manager. You need to figure out what to do with your money on the side in order to make sure that you can keep the wealth that you've already earned.
Yeah, and I mean, you can't do both of those very well. So now you're doing both of them pretty poorly, which is a massive brain drain on the world. Imagine how much more, how much better technology we could have, or more breakthroughs in medicine, et cetera. But I think what you're saying is that don't save in dollars, and I think at this point most people probably get that. Like most people know, as to the point that you're making, you have to be this hedge fund manager on the side. And so I don't have time. So let me just use the Wall Street Industrial Complex to be my hedge fund manager, and they can siphon off the majority of the rewards for me. So I think at this point, most people know, like, don't save in dollars. I think Saylor, there was like that meme that he said, we have a word for them. We call them poor, I think he said. But so people don't know that. So then it becomes then, okay, then what do I put my money into to hold that purchasing power for me? So then is it sort of like, then we have to look for the next best thing? And so then is it gold? So you mentioned gold's been that store of value for all time. Of course, obviously Bitcoin, you wrote the Bitcoin standard. So is it then we need to find something that then holds that purchasing power, but it's really all about a means to a potential end and not the end itself? Meaning a lot of people today make it seem like Bitcoin is the end, but is Bitcoin just one of the means to the end?
Yeah, I mean, money is a medium of exchange. The whole point of money is that you exchange it for other things. That's why everybody wants money, because of the things that you can exchange the money for. But the point is that you want your money to be good at this job of exchanging, and in order to be good at it, it has to hold on to its value over time. And the problem is that wherever else you take your wealth away from the money, it's still going to suffer from the same problem that the money has, which is that there's going to be somebody out there who's going to figure out a way to make more of it. So historically, people move away from gold, and then the next thing they get into was the saving account. Well, you put your money into the saving account, you beat inflation because the interest rate that you get is higher than the inflation. But that stopped working because, well, you know, the whole point of inflation is to finance government. So if everybody can beat inflation, that defeats the purpose. You can't have everybody beat the inflation game, just like you can't have everybody win at the casino. If everybody wins at the casino goes out of business. They can't keep running it as a charity. And I guess that's a good way of thinking about your central bank. It's not out there to make you rich. It has to, the purpose is to take your purchasing power and give it to the government so that the government can murder foreigners and enrich cronies and do all kinds of crazy things that they do.
Yeah.
So if everybody finds a way out of this, if everybody can beat it, then whatever it is that they beat, whatever it is that they used to beat, that is going to be provided in an increased quantity eventually until it stops working. So that happens with savings accounts. Interest rates then go down on saving accounts, and then you can't beat inflation anymore. So then people move to government bonds, and that also same thing happens. People move to government bonds, and it's like moving into an easy money. It's like people moving into copper or moving into something that's easy to make. If everybody tomorrow decides that they wanted to use copper as money, it's just going to mean that copper miners are going to make enormous quantities of copper and dump them on the market and bring the price of copper down. And the same thing happens to the government bonds. When everybody uses government bonds to save, that gives governments far more credit than their fiscal and monetary situation should entitle them to get. And then that, of course, is the mother of all malinvestments. The governments end up spending tons of money on all kinds of stupid and crazy and criminal things. And they eventually, one way or the other, they're going to destroy the value of the wealth that's stored in the bonds, either because the value of the money in which they repay the bonds goes down, or because they default, or both. So it stops working with government bonds. And, now we're in a kind of golden period for stocks, particularly stock indices. They seem to be working fine as a way out of this. But that one, too, I would say is kind of risky, because if everybody in the world can just buy Apple and Nvidia stock or buy the NASDAQ or an S&P, then again, that's going to mean that the inflation game doesn't work. And how do you keep the thing going? So at some point, I think there may be a crash in the market, because monetary policy can't continue to be accommodating, because if it continues to be accommodating, it just leads to more and more bubbles, and it leads to more and more inflation to essentially beat these, more and more inflation to finance government and to allow government to finance itself. So I think what you want is something that cannot be inflated, whose supply cannot be increased. And that just gives us two candidates, really, realistically: gold and Bitcoin. And gold has a supply that grows roughly at around 1.5 to 2% per year, and has always been like that just because of the chemistry of gold. Gold doesn't ruin, so we're constantly accumulating all of our gold supply over the years and decades. And that then results in the fact that even as we get better at making gold, we're just piling onto an ever increasing pile. And so our production goes up every year because we get better, roughly. A little, more or less it goes up every year. And the stockpiles that we have are also growing. So the rate of the new production to the existing stockpiles, or the stock to flow ratio, the rate of production stays constant, or the stock to flow ratio also stays constant. So, but it stays around 1.5 to 2%. And I think the problem with gold is that ultimately the world has already got a lot of gold. And so everybody, well, not everybody, but I mean, there's about $25-30 trillion of gold held around the world by people in the form of jewelry or in the form of monetary gold. And that just means that it's already highly monetized, but it can't truly function as a form of money because it doesn't have a banking system. And in a modern world, you need money to travel quickly. You need to be able to spend your money as fast as your goods travel. And so this became a problem for gold in the 19th century because of trains and ships and cars moving things around quickly. And it meant you couldn't just keep moving gold back and forth between partners. So you had to rely on bank credit, and bank credit effectively became the money. And that led to the growth of the banking malinvestment boom of the last century and the central banking malinvestment boom of the last century. But Bitcoin really is the solution as far as I'm concerned, and I continue to stick to it, no matter what happens and after every crash. I still think Bitcoin is the one that really delivers on this because Bitcoin, A, has a lower supply growth rate than gold, so it grows at a lower rate than gold supply. And two, which might even be more important, you can actually have clearance of Bitcoin internationally very quickly without having to go through government institutions and without having to go through highly centralized central banks. And so Bitcoin is far faster than gold. And therefore you can continue to have a free market and you can continue to use gold as money, even as its value grows and even as the demand for it grows. You still don't need to have one central bank to manage all the clearance, as was the case with gold.
Hey, look, over 130 million in Bitcoin was just stolen from cold card hardware wallets. This is the largest hardware wallet hack in history. And the sad part about this is that the victims, they did everything right. They had real devices, they kept it all offline, but there was a small firmware update that let hackers access their Bitcoin wallets and completely drain them. Now, don't blame self-custody. Self-custody isn't a problem. It's single key custody. That's the problem, when you have a single point of failure. So here's what I actually do. I've been doing this for years because I was always afraid something like this could happen. Now, this happened before Unchained ever sponsored me. I was a customer, and it's my Bitcoin, it's my parents, it's my sister, my family's Bitcoin, and it all sits in what we call multi-sig wallets. And I do that with Unchained Capital. Instead of one wallet and having one key, there's 3 keys on 3 different devices, 3 different places from 3 different companies, okay? I hold 2 in different locations, Unchained holds 1, and it takes 2 of those wallets to move anything, which means like this exact hack right now that got everybody drained, 1 compromised key won't be enough. It probably sounds complicated. Don't worry. Unchained has a concierge service where they can walk you through the entire thing one-on-one, and they're going to build out your vault. They'll test your recovery. They'll have an expert review everything, making sure you don't have any problems. If you want to do the same thing I do, the same thing I have my family do, go to unchained.com/MarkMoss. Again, unchained.com/MarkMoss. Set it up right. Do it once. Don't get vulnerable to a hack like this. Wow, you gave us a lot. You gave us a lot to dig into. So there's a bunch of questions that we have. That's a good thesis. I want to double click into quite a few of these things. So number one, I want to get into, you said that governments need the inflation to continue to pay for all the things that they're doing, the cronyism and the wars, et cetera. I want to talk about that. what's actually baked into that. You mentioned the bonds being part of that, liquidation of government debt. We'll talk about that. You talked about how gold and Bitcoin can't really be increased, and you talked about the stock to flow of gold. I want to get into that, especially in the world of abundant money printing, but also abundance of AI. Bitcoin being a better medium of exchange than gold, the SOV versus MOE. And then I want to talk about Bitcoin delivering on some of these things that you're talking about in light of what's happening today with hacks on self-custody, and then Wall Street financialization. So let's talk about a couple of those things. Let's start with at the top. So you had talked about, the governments won't allow inflation to stop because they want to continue to pay for the cronyism that they have and the wars they have and things like that. And certainly I agree with that in one instance, but I want to ask from a different angle because, I like to say that the two things in life that are certain, well, the saying goes that death and taxes are certain. And I say money printing is also certain at this point too, so there's like a third thing. I think of it more from like a function of the debt-based monetary system that always has to grow, because in a debt-based monetary system, money is created through debt issuance, and then the debt becomes the collateral for more debt. And so then it kind of creates this Ponzi scheme where like it has to continue to grow. So is it that the governments always just want inflation because they want to just keep stealing from you and pay for wars? Or is it now baked into the system and it's a function of the system, and then that's what makes it certain? So if we got good leaders that don't want to cause wars anymore, does it end? Or again, is it baked into the system that it always has to continue to inflate like that?
I think it's just the way that democracy works makes it inevitable almost that you're going to have to get a bad leader. Because if you have two people competing against each other in an election and one of them says, I'm going to run the money printer. Well, he's not going to say he's going to run the money printer, but he's going to say, I'm going to deliver all kinds of
promise
things.
You all this free stuff. Yeah.
Yeah. I'm going to give you, pink unicorns for all the girls and Superman powers for all the boys and free hospitals and all kinds of nice things. You're going to beat the opposition that says, no, I'm sorry, I can't give you unicorns for all the girls and Superman powers for all the boys. I don't do that. So it's just baked into the system that you are going to have to make ridiculous promises in order to win. And if you don't make your ridiculous promises, you don't win. And if you want to win, you have to make the promises and you have to live up to them. And so it's just... once you place the ability to create money in the hands of government, Mises used to say this, is just they cannot resist the temptation. It will be used. That temptation will be acted upon because it's providing so much benefit to the people in power, and the cost is so spread out over such a long-term horizon. Effectively, in a democracy, you're in power for 4 years. And during those 4 years, you can do all kinds of amazing things for you and for your family and for your, tribe, clan, cronies, whatever it is. You can get them all kinds of things by externalizing the costs onto generations of people that are going to have to be paying off the debt and the consequences of the inflation over decades. Yeah. So democracy is really just ideally suited for this system. And I think the few places where you see governments that can, up to a point, resist that temptation is places where they don't have a money printer. So I think part of the reason that maybe El Salvador is successful is that they've gotten rid of the money printer. They don't have a money printer. And so they have not had inflation since, I think it was 2001 when they went off that. There's not been a government in El Salvador that has been able to run the money printer effectively. I mean, of course, they can borrow and they can do all kinds of other things, but not having the ability to create money massively hamstrings their ability to fund the present at the expense of the future. And I think also monarchies can be better at resisting this. And if you look historically, you'll find that monarchies do a generally better job of maintaining the value of their currencies, because monarchies are far more long-termist in their approach. So as a king, you're not just in power for 4 years and then you are going to be out of power, and you're not thinking about how much can I maximize? How can I maximize the amount of input that I get in those 4 years in order to be able to finance myself over those 4 years at the expense of society? because you're thinking, I'm going to be in power for the rest of my life, and then my child, and then their child, and their child, and their child, hopefully for centuries. So you don't want to milk the country dry over 4 years. You want to keep the country healthy so that you and your descendants can milk it for centuries from now.
Yeah.
And that, I think, ends up being better for the people, because it provides people with essentially a government that is incentive aligned, that has incentives aligned with them, because the people the people want their children to be prosperous 100 years from now, and their descendants. And the king also wants your children to be prosperous 100 years from now, because he's planning on taking money from you in 100 years from now. He wants his descendants to be taxing your descendants. So you take care of it. It's a caretaker government that has a long-term vision, whereas in the democratic system, in political science they call it the roving bandit versus the stationary bandit. If you're a stationary bandit, you have a long-term relationship with the people that you're farming effectively. And so you want them to be prosperous. You want the cows to get fat so you can get a lot of milk and beef out of them. Whereas if you're a roving bandit, you're just passing by a farm at some point and you are raping and pillaging as quickly as you can, because you're going to move on to something else. And you don't care about what this one particular farm is going to look like in decades or centuries.
I mean, certainly the way you break that down and set in the incentives are completely different. And as Munger would say, and the incentives equal the outcome, right? So it makes sense. I would agree with you on the Democratic side. And unfortunately, when the voting populace, the majority of them can now vote to take money from the top. I mean, then we have this disincentive, as we said. And then you said, the politicians come in to offer more free things to the voting populace, and we continue to go down that route. I would just say quickly on the, whatever you want to call it, monarchy, but autocratic, dictatorship, whatever. I mean, plenty of more recent case studies in Africa and Middle East of that not being the case, where the people have enriched themselves to billions and billions and billions of dollars, while most of the people in the country are poor. But let's just stick back to and those aren't, to your point, those aren't necessarily monarchies, but I do agree with you on the Democratic side. And so we have these problems in the developed world in the United States. But let me just ask the question again. If we could, and I agree we can't, but if we could get leaders who don't come in offering these things, is it, from an economic standpoint, is it this debt-based system? Have we built up so much leverage in the system? Has that debt continued to become more collateral, where that has to continue mechanically, regardless of politics? Or are you saying, no, it's 100% choice?
I mean, ultimately it is political. If you made me king of the world and I was perfectly long-term focused and I really, really cared and I was incorruptible, and I'm saying it's a big if, I'm not claiming to be all of those things, but if you got a radical Austrian hard money guy like me, and I was not tempted by power, and I was not tempted by money, and I was not tempted by the political process, I think you can kill inflation. Theoretically, you can do it. And I think the notion that the system needs to continue to produce more debt is, it's a little bit like the alcoholic who tells me, no, you don't understand. I really need to take this drink right now because withdrawal will kill me. Yeah, well, of course, because you drank yesterday and you drank the day before and you drink every day. But, if you choose to snap out of it, you can snap out of it and you can stop. And yeah, it might suck a little bit, but then eventually you can just stop it. And so, you can just turn basically all the credit money out there, turn it into physical money. And I think that's the sort of simple way of doing it. Friedrich Hayek proposed something like this in the 1930s, which is take all of the money that is outstanding out there, which is essentially mostly credit obligations. So if you look at the money supply, it's just the majority of money is debt. Only some of the money is physical form. But figure out what the total money supply is in terms of debt, and then print physical papers that match the entire supply of the money, and then break the printer. And then, look at the money supply today. What is it today? I think it's about 22 trillion M2 or whatever it is. And then just literally print 22 trillion, not in the figurative sense, but actually $22 trillion in the physical sense, and then give them to all the people that are holding all of that money. And then they have that money, and then just say, no more central bank, no more money printing. And if you want to try things like fractional reserve banking, you're on your own. You've got all of the dollars that you've produced so far as a bank, because when you're a bank, you're producing dollars every time you engage in lending. So you've got all the dollars that you produced under an inflationary monetary system, under an inflationary central bank. You've gotten them in physical form, and this isn't going to be inflationary because these dollars already exist.
Right.
And now, if you're going to try and you just converted them from digital dollars into physical dollars. But now, if you're going to be trying to engage in credit creation without physical dollars backing them, then you are going to end up one day with a liquidity crisis and without a central bank to bail you out, because there's no more money printing. There are no printers. We broke the printers. Then you're going to run out of money, and eventually the money supply will contract and go back to the supply of the physical money that is there. So theoretically, it's possible. Politically, impossible.
Yeah. I never actually heard it walked through like that before, because I always think about like the transition. Like, okay, I mean, that's a perfect world, but like, how do you get from here to there? And like, how much pain is caused for getting from there? But I think sort of what you proposed, like I said, I never really heard it walk through like that. It sort of creates that buffer where it's like, okay, no, let's not crash anything. Here we are, but we're frozen in time now. And now let's see what we can do from here. But to your point, yeah, good job politically. Unfortunately, humans only act when there's enough pain, right? I believe in the chiropractor, but man, like I probably don't go unless I'm like, and my back's really hurting, for example, right? Now, when you talk about it like that, and you talked about the difference of gold and Bitcoin. By the way, you have the new book. I haven't read it yet. The Gold Standard. Go ahead and hold that up. We'll talk about that. But what I think was so amazing about the Bitcoin standard is you started with gold. I mean, and actually you went back even before gold, right? And so you really talked about what money is, all the different forms of money that we've had, leading into the gold standard, and then of course the gold standard to the Bitcoin standard. The gold standard, you talked about gold also being a good medium exchange. So let's talk about that for a minute, because as I was telling you before we started recording, every year I go speak at one of the largest gold conferences in North America. It's been like 5 years in a row. And every year I keep saying, if you would have listened to me a year ago, this year they had the last laugh. It was in January. And of course, gold was, I forget where it was at that point, but $5,000. Bitcoin, of course, is drawn down quite a bit. And so the gold people have their last laugh there. Talk us about
not the last laugh. There's still going to be a lot more laughing to come.
Certainly not the last. Certainly not the last. They had the laugh at the event.
The
latest, yeah. And of course, I pull out a chart and go, well, hang on. And actually, let me ask you this question, because the chart that I pulled up for them at the gold conference, it's doomers. It's all doomers. Everyone there, they're selling gold because the dollar's going to die, the system's going to crash, we're going to go back to this barter system, and you better have gold. And like that's the whole sales pitch on gold, where I think Bitcoin has a hopeful future, and it works with AI, and it works with AI agents, and like the world doesn't have to die for Bitcoin to succeed. And I think that's a big piece, and you can comment on that. But back to the point that I made, I said, so your whole thing is that inflation is going to rage, the dollar is going to die, and gold's going to protect you. Then how come from 2020 to 2024, and I showed the chart, when we had record inflation and record money printing, gold went nowhere for 4 years? And I showed the chart, right? And then 2024, the gold price started taking off after inflation's already come back down. I mean, what would you say to that? And we can get into the gold standard. Hey, do you know that instead of sending your tax money to the IRS, you could buy Bitcoin miners with it instead? Here's exactly how I do it. You see, mining hardware is 5-year property. And under bonus depreciation, which was dying, it was down to about 40% last year, and it was going to zero. The One Big Beautiful bill has reinstalled it back to 100% and made it permanent. So I can deduct the full cost of the machines in year one. Now look, billionaires have run this play for over 40 years. They do it with real estate, oil and gas, rail cars, and it's the same provision in the code, but the only difference is what you own when it's done. So you see, I own the machines that produce the Bitcoin, but I don't have to do the work. Blockware does all that. Blockware sources the hardware, they secure the power, they run the sites, and my tax team, they structure it so the deduction actually works. You see, that's how I turn my taxes into Bitcoin. So if you want to try and do the same thing, check out Blockware today. To get started, just go to blockwaresolutions.com/market disruptors. Again, blockwaresolutions.com/market disruptors.
Yeah, and I think that's a great point. I think, it's interesting, for many years, decades now, gold bugs have been talking about
5,000 gold, $5,000 gold. We're going to get $5,000 gold. And when that happens, the whole world will be in a Mad Max situation, as they keep calling it. You know, you need to stock up on golden bullets, and you need to stock up on canned foods because the dollar's going to fall apart. Everything's going to fall apart. And here we are with $5,000 on gold, and it seems to be as consequential as the price of copper or nickel going up. It's just another commodity, and its price has gone up. It has not brought about the monetary apocalypse that they have been fantasizing about for decades now. And I think that is quite telling. And it's very interesting because really, if you look at it, yeah, the gold's performed really well over the last couple of years. But, you know, this is when gold bugs start sounding like shitcoiners looking at the short range charts.
Yeah.
Let's drag out the chart and zoom out and be big boys who are able to think in the long term. And in the long term, gold has basically barely kept up with inflation since 1971, since the world went off the gold standard. Gold's recent run has basically brought it back to keep up with the rate of growth in the money supply over the past 50, 55 years or so. So it went up in the 1970s, and then it had a bear market from 1980 to about 2000 and bottomed around 2000. And then it went up from 2000 to 2011 and then had a bull market of 10 years and then another bear market of 10 years, 10, 12 years. Or it was basically from 2011 to 2023, I think, until it reclaimed, or 2022, something like that. So really, it's barely caught up. And as an asset to hold, it's entirely reliant on when you bought. So you may have gotten lucky and bought in 2000 and started saving in gold in 2000. Then it worked out up until 2010. And then it sucked up until 2020, 2023 or so, and then made up for it in 2024. So it's a little bit like a shitcoin pump and dump in that it's not really going up reliably, and you need to be able to time it, and you need to be able to, understand how the dev team is working and all of that. But I think this is really the issue, that ultimately, as long as people cannot use gold as money, except with people that are within arm's reach, then you are just going to have a bad time trying to make this into the world's money. It's just not going to work as the world's money. This is the way that I see it, because people are going to stack up more gold. People will stock up more gold. They will buy more gold. But when they need money, they need to sell the gold and acquire money, because you're not dealing with gold day to day. And the fees on going in and out of gold are enormous, and you have to pay capital gains tax on gold. And if you want to pay gold to somebody abroad, you can't do it. There are no gold banks. It's illegal to set up a bank that runs on gold. And governments have done this since 1971, and the IMF ensures that you do that. So gold's monetary role is essentially neutered by governments. And
it's a store of value only, right? It can only be used as a store of value, you're saying?
Exactly. And so therefore, you have to buy in and out of it every time, and there are fees and there are conversions, and this is just essentially kills its liquidity, kills its ability to be saleable. Its saleability is very low effectively. So you have to buy in and out for it. So it still has the fact that the supply doesn't grow much, but it can't be used as money, and it has the other it has the other major drawdown, which is that the supply is already enormous and the market capitalization is already enormous. People already have tons of gold. People already have literally thousands of tons of gold, and people already have trillions of dollars worth of gold in their pockets. And they can't have much more because they can't really easily hold large balances in gold, because they need to continuously go in and out of gold.
Yeah.
And this is where I think the difference is with Bitcoin. And this is why I would say the Bitcoiner vision is more positive about this than the gold bug vision, because the Bitcoiner vision is powered by number go up. We've got number go up technology that means it's first of all, it's attractive for you as an individual because it's got so much more room for growth. First, because again, you can use it as money because it travels very quickly and you don't have to rely on banks and central banks and government institutions in order for you to use it as money. But secondly, it's only about $1.5 trillion currently in market capitalization, or $1.2 trillion. So it's less than 5% of gold's market capitalization. And so it's got a long way to run, even if it becomes just half of gold, which I think I don't see as reasonable. I think it's a better money than gold objectively. But even if it becomes half of gold, that's still another 10x from here. There's still enough appreciation for it to go up 10%. So even if your case for thinking about Bitcoin is that it's half as good as gold and it's going to become half the money that gold is, that's still a 10x from here. It's not easy to imagine a 10x with gold. If there's a 10x in gold, that means we have to have the entire world run on a gold-based monetary system.
Or the money supply has to go up by 10x.
Yeah, well, when I say 10x, I mean in terms of purchasing power, not in terms of the dollar price. But in terms of purchasing power, if gold's purchasing power is going to go up 10x, it's going to have to eat all of the government currencies, all of government bonds, basically.
Yeah.
And that's just not going to easily happen because the governments are not going to let you use their banks. They're not going to let you use banks that use gold because they want to milk you with inflation. Whereas with Bitcoin, it can go up 10x and still be half of gold. So there's an incentive for people to buy in. And I think, as you said, in the Bitcoin Standard, I talk a lot about gold, and a lot of gold bugs love the book because it makes a very good case for gold. A lot of them tell me this is a case that is better than what the gold bugs make. And really, you listen to some of the gold bugs, they talk about it being shiny and about the nice noise that it makes when it falls on the ground. And I think, excuse the humble brag, but I think my case for gold is a lot more compelling because it's mathematical, historical, and still, I end the book by being essentially bearish gold and saying, if you understand why gold is good, that's why you would want to be in Bitcoin. And I think to go back to the point on why gold is different, I discussed this in the fiat standard, and this I think is something that not a lot of people talk about in terms of Bitcoin and how Bitcoin can continue to grow as money, which is that with gold, there's not much room for the value of gold to go up. So this means that as individuals, there's just not that much of an incentive to hold large balances in gold because you don't expect it to go up as much. But also, it means that it can't really replace the current existing fiat system effectively because it's already very big. Whereas with Bitcoin, essentially Bitcoin can continue to grow and it's monetizing as a hard asset. And the fact that it continues to grow essentially offers people a way out of the collapse of fiat and the decline in the value of fiat and the constant cycles of business, of boom and bust that fiat has. So essentially, as fiat continues to devalue, you could say that the fiat economy becomes less and less important. And in a world in which we only have fiat, that's a problem because you're constantly devaluing the fiat. But in a world in which we have in a world in which we have Bitcoin, well, people start building cash balances in Bitcoin and these go up. And so as your fiat assets are declining, your Bitcoin assets are going up. But more importantly, most people don't have fiat assets. Most people don't hold fiat money. They hold fiat debt.
Right.
And as fiat gets devalued, the debt is essentially devalued. And so the debt is wiped out. And so really, it offers us a way out of this that is hopeful rather than the gold doomer scenario where all the governments are going to fall apart, all the banks are going to fall apart, we're all going to be scrapping over canned food, and then we'll have to rebuild civilization from scratch with a gold basis. Well, with Bitcoin, we don't have to do that. We're just building it as an alternative system, and we are going to continue to grow as the alternative system continues to become less and less. The Bitcoin system continues to become more and more valuable while the fiat system becomes less and less valuable and then shrinks into irrelevance without it having to collapse.
So let's talk about that transition. So you have the opportunity, Bitcoin's going to continue to grow. It's small. You can move into it today. You can exit the fiat system. But you talked about fiat debt. Most people aren't holding fiat assets; they're holding fiat debt. And we talked earlier that the governments, for whatever reason, the debt-based monetary system, but more probably politically, will continue to increase the money supply. And when you think about, you also said that they can't, they have to have inflation because they want to pay for all their things. The IMF and the BIS put out white papers in 2015 called The Liquidation of Government Debt, where basically they do financial repression. So the amount they pay on the debt has to be less than the rate of inflation so they can liquidate that debt. And so I think about it like in this like macro loop where the governments are going to continue to run bigger and bigger deficits, which means they need more and more debt. In order to afford more and more debt, they have to push rates lower and lower and lower. Inflation is destroying that debt, right? So if I take a 30-year mortgage, in America we get those things. Warren Buffett calls them the best financial engineering piece that the government has given us. But my payment on a 30-year mortgage in 30 years from now is a fraction of what it would be today, right? So the inflation is destroying the debt, which the government likes their debt being destroyed, right? So if they need more deficit spending to pay for their programs that they promised their voters, that means they have to take on more debt. They have to artificially push the rates down low to afford the debt. And then we have Bitcoin growing inside of there. So then it might make sense, instead of paying off my 30-year mortgage early, I'm buying Bitcoin instead and thereby performing a speculative attack on the currency. So I could borrow in the cheap dollars that the government gives us, knowing that they're going to continue to destroy the value of those dollars through inflation and keep rates low because they need them low, and then go into a stronger currency like Bitcoin and go up. It seems so simple. Obviously, there's volatility through that process. I see you sort of nod your head like, yeah, that makes sense. We know like Hugo Stinnes in Germany did that in Weimar Republic, and of course it's been done a million times since. And it seems to be the strategy that, I guess, strategy is deploying. So you shake your head sort of in agreement. What do you think about that strategy just generally overall, using cheap debt that's guaranteed to be destroyed through inflation, locked at lower rates than inflation will be or debasement will be, and being able to get into a life raft like Bitcoin to go back up? A lot of Bitcoiners are against debt, though.
Yeah, well, I mean, it is essentially accelerating the process that I'm talking about. In a sense, it is accelerating it because it is devaluing the dollar more, because the more debt you take on, the more dollars are created, and therefore the dollar is devalued, and then you use that debt to buy Bitcoin, you're bidding up Bitcoin, and you're increasing the market value of Bitcoin. And this is what Michael Saylor is doing. This is what a lot of Bitcoiners are doing. But it's not guaranteed that this kind of scenario will continue. It may well be the case that at a certain point, governments will turn around and say, if you're taking out debt, you can't hold Bitcoin. Or if you're holding Bitcoin, you can't take on debt, or you can't buy Bitcoin with debt. So this is a relatively straightforward thing to do, because debt creation is all linked to central banks and it's highly regulated. You can't just go out there and create dollars and hand them out to people. So you could get, instead of a 6102 that confiscates people's Bitcoin, you just get a law that says you can't borrow to buy Bitcoin. If you hold Bitcoin, you can't borrow. And if you borrow, you can't hold Bitcoin. So that could slow it down. But I think ultimately the process just continues. They're going to continue to make more dollars. They're not going to make more Bitcoin. Nobody's going to make more Bitcoin. And so the mathematical inevitability is that the dollars are going to devalue and the dollar debt is going to devalue. And I think this is really the winning move here, is to just, as you said, you want to be on the side of the people that are in power, because they are rigging the system to their advantage. And, it's a common misconception to think that rich people have a lot of money. Rich people don't have a lot of money. They have a lot of debt. They have hard assets and debt. So, if you're a billionaire, you don't have $1 billion sitting in a bank account, and you don't have $1 billion sitting in your basement. You've got maybe $5 million in a bunch of bank accounts here and there, $10 million, something like that, in liquid accounts. And then everything else is hard assets, and you borrow against those hard assets. So the biggest borrowers in the world are governments and big corporations and the richest people in the world. And that system works very well for them, because the system devalues the value of their debt.
Okay, so I got to tell you what I've been doing with my money lately. I moved my cash over to River, and before you ask, yes, I still pay all my bills in dollars. Everything works the same, but here's the real difference. You see, River pays me 3.3% on my cash, and they pay it in Bitcoin. So my money that was just sitting there doing nothing at all in the bank, it's now stacking Bitcoin while I sleep. And I started thinking, like, my bank takes my deposits, they loan those deposits out, they make 12, 17, 24%, and they pay me 0.04%. I mean, honestly, that's kind of a shakedown when you think about it. Now, River's FDIC insured, they use full reserve, they charge no fees. So I don't know why I didn't do this sooner.
So click the link down below and get $100 in Bitcoin just for getting started.
So obviously putting the risk disclaimers on here, everything in life has risk because everything's a trade-off in life. And certainly going and swimming in the ocean where there's waves is dangerous because people drown out there every day when they're visiting from Indiana. But especially when the waves are big. Unfortunately, we just had these amazing waves. I live in Southern California. The waves last couple weeks from hurricanes were really, really big. And everyone travels here to go surf. And then unfortunately, some people drown because they came from Indiana and they don't know how to swim. So it's risky, but you could learn how to swim and you could learn how to surf and you can learn. And the financial markets are also risky. You give your money out, counterparty risk, you may not get it back. And then you add leverage on top of it, it adds more risk. But that being said, back to sort of this financial thing, if the Cantillon, I think about it like this, like in the Bitcoin circles, we talk a lot about the Cantillon effect. And those closest to the money supply have the first advantage, right? And then those at the bottom are disadvantaged because prices have already gone up by the time they get the money. But if we think about it, at the top, they're printing the money and they're buying assets. And where does the money get printed? At the bank, right? The commercial banks print it when they give a loan. So I could also just get the loan and buy hard assets. Why do I have to be the victim at the bottom of the Cantillon effect? Why can't I join them at the top and get the newly created money to buy hard assets like they do?
Because you can't get the low interest rates that they get. They can't get the terms that they get. You can't get the long-term payment facilities. You can't get the. I mean, this is why Michael Saylor can do this, and you and I cannot. We can't.
But I would disagree with that because Michael Saylor's paying 12% on Stretch right now. 12%. I can go into my
now
brokerage.
He is, but he got a lot of his debt at close to 0%.
Right, which has mostly been paid off. Well, he's paying some of it off. There's very minimal debt is at the 0%. Most of it's at the 12%. I could click a button in my brokerage account right now, like while I'm even on a podcast with you, and get 5% loan right now on my loan. Right, so he's paying 12. I can get it at 5. My mortgage is at 3 right now. Rates are about 6. Whatever you want. Either way, it's less than 12, right? So I don't know. And the numbers it's all about the spread anyway. So anyway, I'm just curious.
Yeah, but I mean, for most people, it's not. I mean, the bigger the corporation is, usually the better the all else equal, the lower the interest rates that they could get. And you can get you can do this with your home because you get favorable rates on your home. So that's why it makes sense for most people to get a mortgage. You can do this on, you can get 0% interest on a credit card for 12 months, which really is a way to play mini Michael Saylor for the average Joe.
But that's dangerous with a short duration, yeah.
Yeah, but it is a short duration. That's the thing. The thing that he gets is long durations and low rates. And you may be able to secure that with your mortgage. You may be able to get it with a couple of, I don't know how your brokerage accounts works, but I'm going to guess that overall, Michael Saylor, you have to understand also the numbers are skewed now because he's had a bit of a rough time in the credit markets over the last few months, so he's paying a little bit over the odds. But I would say overall, generally, I think the big corporations can do better than you.
Sure. Of course, I would agree with that. Of course they can, right? They're borrowing much closer to the Fed rate than you and I would have to pay a spread. But it's just the strategy just overall. Like I said, so many Bitcoiners are seemingly really against debt. And I think there's a lot of the Dave Ramsey out there, pay off your debt. Debt is evil. The Bible said you're servant to the lender, et cetera. But in a debt-based system, especially considering back to this strategy of this the government's going to keep liquidating debt. They're going to keep pushing inflation. If we can lock in low debt, we can buy assets. Anyway.
Yeah, well, I mean, I definitely get the moral case for it, and I should say, you know, I'm explaining the rationale for it. I'm not saying you should go out there and borrow, because of course
Right.
there's the downside for it, which is that
course.
you miss a couple of checks, so you lose your collateral.
Yeah.
You are in very big trouble. That's how a lot of people end up being homeless and
Yep.
their lives fall apart. So this is really the truly pernicious aspect of the fiat money system is, you know, first of all, I mentioned earlier, you got to earn your money twice. You can't just save. You have to be a part-time hedge fund manager. But also, if you're not taking on debt, then you're not, you're essentially taxed through inflation. You're losing your wealth through inflation. And if you are taking on debt, you are you are taking a massive risk. And in fact, it's almost a baked in risk. People are going to have to default. They issue so much debt because there's no real money behind it, that the defaults are baked into the system. There will have to be people that will default. There will have to be people that end up on the street. That's the cost of this system. And it's just, it's a Faustian bargain. What do? Do you suffer the inflation slowly while everybody else takes on the debt and dances that dance, or do you take on the debt and end up being part of the small percentage of people that gets wiped out and has their life ruined? And you know, on the moral case for it, I'll say this. Yeah, you know, a lot of religious and moral arguments are made against getting into debt, but you could also make the counter argument, which is that if you live in a modern economy, you're using a currency that's generated from debt. So you are part of the debt system, whether you like it or not. And if you're not taking on debt, you're subsidizing others taking on debt. So you're still playing the game, but you're just guaranteeing that you're losing.
Yeah.
But then again, are you really losing because you don't have the risk of default? You don't have the risk of getting thrown out of your house.
It's a trade-off.
It's
a
really,
trade-off. It's a trade-off, right?
And it's a bad trade-off. And in a hard money system, the trade-off would be very different. The trade-off would be you have your savings, and your savings are appreciating over time. And then that means that, and because you don't have infinite credit creation, you don't have easy money, that means houses aren't being bid up by people all the time. You don't have investors buying into houses with cheap credit, bidding up the price of the house for people to live in them. Hard money buys houses, people save, and the value of their money goes up. So it's easy for them to just buy houses in cash. And so people have their homes, they have their savings, and then if they want to take a risk, they take a risk on an investment where after they've secured their home and their savings. And then if the investment doesn't pan out, you've still got savings and you've still got a home.
Yep.
And in the fiat system, it's just we're fragilizing ourselves by borrowing against all of that stuff and then making ourselves
Sure. I mean, you're you're coming out with college debt before you even start making any money. You're a debt slave from day one, right? So
I know.
All those things are true. I would just say they all require trade-offs, and of course there's risk and there's risk mitigation. I want to jump into one last topic. I know we're getting kind of short on time here. So you made the case about, you know, gold being a good store of value, but not a medium of exchange. And the problem is, since gold isn't money, every time I go in and out of money, it costs me money. And I never actually really thought about it like that. But I mean, that's such a good point, because I was thinking, well, you could have a medium exchange and then you can have a store of value. And we store our value in lots of things, homes, as we're talking about right now, and obviously stocks, equities, we talked about that already. So there's lots of things that we store our value into. I'm remodeling my home right now. I'm renting another home while we're remodeling. And I was like, I kind of like the home I'm renting. I'm like, maybe I'm just going to sell my house and just buy this one. And I actually thought I was going to do it. And then I ran the numbers on the taxes I would have to pay to move my value from one house to another. And I'm like, whoa, there's no way I can do that. Because to your point, to move the store of value, I have to pay for it. And so Bitcoin being a store of value and a medium of exchange, obviously it's more saleable, as you would call it in your book. I see the advantage. In order to do that, then I really then probably need self-custody. So I want to talk about self-custody for a second, or just custody in general. Let's just talk about custody in general. You know, value is created by solving problems. And maybe the oldest problem in the history of the world is, how do I keep my property from being stolen from me? And Bitcoin solved that, right? On a gold standard, what do I do? How do I protect my gold, right? But with Bitcoin, we can protect it very easily. And if I want to be able to send it censorship resistant, I need to have custody to another peer-to-peer person. In the Bitcoin community, we've been rocked over the last week with a massive hack on seemingly one of the best security devices, the Cold Card hardware wallet. So how do you think about self-custody or just custody in general, having someone else custody it or I custody it myself? Strategy as far as, from small denominations to big denominations. And what do you think about just that hack and what it does to the community and the self-custody aspect? Okay, I want to take a second and give you a quick and important word from today's sponsor, which is Rumble Wallet. Now, it's a good reminder that the money in your bank, it's not your money, it's the bank's. They owe it to you, but you don't control it. The bank does. So you have permission to access your money until you don't. Now, if you ask anybody who's ever had an account frozen, I have, you'll find out the hard way. So if you want to hold assets that you can actually own and control, then check out the Rumble Wallet. It's non-custodial, which means that you have the keys to control it. They're yours, not a bank's, not a platform's, they're your keys. So go buy Bitcoin, hold dollar-backed stable coins. You can even have digital gold backed by real gold, and you can have it all in one single wallet that you control. Now, it's pretty quick. The setup takes minutes. You can fund it with a debit card. You can fund it with credit cards, a bank account. Right now, download the Rumble Wallet and enter my code MOS10, and you're gonna get $10 in US stablecoin just for signing up. You can even use it to support creators here on Rumble, like me. So go to wallet.rumble.com/moss or scan the QR code that's on the screen right here. Of course, it's a limited time offer. If you want to see the terms that apply here, go to rumble.com/promo-official-rules and check it out.
I think, from the time that I wrote the Bitcoin Standard, which was 9 years ago, one of the main arguments about it, other than the monetary history and the monetary argument for Bitcoin, there was an analysis of the economics of Bitcoin and the analysis of the capacity for the Bitcoin blockchain to process transactions. And I made the case that, look, this thing does about 500,000 transactions a day. You may be able to stretch it to 1 million or 2 million or whatever. But on-chain capacity is never going to be anywhere near enough to onboard the people who want hard money. And I sort of made the case that the demand for hard money is infinitely larger than the demand for Bitcoin transactions for their censorship resistance or just the capacity of the Bitcoin blockchain to handle transactions. These are just massive orders of magnitudes different. Everybody is going to want to hold the money that is least inflationary because nobody wants to get poor. But not everybody has a need for a transaction that is seizure resistance and permissionless and so on. And that demand is much smaller. But either way, it won't fit on the blockchain. We can't have 8 billion people buying their groceries every day on the blockchain. We can't have 8 billion nodes around the world recording everybody else's grocery purchases in order to validate them. I don't want to validate your grocery shopping. I'm very happy for you to sort it out with your local supermarket without me being involved.
Yeah.
So this was always the case, that it was never going to be feasible that everybody's going to have on-chain Bitcoin. And that's just the way it is. And, a lot of people get upset when I say that because they have this image of Bitcoin as being money that's going to be completely decentralized, that we're going to all have the same kind of capacities. But for me, that's, would be nice, maybe, if we could make it in a way that is not expensive. It would be nice in the same way that, time travel would be nice and teleportation would be nice. I'd much rather be teleported next time I cross the Atlantic rather than getting into an airplane.
Yeah.
But realistically, I'm still going to take an airplane because teleportation isn't here, and an 8 billion person blockchain is not here, and I don't think it's coming anytime soon. So that doesn't mean that everything else is bad. That doesn't mean that we just stick to fiat. And I think the key thing is to compare the capacity for final settlement that exists between fiat, gold, and Bitcoin. And that's when really Bitcoin shines. So we don't have to go to the world where everybody's using their own node on-chain for all transactions in order for us to kill inflation. And that's what matters for me. That's the big one. That's why I'm here. That's the jackpot. This is the holy grail. We need to kill inflation. We need to kill the ability of governments to finance themselves by robbing productive people. This is the fight. This is what it's about. And for that, we don't need everybody in the world to run their own node and hold their own keys and buy their coffee on chain. We need to make the Bitcoin blockchain
much more decentralized than gold, so that we don't end up in a situation where every single country has one central bank that controls all of the clearance of payments between that country and the rest of the world. That was the natural, feasible solution to the problem of scaling gold with 19th century technology. You couldn't just have a person in France ship 3 gold coins to their supplier in the US every time you wanted to trade with them. You had all of the French people settle with their local central bank, and then the central bank of France settles with the US at the end of the day or week or month or year or whatever. And so this was just the natural solution for gold to scale. And it meant essentially very expensive and very small number of international settlement transactions, where for each settlement, thousands of smaller transactions were taking place. So when at the end of the month or year, the French central bank sends gold to the US central bank, it's settling thousands, maybe millions of transactions that have taken place over a year. Well, Bitcoin allows us to do far better than that. We can still do 500,000 or 1 million transactions a day, which is an enormous thing. And then, there are ways of making it a little bit more efficient. So you get millions, essentially, of final settlement transactions every day. And that, on its own, I believe, is strong enough to allow us to have the entire world use Bitcoin. We can have hundreds of thousands of full nodes that perform final settlement with one another every day or every week. And it would be far more decentralized than the central banks that have to lug physical pieces of gold around. So that really is the value proposition. For me, it's not that everybody's going to have to buy everything on chain. It's that the chain is quick and large enough that it can have a far larger number of financial transactions carried out internationally for final settlement than the fiat and gold monetary system, which is why the subtitle of my book is The Decentralized Alternative to Central Banking. That's what the Bitcoin standard really is. It's a decentralized alternative to a system in which we have 200 central banks around the world, but really ultimately, we only really have one central bank, which is the US central bank, and everything else is essentially a second layer solution. So gold and fiat have to centralize into one central bank at the end of the day. Bitcoin, I believe, will centralize to a system of tens of thousands, maybe hundreds of thousands of central banks. And none of these central banks will have the ability to stop you from using other central banks, and none of them will have the ability to print money. And that's it. That's the jackpot. If we're just able to stop central banks from increasing the money supply, then we are going to make the world an infinitely better place.
I agree. We're all pushing to get that world into existence as soon as possible. I want to wrap it up with that, but walk us through the books real quick, because as I said, the Bitcoin Standard, it's the #1 recommended book. It's the book that got Michael Saylor on track that he's on. But you have the Fiat Standard, the Gold Standard. Just give us like a brief synopsis of what they are and who should read those, or how they should think about them.
Yeah, so the Fiat Standard is the sequel to the Bitcoin Standard, which looks at the questions that I couldn't really answer in the Bitcoin Standard. The most common questions that people asked me after the Bitcoin Standard, what do you think of this? What do you think of that? And particularly it's centered around the topic of understanding the interaction of Bitcoin with fiat. And it's structured in a way where I follow the same approach that I used in the Bitcoin Standard to study Bitcoin. I use that to study fiat in the Fiat Standard. So it's almost like you're an alien coming in and discovering this new civilization, or you're a computer programmer trying to abstract how fiat money works and analyze it from first principles. Just look at how it actually works. And, having looked at Bitcoin and a whole bunch of shitcoins over the years, you develop this kind of idea where there are all the important metrics that you want to understand. And in other words, Bitcoin is like the MVP, the minimum viable product of money. It's the bare bones of the essentials for money, and it works as money. So it allows you to think conceptually of what it is that makes money, and then you can apply that to thinking about fiat and see how it operates as money. So what is the equivalent of mining? How is fiat created? When you think of that, then it really shines a lot of light onto how fiat works and how the world works, because the equivalent of mining in the fiat system is credit creation. And whereas in mining in Bitcoin, you have the difficulty adjustment that controls the amount of supply that gets created, in fiat, you don't have a difficulty adjustment. So credit is created at a much faster rate than Bitcoin is created. But you do have some sort of barbaric system of difficulty adjustment, which is that if too much credit is created, then you create credit cycles which cause a crash in the money supply, and it brings the money supply down. So there's an enormous amount of insight that you can get from looking at fiat without the romance, stripping away the propaganda and looking at how it actually works. And so then using that as a mechanism for understanding how Bitcoin and fiat can interact with one another and how you would expect Bitcoin to grow over time. Now, the gold standard is an entirely different story. The gold standard is a fictional book. It's an economic fiction book. So the first third of the book is a history book of the world leading up to World War I. And then the second third of the book is like a novel of trying to understand how an alternative history could have developed where fiat money dies in 1915, World War I ends, all the central banks go out of business because they're all broke because they can't print money anymore, and the world goes back on a gold standard, but it's a decentralized gold standard. So if you'll notice in the pictures there's an aircraft here. So gold goes from, the evolution of gold is from gold coins, gold central banks, and then we have an airplane clearance system where we are a decentralized monetary system based around gold. And so essentially airplane technology in the early 20th century advances far faster than it actually did. And that allows us to have a business model that is successful across Europe and the world for clearing gold internationally. And that means that when central banks start printing money, people can take their money out of the central bank, out of their local bank, and they don't have to turn in their gold, and they can just trade with one another using these airplanes. Essentially what I was referring to in terms of Bitcoin and how Bitcoin is an alternative to gold. I do that as a thought experiment, and the jet is called BTC. The airplane is called BTC in order to just drive the point home. I'm not very good with subtlety. So, essentially it's saying what would have happened if we had something like Bitcoin in 1915, and it would have ended World War I, and it would have completely revolutionized and changed the way in which states function, the way in which money, banking function, and the way in which technology has evolved. And then the third section is almost like an economic history book where we're looking at how the economy of the world developed over the 20th century with this new technology. And my third book, well, the gold standard is the fourth one, is just published last year. But the third book was Principles of Economics, which is an economics textbook from the Austrian perspective. And that's maybe the most complete academic book of mine, which really goes through Austrian economics, summarizes all the most important ideas in Mises and Rothbard's work, and adds a little bit of my own twist on it.
Good, good. Well, we're going to link to all those down in the show notes down below. And with that, we'll wrap it up. Saif, thanks so much. Appreciate it. Your contribution to the Bitcoin space with that book, with all the books, and thanks for taking the time.
Thank you, sir. Appreciate you having me on. Always a pleasure chatting to you, Mark.
Welcome. This is BFC in NYC, the premier institutional Bitcoin adoption event. We are here with over 300 decision makers from across the industry. We're excited to welcome you, and let's get into it. So the people in the room are what makes today an incredible event. The top companies who are allocating Bitcoin to their balance sheet and leveraging Bitcoin to run their businesses are all in the room, having conversations and making deals happen. All the decision makers from across the Bitcoin ecosystem who have anything to do with corporate adoption, institutional adoption, are in the room here at BFC in NYC. Thanks for coming, and we hope you enjoyed the event. We'll see you in Hong Kong.
p.m. here in New York. This is the countdown to the close. I remain Boston.
And I'm Kate. Katie Greifeld. We're keeping an eye on equities, but let's check in on the world of digital currencies. Strategy beefing up its reserves to $3 billion following its recent stock sale, not buying or selling any Bitcoin between July 6th and July 12th. Joining us live, I'm pleased to say, it's Strategy CEO Feng Li. Feng, fantastic to have you with us. So as I said, this week you issued that stock sale. Your cash reserves are up at $3 billion. My understanding is that this allows you to pause Bitcoin sales for the time being. But talk us through, what the next several months look like. Do you plan to sell more Bitcoin? And if so, how much?
Katie, thanks for having me. We have really evolved from being a Bitcoin treasury company to a full digital capital platform. We're the world's largest identified holder of Bitcoin in the world. We have over 840,000 Bitcoin. Digital credit has been launched in the last year in the form of stretch just $10.5 billion. So we have a responsibility to our common shareholders, our preferred shareholders, and Bitcoin, of course. We issued now, or we've accumulated $3 billion in cash because we listened to our preferred shareholders, and they said having liquid cash on our balance sheet in the short term is important. And we also sold Bitcoin to be able to show liquidity with our Bitcoin. Yes, we will continue to issue capital. It could be in the form of MSTR, it could be in the form of Bitcoin, and we're going to make the decisions that are best for our shareholders over time.
Well, could it also potentially be in the form of STRC that, of course, are preferred shares? They're known as Stretch. My understanding is that you last issued Stretch in mid-May. Of course, it's been trading at a discount here. Do you plan to issue Stretch again in the near future?
Yeah, our plan is to get Stretch back to par. Unsure how long that will take. Building up the U.S. dollar reserve was a big part of that, and we'll continue to build that. And yeah, when Stretch gets back to par, we'll issue more. We'll buy Bitcoin. We may continue to beef up our U.S. dollar reserve. That's a big part of our capital plan, is to issue more preferred over time because it's very accretive to our Bitcoin per share, which is accretive to our shareholders.
Well, I am curious just about just kind of the structure going forward. I mean, to get back to par, is there a sense here that you can do that, whether it's with selling more Bitcoin or issuing more equity? Have you determined what might actually be the best path to get there, or the most efficient path to get there?
We think the first thing is the U.S. dollar reserve, right? I think we've learned over the course of the last couple of months that having that liquid access to U.S. dollar capital, whether it be 1, 2, 3 years, is quite important. And we saw when we increased it in the last couple of weeks, we got Stretch up from a low in the 75 range to close to 90. So we'll continue to build that. We increased the dividend. I don't think the dividend is as much of a factor. And I think a track record of success and a track record of execution. And then, of course, education. We're a year into the product. A lot of financial products take 2 or 3 years to mature. So we're early, we're learning, we're listening to the market. And the great thing is there are built-in mechanisms with a market, for example, go into par, right? And staying at par, that's a mechanism lets us know what we're doing right and what we're not doing right and what we can improve upon.
What's the communication, though, with shareholders overall? There's been a lot more focus, obviously, on the preferred shares, but I mean, you guys issued a ton of common equity in the preceding years, and I am curious if there's any sense in trying to reconcile some of those folks who bought a lot higher than where that 96.73 price stands right now.
Our shareholders understand our primary goal is over time to outperform Bitcoin, which is an extremely volatile asset. Right? It's vol is somewhere in the 30, 40, 50 range, and they understand that MSTR is built to outperform Bitcoin. And as a result, when Bitcoin goes up, MSTR typically goes up more. When Bitcoin goes through a bear cycle like it is right now, MSTR can perform a little bit worse. But as long as MSTR is priced greater than the net asset value of our Bitcoin, it means that our shareholders are giving us credit for the performance above Bitcoin. And when we do that, we can issue more equity for the most part. Look, we talk to our shareholders all the time. There's quite a few constituents. You know, we're one of the most liquid stocks in the world. And when we talk to our shareholders, institutional, retail, we look at what people say on social media. We take a lot of comments. We bring that all in, and it's great to have the feedback.
And I mean, just looking forward again, I mentioned that, you know, your cash reserves, they're $3 billion right now. It seems like you have several years of being able to cover your interest expenses. But I mean, when you game plan out in the future, 3 years, 5 years, it just feels like Bitcoin has been stuck in this rut for a while now, you know, trading around $60,000 per coin or thereabouts. But do you have a break glass sort of plan if, you know, we go down to 30,000 or 20,000 or even below?
Yeah, when Bitcoin gets down closer to 8 to 10,000 is when we're going to have, you know, we have to consider some of the risk associated with our debt. Until that point in time, we feel very secure about the balance sheet. Look, to your point, Bitcoin has quite a bit of volatility. It goes up and down, and every time it's in a bear cycle like it is, people ask, okay, will it go to zero? And it hasn't yet in its 18-year history. In fact, it just achieves all-time highs. But what we need to do is build a capital structure that can withstand bear markets and, of course, benefit from bull cycles. And that's what we've done so far. We've been through this in 2022. We're going through it in 2026. And I'm pretty excited about the next bull market of Bitcoin.
So for those folks who are concerned that sort of strategy as being kind of the dominant buyer, or at least a perpetual buyer of Bitcoin, there's some reassurance you can give them that you are not gone from that market as a buyer?
We're not going anywhere. We're the largest identified holder of Bitcoin. My objective would be the largest buyer of Bitcoin for the foreseeable future. We're not going anywhere. Anybody that's worried about strategy shouldn't be. That said, Bitcoin's a lot bigger than us, right? We are 4% shares of Bitcoin for the long term.
Okay, so you're not going anywhere. I do want to go back a little bit to the preferred shares because Bloomberg News did report last week that distressed funds, they're in talks to swap their preferred shares for other securities. Of course, that would be a negotiation. And with that in mind, can you give us an update on what those conversations sound like? What is actually developing there?
Yeah, there may be funds talking to each other about swaps. We haven't been at any material conversations. The way we're going to make stretch work is we're going to continue to increase the U.S. dollar reserve. We're going to listen to the market. We've put out, the opportunity and the option to buy back stretch if it makes sense, but we're not in any material conversations otherwise.
And Feng, before we let you go, I want to reflect on strategy a little bit because you're the CEO of strategy. You're best known, of course, for being a Bitcoin Treasury company, really the OG, but you also have a software business, and as of the end of March, you had more than 1,500 employees, and I'm wondering, sitting in the CEO chair, how much of your time do you divide between this ecosystem of financing that you've built up to accumulate more Bitcoin and the actual underlying software business?
I'll start with I'm an engineer by education. I'm a technologist at heart. I'm a financier as my day job, I'll call it. So I love software. I love AI. I love Bitcoin. They're the convergence of all the things that I really enjoy doing. 50-50, 40-60, a lot of the discipline is the same. And, keep in mind that the 1,500 employees, we have folks who are in finance and marketing, in engineering, in legal and accounting that are able to bring a maturity and 25 years of public company experience to our Bitcoin business that I think a lot of other companies that are in the Bitcoin or DeFi world aren't able to bring. And it's part of, I think, what makes us successful.
All right, Feng, really appreciate you taking time for us. Feng Li there, the CEO over at Strat.
All right, guys, something big is happening. We saw roughly 189,000 Bitcoin that had been inactive all of a sudden start moving. Now, if you own Bitcoin or if you're thinking about buying Bitcoin, then the reason why it's moving should actually matter to you more than what the price is doing right now, because one of the largest known hardware exploits just unfolded. We saw more than 1,800 Bitcoin reportedly stolen, over $140 million. And if your Bitcoin depends on one exchange or one device or one seed phrase, then the same hidden dependency could already exist in your own setup. But there's a bigger question that almost nobody seems to be asking. Did the people who moved their Bitcoin actually remove the danger? Or did they carry the same exposed seed into a brand new device? Now, this is a big deal because I had to learn the lesson the hard way. I lost 17.8 Bitcoin from a hot wallet. I lost more than 27 Bitcoin from an exchange. And back in 2021, I warned that one day a bug inside a hardware wallet could create exactly this kind of failure. Now, one has. So in this video, I want to show you what this mass movement proves, what it doesn't prove, what it doesn't mean, why changing hardware may not make you safe, and the single failure test that I use so one hidden dependency can't take everything from you. You ready? Let's go. All right, now look, this is a really important video. It's important for me because I lost a lot of Bitcoin. It's been super painful, and I don't want you to have to lose like I did. I talked to a lot of people who lost a lot of Bitcoin in this last hack, and so I don't want that to happen to you either. Now, to really understand what's going on here, first we have to separate the fact from assumptions and from fiction, right? So here's the facts. On July 30th, one of the top Bitcoin hardware wallet manufacturers called CoinKite. They published a security advisor, and it covered certain versions of their hardware wallet, which is the cold card. Now, the cold card firmware had a problem, and they warned that those versions could generate weak seed phrases. Now, what that means is that, your Bitcoin is not stored inside this hardware wallet, this device. The hardware wallet only holds and protects the private key that controls your Bitcoin. Now, those keys come from your seed phrases, and the seed phrase, it needs like this enormous randomness for the encryption. Otherwise, if it's too simple, then someone or some powerful computer, some AI computer could predict it. They could figure it out. Now, many of these cold card wallets and the users, they created the security, but they didn't use enough randomness. Then, of course, it makes it easier for certain keys to be able to predict that. And I want to be just real clear about this first. Like, Bitcoin did not break. This was not a break in Bitcoin. It was not a hack on the network. All it was a hack on the key generation process for cold card users. Okay, that's it. Now, once attackers could predict what those keys were, they didn't need the original device anymore, because now they could rebuild the wallet somewhere else. Now, the hardware, the device that you had, could remain locked in your safe, in your bedroom safety deposit box, whatever, but the Bitcoin could still disappear off of that. Now, CoinKite released corrected firmware for this, and that protects seeds that are generated in the future with the new updated firmware. But of course, the software can't go back. It can't repair like the old seed. It can't add randomness after the fact if there's no randomness there. Now, it's been reported, we don't know exactly, but about $130 million USD value of Bitcoin was stolen during this cold card wallet exploit. And now there's many people that move their Bitcoin from the cold card to another wallet manufacturer, Trezor, Ledger, something like that. And they might not have fixed the problem at all, which I'm going to come back to. I'm going to talk about how we fix that problem. But what's also interesting to report right here is that around the same time, Blockware reported unusual Bitcoin movement. We saw roughly 189,000 inactive Bitcoin move all in a single week. Now, we can't tell exactly, but many of it appeared to be heading towards exchanges. And just because it's headed to an exchange wallet doesn't mean it's going to be sold. All we can do is see the movement, right? But we don't know, the intention or the motive behind that. We also can't prove that every coin involved was on a cold card, right? But the timing around it makes a custody response pretty reasonable, right? Of course, it doesn't make it certain. The Bitcoin blockchain, it's open, right? It's open and it's anonymous, right? It's not private, it's open, it's anonymous, so we can see that movement that's happening. We don't know who owns them, right? We don't know what wallet they were using. And of course, we don't know why they wanted to move them. But what we can say is still pretty remarkable. Old Bitcoin became mobile during a custody crisis, and the response exposed a much bigger problem. All right, now to understand how expensive this problem can become, let's go back to the lesson that I had to learn the hard way, the lesson that cost me more than $2.8 million. So it was July 2017. I was down in Mexico with my family on a surf trip. And at the time I was buying Bitcoin mining equipment, and I had to make one large payment, one single payment. At the time I was restricted of how much I could actually send from my account in a single day. So what I was doing is every day I would move a little bit into the Bitcoin hot wallet that I was using. It was on my phone, so that then I'd have enough and I could send it all in one transaction. And then one day I opened it up as I was transferring more on there, and I realized all the Bitcoin was gone. 17.8 Bitcoin was gone. Now, it was worth about $40,000 back then, 2017. Today, it's worth about 1.1 million. But the thing is, I didn't lose dollars. I lost Bitcoin. I lost 17.8 Bitcoin. Bitcoin I would still own today because I haven't sold any of my Bitcoin. That's pretty bad. And now, that was on a hot wallet, in a wallet that I controlled the keys for. Fast forward to October 2019, and I was using an exchange account. I was had an account with Bittrex, and I logged into the Bittrex account. And one day I was there, the Bitcoin was there. The next time I logged in, the Bitcoin balance was zero. More than 27 Bitcoin were gone. Now, Bittrex was supposedly founded by a cybersecurity team, engineers. Supposedly they had the very best security in the world. That was their whole pitch, right? And they did the security for me, right? They secured the private keys. I didn't have to deal with that. But that created a completely different risk. And this was a risk I couldn't control. They controlled access to my property. Now, they failed. I hired attorneys. I fought through the courts. I tried to get my money back and I lost. The reason why is I'd clicked the little box that said I accept their terms, and then that protected them and not me. So now here we are, 2021, and I had to learn the painful, expensive lesson twice, right? I learned the lesson that most people still refuse to accept. I lost Bitcoin in my own wallet that I controlled the keys. I lost Bitcoin on exchange that somebody else held the keys. Those two losses totaled nearly 45 Bitcoin. Now, today, that's about $2.8 million. Now, of course, when Bitcoin gets to 1 million per Bitcoin, that loss becomes nearly 45 million. That's the real cost of losing a scarce asset too early. You see, once a scarce asset leaves your control, you lose every future dollar that it could become, right? This is why I never build a retirement plan that requires selling the scarce asset in the first place. Now, speaking of retiring and with Bitcoin, I recently just rebuilt my entire Retire Off Bitcoin toolkit. More than 100,000 people have already gone through the original one. Now, the new calculator answers two questions. What could your Bitcoin support? And when could it make work optional? I'm going to show you where to get it at the end of the video, or I'll just put a link down in the description down below. It's all free. But let's get back to losing and securing Bitcoin, right? Because the bigger lesson was this. There is no choice between risk and no risk. There's no such thing as no risk, like risk or no risk. No, there's only trade-offs. Leaving Bitcoin on an exchange, there's risk. I can trade key risk for company risk over here. I can hold one seed myself and I remove the company risk. But if I have one device, one backup, or I make one mistake, then it becomes fatal. You know, in Bitcoin, we say not your keys, not your coins. And it's true, but it's sort of incomplete. You see, self-custody gives you control, but it also makes your mistakes permanent. Sovereignty and responsibility, they have to work together. Now, back in 2021, I made a video talking about this. I described the hidden dependency this way. Let's play the clip.
Is because what if, and I'm not accusing anybody, but what if a developer at one of these companies, Treasury, Ledger, Cold Card, et cetera, what if one of those developers put in a backdoor? And, you know, when Bitcoin gets to $1 million, they decide to exit scam everybody. What if there wasn't malicious? What if they just had a bug that they didn't know about? And so you don't want to have all of that dependent on one device. And like I said, it's super messy and complicated.
All right, now I wasn't predicting this very specific incident, obviously, but I was naming a class of risk that I was worried about. And the answer was not finding the perfect device. It was changing the failure condition altogether, right? That's why I moved off of a single security device to a multi-signature device. Not because multi-sig eliminates risk, right? We can't get rid of it. Because one compromised key should not be enough to lose everything. So we want to stop asking, is this safe? Because nothing's perfectly safe. And we want to ask a better question instead. And the better question is, what failure am I depending on never happening? Now, that might sound terrifying, and it is. Don't lose your Bitcoin like I did. Fear is not the solution, right? We have to architect the solution. We have to learn how to mitigate the risk. The goal is not eliminating risk. The goal is making sure that one failure can't take everything. Now, the first step is finding a hidden master key. All right, so the answer, the hidden master key is to diversify the risk, right? I don't believe there's one perfect manufacturer out there. So instead, we have to change. We have to diversify the failure condition. Now, this is why most of my Bitcoin was moved towards multi-sig devices, which basically means that I need multiple keys to sign a transaction, multiple signatures, right? So this way I have 3 different hardware wallets by 3 different manufacturers, all on 3 keys, you know, in different locations. That way there's no single point of failure, right? This is the conclusion I came to back in 2021, the one I talked about in that video, and I've been using it ever since. This way, if one hardware wallet has a malicious actor, right? Inside the company, or maybe they just don't know what they're doing. They have oversight on the code, something like that. Someone breaks into my house and steals the hardware wallet, whatever, a hacker gets into it, whatever, I'm still protected because they would only get access to 1 key, but they would need 2 of the 3 keys to do anything. So that's the bigger solution, but we still need to be addressing the mistake that may still be putting people in danger right now today, because people think the physical device is the wallet. But that's not true, right? Because the Bitcoin exists on the blockchain, like in the cloud. The hardware device is a tool that creates and uses those keys, right? So then the recovery words are the master instructions that can recreate those keys on another compatible device, you know, if or when need be, right? As long as I know those words, typically 12 words, I can go anywhere in the world, plug those 12 words in, and I can have it back. We have to understand this chain. It's pretty simple. Your seed phrase, the words, it produces your private keys. Those keys control the addresses, and control of those addresses controls the Bitcoin. So if the original seed was exposed, then loading it onto a new device doesn't create new keys, right? All it does is recreate the old ones. So you can move into, you know, I don't know, say you move into a new house. you can install a beautiful new lock. But if you keep using a master key that maybe everyone already has copies to, then the new house is still exposed, right? You changed the lock, but you kept the copied master key. So the same thing is true if you generate a new address from the same seed. It may look new on, the blockchain, but it still comes from the same root dependency. And so a new device with an old seed is an old wallet wearing like new hardware. So the real migration requires a genuinely new, independently generated seed. So new keys, a new verified address, an on-chain transfer from the old keys to the new ones. So what does this mean? It means that if I had a cold card and I took my seed phrase and I just went to a new wallet, another brand, whatever brand you want, and I use that seed phrase to move my funds to the new wallet, I'm still exposed. What I want to do is I want to get a new wallet and set up a new seed phrase in the new wallet. And then I transfer the funds from the cold card over to the new wallet. That way the new wallet and the new seed phrase, it's all protected. All right. Also, just really quick, I know this sounds complex and it kind of is, but so are other financial transactions, right? So like buying a house is pretty complex, buying a business, opening an investment account, it can be, difficult. So we use professionals, and those professionals help us make it easy, but more importantly, they make sure that we don't screw it up. Now, I've been using Unchained Capital for myself. I use it for my parents, my sisters, my family. I've been using them for years, long before they sponsor my podcast, The Mark Moss Show. If you don't check that out, I'll put the podcast link down below. But they sponsor my podcast, but that's who I use. And Unchained Capital, they help Bitcoin holders build collaborative 2 of 3 multi-signature custody. And then they have professional service. They have concierge, one-on-one assistance. They make it fast, they make it easy, so you don't screw it up. Now, Unchained can also help with succession plans, like if something were to happen to you, your spouse, whatever, to make sure your kids get the Bitcoin. And again, like I said, I've been a customer for years, ever since I lost the Bitcoin both ways. And I think it's the best way to secure your Bitcoin. So I'm going to put a link in the description down below if you want to save some money and getting it set up. Same service I use, I'll link to it down below. But let's keep talking about what you need to understand about the hardware wallets, because it's important to understand that owning 3 hardware wallets doesn't automatically give you 3 layers of security, right? So even if I have this multi-sig setup, if all 3 devices use the same seed, then I haven't diversified the risk, right? If they're all with cold card, all 3 keys are cold card, then all 3 can be exploited. You can't have 3 devices holding 1 seed, right? It's just the same dependency. So the architecture changes only when the keys are independently generated and 1 key is not enough to move the money. And especially, like I said, I want them from all different manufacturers. Now, back to a standard single signature wallet, 1 seed produces the key system that can spend. And if that seed is predicted, if it's stolen, exposed, whatever, destroyed, without a backup, then the entire balance can be at risk. If 2 of 3 multi-signature wallets, then there's 3 independent keys. Now, any 2 are required to spend that transaction. So there's key A and key B, they can sign. Key A and key C, they can sign. Or key B and C, they can sign, right? But 1 key can't enough. It's like the movies, it's like we're going to send the nuclear submarine or whatever, and like the admiral and the president have to put the keys in, turn at the same time. Now, for that independence to be real, though, each seed should be generated independently. And you should not clone 1 seed across 3 devices. That's not diversification. And like I said, I want different manufacturers, right? That way it reduces the chance that one, bug implementation or 1 code defect or 1 malicious actor isn't enough to lose everything. And then separating the keys geographically and operationally. That can reduce the chance of 1 theft or a fire or we call it a wrench attack, a coercive event, someone breaking into your house trying to steal it. And you got to preserve the wallet configuration and the recovery instructions, not just the seed phrase, all right? You also need to plan for incapacity, right? Like I said, for inheritance, because security that nobody else can recover, it becomes a permanent loss, right? And this is where the cold card incident becomes a powerful teaching example. I hope you didn't lose money in it. I know a lot of people who did, but as we say, smooth seas never made a skilled sailor. So we learn from these things, and hopefully you can learn from other people's mistakes. But what we learned is if 1 key in a properly constructed 2 of 3 wallets was generated by an effective cold card, an attacker who recovered that 1 key would still need a second independent key to spend. They couldn't do it. The affected key should still be replaced, of course, but 1 compromised dependency would not automatically become a total loss. It required 2 keys from the same vulnerable process, or if the same seed was copied across devices, the apparent redundancy could be an illusion. Now, I also want to say real quick, it doesn't mean that everybody should just rush into a multi-sig setup. Every custody model removes some risks, but it also adds others, right? A hot wallet gives you convenience. It can make sense for, walking around, spending money, things like that, but it creates more exposure. It's a poor place for your life-changing savings. In exchange, it reduces their key management, right? Because now they're doing it, but it adds counterparty risk, legal risk, withdrawal, account security risk, things like that. A single signature hardware wallet removes exchange custody, but now concentrates responsibility in you, and there's only one seed to worry about, okay? Then I go to multi-sig self-custody, or we call it collaborative custody, and then that can tolerate the failure of one key, but it adds setup, coordination, backup, inheritance complexity, things like that. I could leave it in a brokerage. I could buy like Bitcoin through an ETF, and then I get the convenient price exposure to Bitcoin in the brokerage account. I don't really have to worry about it ever being stolen. But all I own is like IOUs from my brokerage. I don't really actually own Bitcoin, right? Now, I don't publish my allocations. I don't publish my key locations, but I don't force every dollar of every Bitcoin through one custody rail either. So I have multiple bank accounts, and at each bank, or I have multiple banks, and at each bank I have multiple bank accounts. And so I keep money across all those banks, and then I have money in my brokerage accounts, and I have money on PayPal and Venmo, and we have it diversified, right? And so I think about Bitcoin sort of the same way. And so you can have Bitcoin on an exchange, you can have Bitcoin through your brokerage account, you can have Bitcoin through a hardware wallet, through a multi-sig, or whatever you want to do. You can diversify that. So if one gets lost, you don't lose it all. Now, I do want to reiterate one more time, because this is super important. Bitcoin did not break. The network kept enforcing valid signatures exactly as designed. The failure was in how some keys were generated before those signatures ever reached Bitcoin. So this is not an argument against self-custody. It's an argument against lazy certainty. Now, if your entire security analysis is, I bought a hardware wallet, then I guess I'm safe, then you haven't analyzed the risk. You've repeated the marketing. So self-custody gives you sovereignty, but sovereignty without competence, without responsibility, without backing it up, without redundancy, becomes fragility. Okay, and I also want to be clear, like, don't respond to this video by panic moving Bitcoin. Don't do that. You don't move it until you fully thought through this, all right? Respond by running a single failure test. Let me walk you through it. Ask one question. What is the one thing that could fail and take everything with it? Then you got to work through 5 questions, all right? Question 1, what actually controls my Bitcoin? So is it an exchange account? Is it one seed phrase? Is it a 2 of 3 signing quorum? Or is it a brokerage claim? Question 2, what single failure could create a total loss? So could it be a compromised seed? Could it be one inaccessible custodian? Maybe one email account? Was it one device manufacturer? Or one person who has never practiced recovery? Question 3, if I changed hardware, did I create a new independent key? Right? Because restoring the old words is not a new security boundary. A genuinely new seed requires verified on-chain move. Okay, question 4. Can the system survive me? Right? Could a trusted successor, my wife, my kids, whatever, could they recover it if I were unavailable, if I was dead or incapacitated? Or have I created so much complexity that nobody else could even execute the plan? Question 5. Does the security match the consequence? See, spending money and life-changing savings should not require the same custody architecture. More complexity is justified only when it removes more risk than it creates. Think about, like, you maybe carry money around in your wallet or your billfold, right? But like, you don't have your life savings in there. You have enough for spending, walking around. I don't have to secure it that much. I can leave it on my nightstand or dresser. And with a little bit of Bitcoin, maybe you have in your hot wallet, you can do that. More requires more security. So what changes after this event is not that everyone needs the same wallet. What changes is that cold storage can no longer be the end of the security conversation. What does not change is the value of self-custody. For the right person with the right process, it remains one of Bitcoin's most powerful properties. What you should reconsider, though, is any arrangement where one company, one seed, one device, or one mistake could cost you everything. Security should scale with consequence. Okay, so look, 189,000 Bitcoin moved in 1 week. And of course, like I said, we can't prove that all of it came from the cold card users, but the movement exposed something bigger. Owning your keys does not eliminate trust or responsibility. It only relocates them. Leave your Bitcoin on an exchange and you depend on the institution, its security, its terms, and your access to that. Hold one seed yourself you depend on your ability to generate it, protect it, back it up, and recover it. Use multi-sig and you reduce one key risk, but now you accept more complexity and coordination. You see, every choice is a trade. After losing more than 44 Bitcoin, I stopped asking which wallet has no risk because that wallet does not exist. I started just asking a better question. What single failure could wipe me out? And how do I design a system so that failure is survivable? Because moving Bitcoin is not the same thing as removing risk, right? The goal is not to eliminate every dependency. That's impossible. The goal is just to make sure no single dependency has the power to destroy you. So that was my expensive mistake. I don't want you to make the same expensive mistakes. But if you have, drop in the comments, let me know if you made some expensive mistakes. Also, man, calculate what it's going to take for you to retire off of Bitcoin with the brand new calculator. 100,000 people got the past one. It's all free. It's in the link in the description down below. And as I always say, to your success, I'm out.
Welcome. This is BFC in NYC, the premier institutional Bitcoin adoption event. We are here with over 300 decision makers from across the industry. We're excited to welcome you, and let's get into it. So the people in the room are what makes today an incredible event. The top companies who are allocating Bitcoin to their balance sheet and leveraging Bitcoin to run their businesses are all in the room, having conversations and making deals happen. All the decision makers from across the Bitcoin ecosystem who have anything to do with corporate adoption, institutional adoption, are in the room here at BFC in NYC. Thanks for coming, and we hope you enjoyed the event. We'll see you in Hong Kong.
I'll say with no specific evidence behind this, it definitely feels like the hedge fund world is coming together directly against some of these digital asset treasury companies all at the same time right now. And you're seeing it in their prices, you're seeing it in the prices of the preferreds, in the put buying in MicroStrategy yesterday morning, into the lawsuits that seem to be very coordinated. To reframe something I said earlier, we just had this period of massive productivity growth and interest rates being pushed upward from geopolitical risks. You know, these are store value assets without productivity growth and without an interest rate, without some good engineering on top of it. So I think this has kind of been the perfect storm against these store value assets. And I find that the financial advisor space is the have and have nots with crypto. There's just a very few select groups that are willing to have over a 2% allocation of their client books. And I think I initially expected that the rest of the marketplace would, like dominoes, so okay, I'm a Morgan Stanley advisor, we just launched our own Bitcoin ETF, there's gonna be a wave of slow adoption, but I think you're gonna really have to that next price leg up before you start seeing the FOMO from the financial advisor community that's on the sideline right now. But I think that's what can really make it exacerbated, and it seems like the ultimate bearish moment in Bitcoin right now. So knock on wood, hopefully there's not much else that can make it worse.
What makes Japan so special? Why is it breaking all of our models? Japan is basically the monetary experiment proving ground for all central banks.
Why do you feel like this is the preview for what we're going to see everywhere else?
Their goal is to eliminate the business cycle. And that's kind of like the central banker's wet dream. Besant said that this is just what allies do for each other. No, it's not. There's something you do when you're scared. The problem with treasury companies is that too many of them focus more on acquiring Bitcoin than they do on their own fundamental business. One of the biggest things that you need to change is this idea that busts are bad. Because nobody ever truly loses, everybody loses.
Does it seem to you like we're past the point of no return when it comes to that?
They need to perpetuate the current system in order to maintain their power.
So what are we looking at next? Welcome back to Market Disruptors. Today I'm joined by Roberto Rios, the artist previously known as Peruvian Bull. And he's been this leading voice in this conversation around the Japanese yen, the carry trade, the global ramifications going around this. So I'm really excited for this conversation today. For those at home who noticed my black eye, you know, big Bitcoin called, I got a shakedown. No, I'm just kidding. But just putting it out there. Yeah, we got a little black eye. It's all right. Roberto, thanks for joining me, man. I'm excited for this.
Thanks for having me. And yeah, that black guy looks pretty badass, man. It looks like you fought off a wrench attack, with your bare hands.
Yeah.
So
yeah, I keep a wrench on me.
Let's go. Let's go. Keep those hammers ready, dude. Yeah, it's good to see that. But yeah, thanks for having me on. I'm super excited to talk about this because this is obviously like the news of the hour. Japan's currently in crisis management mode, and everyone's eyes are pointed there.
Yeah. Yes. I mean, it's hot right now. We'll turn this around in probably like 2 days or so. And so this is something you've been talking about since we met back in 2024. You had the foresight to see that this was going on. And then, now's your time to shine as it's really picking up. And you're the guy. When I was reading about this, I was like, you know what? I got to talk to Roberto. He's the perfect person to have this conversation with. For a little intro, so you started off this video that you put out a couple weeks ago, citing a tweet that said this. It said, "The measures being prepared by the Bank of Japan will affect the lives of billions of people. To the people of the Western countries, I offer my deepest apologies. This is not a personal matter. May God's blessings be upon you," which is a pretty ominous little warning, and then it's continued to play out since then, since you brought this up. Scott Bessent, in this quote unquote leaked, which clearly wasn't leaked, to-do list that he had, said he intended to buy 5 to 10 billion US dollars worth of Japanese yen to prevent further devaluation. And this, which helped for like hours, it kind of helped the market for a few hours, and then the collapse continued. So I'm not a total expert in this topic, but I've been paying attention to it in a lot of ways mainly through the writing that you've been putting out. So I want to see if we could start with zooming way out, even before what you're writing in 2024. Like, what prompted you to start looking into this, discussing this? If you could give our audience a little bit of that zoomed out background before we get into what's going on today.
Sure, absolutely. So, I got into macro basically before my freshman year of college. So this was around 2015. Started researching, global monetary system, money flows, capital flows, different forms of economics, right? Austrian, Keynesian, monetarist. And, within a couple of years, like I felt like I'd built a pretty good base of understanding of how the global monetary system works. And I credit, Luke Roman, Lynn Alden, a lot of those people with a lot of the knowledge I gained in those years. But one thing that always stuck out to me, which was strange, was a stat that I'd read from Hindenburg Research back in 2018, which was in the past 150 years, so since around 1850, there's been 55 countries that have had their monetary system go above 120% debt to GDP, which seems to be like the magic number where either inflation, hyperinflation, debt defaults, demonetization, right? So like El Salvador, for example, went off of the Salvadorian peso and went onto the US dollar, right? There's rumors that Argentina is going to try to move onto a US dollar standard, right? So basically getting rid of their own domestic currency altogether. There's been 55 countries that have gone past this 120% debt to GDP. And of the 55, 54 either, again, defaulted, hyperinflated, financial repression, or just inflated away the debt, right? Or had a severe sort of depression or recession, as a result. The one exception
go ahead.
The one exception is Japan, out of 55 countries in the last 150 years. And so then that started begging the question.
Didn't the U.S. tap like 130 or something back during World War II?
It did. And well, actually, right in the lead up, in the lead up to World War II. And then that was followed by, and most people don't know this, but basically 20 years of the Fed keeping interest rates artificially low and running inflation a bit high in order to offlay a lot of the debt. Although, of course, a large reason why we were able to get out of that was, you could say the growth spurt that happened in the 1940s and 50s as the baby boomers were born and as the U.S. industrialized and trade globalized. But
which is the opposite of what we're looking at today.
Yeah,
right?
Exactly. That was preceded though by a 13-year-long Great Depression. And so for most countries that reach this 120% debt to GDP, 130% debt to GDP, they all face severe fiscal consequences, right? Japan is the only exception. And for many years, people thought like, well, Japan's kicked the can down the road for 30 years. Why can't they do this forever? And so that's when I started researching Japan, and I was curious. I was like, what makes Japan so special? Why is it breaking all of our models? Why doesn't it follow any of the conventional rules? And then that quickly led me down the rabbit hole of realizing that Japan is basically the monetary experiment proving ground for all central banks. So every single policy that we think of, QE, negative interest rates, 0% interest rates, QE infinity, yield curve control, all of this was invented and termed in Japan. So like the term quantitative easing is the translation of a Japanese word. It was termed by Richard Werner in the late 90s, right before Japan actually started to do QE for the first time in March of 2001. So everything that's being rolled out across the West was first tried in Japan. And Japan is kind of like the preview of what all of us will get to see. And that made me realize that this was a very key country to pay attention to. And so for 2022 and 2023, I started paying attention to it more and more. And then obviously I started writing, I started my Substack in 2023 in April, and then I started writing about it. And those posts, ironically, were like probably my most viral posts ever. And so I just kept doubling down. But it truly is the enigma. It's truly the outlier. It's the one of one that, nobody truly can understand unless you go deep down the rabbit hole.
Interesting. And why do you feel like this is the preview for what we're going to see everywhere else?
For a couple reasons. One, Japan is ahead of the West in terms of demographic decline, as well as like societal decline. So you look at like, rates of teenage relationships or marriage rates, or again, like birth rates, obviously. All of that started falling in Japan in like the late 2000s, early 2010s, even before they really started collapsing in the West in like, let's say the late 2010s. So they're about a decade or two ahead of us on almost every single metric. But more importantly, the Japanese culture, basically, in my opinion, has been kind of emasculated by the central bank, right? The central bank has basically de-risked the entire system, right? You can't really fail because all the debt can be rolled over at 0%. But then the result of that is that because all this productive capital is now locked up in zombie companies, because of all these companies just rolling forward debt at 0%, there's no actual capital to be put into productive companies. So you stave off the collapse, but you also make sure that there's no boom either. And that's kind of like the central banker's wet dream, right? Their entire goal, if you go to an economics course or you take a finance course about central banking, their goal is to eliminate the business cycle, right? This is one of the stated goals of the 1970s Fed. They wanted to ensure that we don't have the boom and bust cycle. And so the way that they thought they could do that is by raising interest rates into a boom and then lowering interest rates into a bust, and then doing that perpetually. And then their idea was that instead of the GDP growth number going like this, like a jagged line up with a boom and a bust, and then a boom and a bust, that it would just be a perfect straight linear line. And again, nowhere have they gone as hard as they can as Japan. So that's been their basically monetary experiment proving ground, their lab, so to speak, in order to test out all these theories and see if they can work on the Japanese populace. Because if they work on the Japanese populace, they can hopefully be rolled out to the rest of the Western world, in their opinion.
So relating to this in one of your pieces, I think it was the Godzilla Returns one from 2024, if I'm remembering correctly, which that has millions and millions of views now, which is interesting, but that was big back then, right?
Yeah.
And so you've continued to talk about these ideas. One that stood out to me in that was the impossible trilemma that you I don't know if you coined that term in that, but this is the problem Japan's facing right now, where basically every country that is not a global reserve currency issuer faces a choice between three things. These three things being the free movement of capital, where money can flow between countries freely, in and out of the country freely. I mean, independent monetary policy, so what that nation's central bank does and how that relates to the global reserve currency central bank, and then having a stable exchange rate, primarily, I would assume, so that they can have long-term international trade contracts. And the point you're making is that they can only choose 2 of the 3 of these at the same time. And so the third one has to be sacrificed. So I wonder if you could explain that a little bit more in depth and then tell me which one Japan has chosen and what they're sacrificing as a result of that.
Absolutely. Yeah, the impossible trilemma is definitely not something I coined. It's a concept in monetary economics. It's actually an observation, right? It's like you look at China, you look at Russia, you look at all these, especially net exporter countries, and they deal with this problem. Like you said, you can pick 2 of these 3, right? The stable or floating exchange rate, monetary autonomy, meaning like your central bank raises when they want to, regardless of what else is happening in the world, and an open capital account. And the reason why those 3 things are what matters is because those 3 things are what determines the inflows and outflows of currency, right? And the inflows and outflows of currency set your trade balance and set your exchange rate. And for a country like Japan, which is a net exporter, well, you need to have an open capital account, which means an open capital account just basically means money needs to be able to flow in and out of the country, right? Some countries like China make it very difficult for Chinese money to flow out. It's easy for money to flow in, or it's very easy to open up, investment products in China and have foreigners invest in them. It's very hard for you to get them out, for you to get the money out. And so that means that, if you're going to, facilitate trade in a way that, you can settle payments, if you have a country that only accepts and doesn't send payments, well, how are you ever going to facilitate global trade? You can't. So that kind of a choice, right, basically restricts the economy into almost like a single-use exporter-based economy. And there's no way that the economy, like the Chinese economy in its current state, can expand beyond that, even though they want to, right? The next thing is monetary autonomy. So monetary autonomy, again, means raising or lowering rates at will. The reason why that matters is because interest rate differentials between currencies are part of what drives currency flows. So, like, let's say, again, Japan's at 0 and the US hikes to 5%. Well, then a lot of people will go to Japan, right? This is what happened with the carry trade. They borrow money at 0% and they go and turn it into dollars and they park it in treasuries. And that earns them free interest. And the size of the carry trade is controversial on the actual number. Obviously, it's basically immeasurable because it's diffuse. It's spread out among millions of people's accounts. But the numbers I've seen are on the low end 2 trillion, on the higher end 4 trillion. And if you include banks, pension funds, government holdings, what you'd call unfunded liabilities in Japan that are financed by U.S. treasuries or U.S. tax flows, or U.S. currency flows, that number can balloon up to $20 trillion, according to Deutsche Bank. So this is a huge thing, right? And that monetary autonomy, again, for Japan is very, very important because Japan is at 260% debt to GDP. And that monetary autonomy is needed so that Japan could stay at 0 or at least low, right? Right now, the policy rate's at 1. And so if Japan wanted to give up monetary autonomy, that means it basically becomes a copycat of the Fed. So what does that mean? The Fed does a hiking cycle. Japan would have to match them, like in lockstep or close to it. Let's say we're off by 3 or 6 months. Okay, you can't have Japan sit at 0% and the Fed at 5% without something bad happening. And
what happens? So if they don't hike, what happens? And if they do, in one direction, what's the problem, right? If their rates go too high, their debt runs away from them. Yeah. So what happens in both directions of that?
For every 1% increase in, for every 100 bips increase in total interest rate across the yield maturity curve, Japan pays 2.6% of their GDP in interest. So, do the math. If they normalized with the Fed in 2022, they'd be paying 13% of their GDP alone in interest. And that's almost their entire national budget, right? I think a national budget's like 18 to 20% of GDP. So, you'd be paying 2/3 of it just in interest. So if you hike, you basically hike yourself into an insolvency problem very rapidly. And
that's built on top of very similar problems that we have in the United States right
Mhm.
now with our, if we, we're at that place where as we increase our interest rates, our debt is running away from us. We have all this deficit spending that needs to continue, all these unfunded liabilities. So it's that problem is built on top of a system that shares like a same exponentially growing problem.
Yeah, exactly.
Essentially, right? Yeah.
No, exactly. I mean, again, Japan's just further down the road compared to the US, but the US has the same problem, right? We have $2.1 trillion deficit, $1.2 trillion in interest expense annually, right? It's now the largest line item in the in the fiscal budget every year. It's compounding by 23% annually since 2020. Like it's rising way too fast in the US, but my point is that Japan has just a more extreme version of that. So if they normalized with the US, meaning if they matched the US and went to 5%, or now it's at what, 3.75. If they went to 3.75, it'd still be 10% of GDP, or 9.5 or whatever. It's an insane amount of money. Like they don't have that money, and so they'd have to print it, and so that would just cause more devaluation. And then the last one is the blowout valve that they've chosen so far, which is the yen, right? So they said, okay, we're going to keep an open capital account, so we're going to keep trade flowing in and out. We're going to keep monetary autonomy because it can't hike into a basically insolvent government. So we'll have to let the third one be the pegged exchange rate take all the pressure from this pressure cooker. The problem with that is USD JPY blows out. It goes from 110 to the dollar to 155 to the dollar within the span of like 7 months in 2022. And then they start panicking because they realize, oh shit, we import 93% of our total energy needs and over 85% of our caloric needs. So when the exchange rate blows out by 40%, that means your food, your gas, your transportation, all of that goes up. Your electricity costs, all of that goes up in lockstep with the devaluation of the yen. And that drives inflation in Japan, and then that's very unpopular. And so then they start panicking, and they realize, okay, we need to start intervening. And then that's when, on September 22nd, 2022, that's when they started the interventions. And, they haven't really looked back. They've been trying everything since then, but truly, as we've seen, nothing's really worked.
Hey, look, over 130 million in Bitcoin was just stolen from cold card hardware wallets. This is the largest hardware wallet hack in history. And the sad part about this is that the victims, they did everything right. They had real devices, they kept it all offline, but there was a small firmware update that let hackers access their Bitcoin wallets and completely drain them. Now, don't blame self-custody. Self-custody isn't a problem. It's single key custody. That's the problem, when you have a single point of failure. So here's what I actually do. I've been doing this for years because I was always afraid something like this could happen. Now, this happened before Unchained ever sponsored me. I was a customer, and it's my Bitcoin, it's my parents, it's my sister, my family's Bitcoin, and it all sits in what we call multi-sig wallets. And I do that with Unchained Capital. Instead of one wallet and having one key, there's 3 keys on 3 different devices, 3 different places from 3 different companies, okay? I hold 2 in different locations, Unchained holds 1, and it takes 2 of those wallets to move anything, which means like this exact hack right now that got everybody drained, 1 compromised key won't be enough. It probably sounds complicated. Don't worry. Unchained has a concierge service where they can walk you through the entire thing one-on-one, and they're gonna build out your vault. They'll test your recovery. They'll have an expert review everything, making sure you don't have any problems. If you wanna do the same thing I do, the same thing I have my family do, go to unchained.com/MarkMoss. Again, unchained.com/MarkMoss. Set it up right. Do it once. Don't get vulnerable to a hack like this.
Yeah, and so they have spent, the Bank of Japan has spent tons of printed yen, essentially, to prop up the currency. They've now recruited the US Treasury to come and help try and bail them out, prop up the currency, but it's not working, really. Why do you think it's not working?
It's not working because the structural problem isn't being solved, right? I said this in the spaces the other day. But even if you get rid of the negative problem of, let's say, the carry trade, right, which is a large part of the reason, the Japanese fiscal situation is extremely dire, and the new prime minister, Sanae Takaichi, is a populist right-winger who wants to increase government spending and wants to cut the consumption tax, which is one of the largest line items of government revenue for the Japanese. They have an 8% consumption tax on all food and beverage, as well as fuel oil. So when you go and buy gas, when you go and buy, water, food, whatever it is, you get taxed on it. And it's mainly a tax on the working class, obviously. And it brings in a lot of money for the Japanese. I mean, it basically gives them the equivalent of their entire public middle school and high school budget every single year. So it's a large amount of money. And if she's making these tax cuts like that, and then she also wants to repeal Article 9 and create a Japanese, new Japanese military, which is another 2%, 3% GDP that she'd have to spend, then the fiscal situation is going to get worse. And that just means more printing yen, more devaluation. And so that's why the bond yields are spiking. That's why, the yen keeps collapsing, regardless even of what happens with interest rate differentials, because now it's like they're basically past the event horizon of even that mattering. The debt is just so heavy. It's just sucking in everything around it. And anything they do just makes the problem worse.
So I want to keep pulling on this thread and figuring out where you think that this goes in terms of Japan and in terms of the United States. So I guess one more question before we go into some of the forward-looking projections is, I know that Japan is one of the largest holders of U.S. Treasuries globally. And so in what ways does their currency crisis affect and create risk upcoming for the United States bond market? Can you explain that relationship between the two to me?
Absolutely. I mean, again, you're right. Japan is the largest holder of U.S. Treasuries, $1.2 trillion roughly, mostly held on account at the U.S. Fed, at the New York Fed. And those treasuries, the problem is that using them for yen interventions, right, which is basically what they do is they sell U.S. Treasuries, they get dollars, they go wade out into the foreign exchange market, and they dump billions of dollars into the market to buy yen, to strengthen the yen artificially against the dollar. And so their first one, like I said, in September 2022, brought the yen from 155 to 147 within a day. They had to follow that up with more yen interventions on October 21st and 24th of 2022. That month, they spent $60 billion. The first month was $20 billion. And they followed that up ever since with escalating and growing interventions, right? So the May and June 2024 one was the biggest yet, which was 60 billion in May, and then another 35, 40 billion in June. That didn't solve the problem. And the reason why is because functionally how a yen intervention works, again, is selling treasuries. Well, what happens when you sell treasury bonds, especially 50, 70, 80 billion in a day? Well, it drives yields higher. Well, what are those yields? They're returns on government bonds.
It drives yields higher because that's happening because they're saying, okay, we have these bonds for sale. We need to get them sold. So they continue to increase the bond yields until they're sold, essentially.
Yeah.
Right. And so that's that relationship. Okay. Yeah.
Yeah.
And then you were saying then
even better, the bond price is inverse to the yield, right? So they go out, they sell a bunch of bonds. Let's say the bond price goes from 950 to par, which is let's say 1,000, to 920 to par. Well, that raises the interest rate from 4 to 5%, or maybe not extreme, but 4 to 4.5%, right? It spikes yields, and you can see this. I've tracked this on the days of the interventions. The U.S. Treasury, especially the long end, the 30-year, 20-year, and 10-year yields, all spike intraday, and then they start to stabilize at a higher level. And usually, I think it's a spike of 20 basis points, 10. It depends, but it's a lot of selling, right? It's raising a lot of cash, and that drives yields up in the U.S. And then that means that the carry trade that we talked about earlier is now even more profitable, right? Because now suddenly a trader can say, oh, I can lock in at 20 basis points more. I can get an extra, couple fractions of a percent. They may not sound like much, but when you're using leverage and when you're using free money, which was what Japan had for 34 years, 0% rates or even slightly negative, right? Since February of 2016, their policy rate was slightly negative. It was negative a tenth of 1%. So when you're getting paid to borrow and the US yields go up by 20 or 30 bips, it's why would you not borrow more and add more leverage to the trade? You will every time. So
which makes it worse than kicking the can down the road. It's like, pouring fuel on the fire.
Yeah, it's
more
like
so.
shooting yourself
Yeah.
in the foot, or shooting
Yeah.
yourself in the face. Like it's really crazy, man.
Yeah.
And they kept trying this, right? It didn't work. And then, up until, December 2023, they'd had the the bands on yield curve control at negative 0.1 and positive 0.1%. So they basically had said the 10-year, JGB, Japanese government bond, cannot go above 0.1%. And we will buy unlimited amounts to, make sure it stays within that band. Well, finally, December 2023, they moved the bands to positive to 0 and then positive 0.5%. And then that helped the yen for a month maybe. And then the yen continued to decline. And then they moved the bands again. And then that helped for a little bit. And then it continues to decline. And then they hike out of, their policy rate. Finally, they hike out of the negative bound. They go to positive 0.1%. That helps a little bit for a few weeks or a month. And then it starts to decline again. The yen starts to decline again. So at every stage, right, they've started to unwind all of their crazy, QE, ZERP, NERP policies, YCC policies, but all of it just slowly stems the bleeding, but then the bleeding just resumes again, in a month or two. And that's very apparent with this recent intervention, by the way. From April 30th to May 6th, the Bank of Japan had spent I think it was $73 to $75 billion, the largest intervention at the time, slammed down USD JPY from 161 to 155, 154. And within a month, by the end of June, it was already back up to 160. And that was the biggest intervention on record at the time in, April, May of 2026. And then, of course, July 30th and 31st, they just did it again to the tune of 90 billion. So they're adding 15, 20 billion every single time, but it's still not having the same effect. Right now, USD JPY is at 159.3. I checked this morning, and that's half of the move. So in 10 or 11 days, it's already retraced half of the move that they got from $90 billion, their biggest intervention yet. And functionally, obviously, this was the first different intervention, right? In this one, they didn't actually go out and sell the treasuries on the second day. So the first day, it looks like they did. On the second day, they went out to the FEMA repo facility at the New York Fed. They pledged those treasuries as collateral. They borrowed against them with US dollars, and then they used those dollars to pay off, to buy back the yen and strengthen the yen. And in conjunction, Treasury sold euros, bought yen, and intervened, alongside them. But that doesn't solve the fundamental problem, which is the Japanese fiscal situation is very dire. The carry trade is still on, and they're still an energy importer, right? And there's still rumors and chaos going around with the war in Iran and oil security. So that doesn't solve any of Japan's immediate needs, and in fact, in many ways, it exacerbates them because it makes Japan look even more desperate.
Right. And I'm pretty sure, I want to say 90 or 90+% of their oil that they were importing was coming through the Strait of Hormuz. And so I don't know where it's been coming from since then, but clearly that's, another source of tension on this. So then what next, right? So clearly we have this issue that, if you look at any of the charts, Bitcoiners are familiar with exponential charts, right? You look at any of these charts, we see this exponential problem coming. They're spending more and more money on what seems to also look like an exponential trend on these interventions that are not working. So then what? So what are we looking at next, do you think?
Like what's next for the yen? Or for
Yeah, so maybe a better way to frame it is I could see like a maybe orderly yen unwind or carry trade unwind and like a chaotic unwind. And which of those do you feel like you see coming? What do you expect to happen next in terms of trying to solve this issue?
Well, there's a couple options, right? The first is to continue with the madness that they're doing, which is what they've continued with, right? Like sell treasuries, or in this case, pledge treasuries as collateral, go out, buy a bunch of yen, try to strengthen the yen against the dollar, and then have to pay back the loan in a week, which is the term of the New York Fed, FEMA repo facility. The problem is that's expensive. they charge 25 basis points above IORB, which is sitting at 3.65%. That's the interest on reserve balances at the Fed. And so the total interest rate that they'd be paying is 3.9% for a $90 billion loan. And even though the term's only a week, obviously that's still a week. It's a lot of money. They have to pay it back. So that sort of strategy is probably, if I'm being honest, it's probably one of the more likely scenarios, because Japan, unfortunately, doesn't really have, again, a good option with letting the yen depreciate. Some yen bears say, hey, they can let it blow out. It won't really matter. Nothing will happen. Let dollar yen go to 300, right? Again, the issue with that is Japan imports 90% of their energy and 85% of their food. And for the last,
which means
20
basically the
years,
prices of everything double.
Yes.
Right.
Yeah. And for the last 20 years, right, inflation's been zero, growth has been zero, and wage growth especially has been extremely low to zero. And so the Japanese economy is essentially engineered in a way to assume that the prices of everything stay stagnant and that wages as well stay stagnant. And if you introduce a price shock like that up to that level, to an economy that's not prepared for it, you could see riots, you could see demonstrations in the streets, you could see political extremism, and the people in power at the BOJ and the LDP, the Liberal Democratic Party, which has basically ruled Japan since 1955, they don't want that to happen, right? So their main goal is to keep USD/JPY as low as possible, to keep stop the depreciation. And even though this selling treasuries thing is madness, they don't really have another choice, right? It's just what they kind of have to keep on doing. So that's what I think is the most likely scenario. But again, they could try to just take the pain and just say, you know what, let's stop with these interventions, let it blow out, let the inflation rise, and we're going to have to work as fast as we can to try to build a domestic energy and food industry here in order to sustain ourselves. Again, the issue with that is Japan doesn't have much natural resources to speak of. They have basically no natural gas. They have no oil fields to speak of, no petroleum or what's called shale oil sands. For their agriculture, they actually have a very low percent of their total land mass is arable land, meaning like farmland. A lot of it is heavily forested or mountainous rocky terrain. So that land isn't really prime for growing stuff. And the main thing that they can grow in Japan is rice, and rice is not very calorically dense, right? So you basically have this situation where their geography, their history, their culture, right? Everything has limited them in terms of their options for independence, especially in terms of food and energy. The Fukushima nuclear disaster, which you remember, there's a nuclear plant that basically melted down after a tidal wave hit it. That freaked out Japanese politicians so much in 2011 that they made a push to shut down a bunch of their nuclear reactors. So they have 55 total constructed nuclear reactors, and right now only 13 are operational. And obviously, since COVID happened, and then now especially since the Iran war, the recent administration has been pushing to reopen and turn back on some of the decommissioned nukes. There's about 22 that I read that can be turned back on, without major construction. The problem is the process of turning on a nuclear reactor takes around 3 to 5 years. So it's not like flicking a switch. It's very intense, difficult work. You have to be very careful. Obviously, so uranium nuclear reactor, you don't want to melt down. And so their energy needs are also their electricity needs are also very, precarious right now. So it's going to take years for them to start to gain their independence in terms of energy back. But long term, they're always going to be dependent on other countries, which is, by the way, that's why the Japanese Imperial Army invaded most of Southeast Asia in World War II. Is they were looking for oil. They were looking for arable land. They were looking to conquer in order to secure resources for the homeland. So it's just been a perennial anxiety for the Japanese.
What are some of the non-monetary policy drivers and factors related to this? You just cited like there's these cultural factors, historical, these sorts of things. I know age demographics are a big part of this, and I sort of wonder at the same time as you explain this, like how much of it is a chicken and the egg problem versus are these changing cultural, societal, plummeting marriage rates, fertility rates coming from a currency problem? Is the currency problem coming from these? Is it both and? Yeah. What do you think of that?
It's a good question. There was a really good Substack post made a few weeks ago called No Country for Young Men. And the post was about Japan, right? It's a really long post, but I highly recommend it if your audience wants to check out some good writing on Japan. But the post basically made the case that Japan has basically made it very difficult to be a young person, especially a young man, within the country, right? There's in many Asian countries, there's very strict and like legalistic frameworks on how to become successful, right? You have to go to law school, you have to be a doctor, you have to be an engineer, you have to follow the structured guidelines on what exactly to do and how to rise through the ranks, right? And especially in Japan, but also in Korea and China, there's a very strong insistence on honor culture, right? Somebody who's older than you, someone who's your superior, is someone that you need to listen to, even if you believe they're wrong, even if they are wrong. It's not your place to speak up. It's not your place to fight back. It's your place to shut up and listen, right? And to hammer that point home to me, Weston Nakamura, when we filmed, I have a documentary up on my YouTube channel about this, but Julian Figueroa and Isabella and I were there in March 2025. We filmed the documentary on this, and Weston was
that's super cool. I'll have to link that. They're interesting. Yeah, people in the space.
Yeah, this is a really good experience. But when we were there, Weston was telling us, he's like, if you're a Japanese, let's say corporate worker, you're an accountant, you're a financial analyst, you're a lawyer, whatever, you don't get promoted based on merit. You get promoted when the guy above you dies or retires. And if your boss makes mistakes, if your boss does things bad, you cannot speak up in any sort of meeting or public situation and criticize them. That is completely taboo, right? And this fear of like losing faces is so prevalent that the Japanese have actually created a new way of firing people, which is they don't even fire people outright. They just give an employee less and less work until they're basically doing nothing and they feel useless and they quit out of shame. Right. These are things that only would happen in Japan, right? Because of this 1,000 years of samurai honor culture, respecting elders, that's been ingrained into their society and their psyche so deeply. The problem is that creates a work environment, a business environment that's very hierarchical, very rigid, right? Weston made the great point. He said, where's the Japanese Mark Zuckerberg? Where's the Japanese Elon Musk? Where's the Japanese Jeff Bezos? It's like they don't really exist. All the Japanese have done is they've taken already existing ideas like the car or the radio or the TV, and they've made the production process and the actual end product higher quality. So they've improved the quality drastically of an already existing invention. But in terms of actual raw inventions, it's very low. Because again, their culture does not prioritize creativity or openness or breaking through barriers or breaking preconceived notions. It's all about rigid, structured following of guidelines. And so that's basically crippled them in terms of their creativity and their entrepreneurship. But it also has played to their strength in terms of manufacturing prowess. What the U.S. military does now and what U.S. defense manufacturers, auto manufacturers do now in terms of quality is only possible because of what they learned from Japan in the 70s and 80s, during the Six Sigma manufacturing improvement era. So, and many of them actually hired Japanese engineers to come and consult. Right, they're very good at that. But then that leaves their economy very structured and vulnerable, and makes it very hard for them to adapt to this ever-changing world that we're in.
It seems like that's how you would set up your culture and economy if you wanted to like completely discourage innovation, right? It's very different from the American way, and there, I think in American business perhaps there's a lack of that. I notice in how would you put it, like a cursory study of Japanese culture, there's a lot more emphasis on like taking responsibility that I feel like you wouldn't find as popular in American culture. There's a lot of finger pointing in American culture, but also too, there is this pragmatism that I think comes from like earlier American philosophy in some ways, where it's just like, if it works, you get it. If you're the guy, if you're doing it the best, like, if you're on a sports team and you're the next man up, if you're doing better than the guy who's in, you're in. It's not like, oh, this guy's been on the team longer. I think a lot of businesses are structured that way as well, where it's like, okay, if as soon as you're more productive, better, you're in there on the front lines, and so that's but I think that there, in a lot of ways, seems that our cultures are opposites to one another, and so there'd probably be a lot, like, much more benefit from the things that we could adopt from each other's cultures in that way too.
Yeah, I agree. And again, to drive this point home, there's a study of all 50 developed countries, roughly 50, in the world. Japan is second lowest in terms of entrepreneurs per capita, so startup founders per capita. The only one lower is Croatia. So think about that. Japan, which is the fourth largest economy in the world, right? GDP that is basically driven by huge manufacturing giants. It's a first world country. You go there, Tokyo is exceptionally immaculately clean, modern buildings, modern high rises, modern bullet train systems, better than anything we have in the West, and yet they have basically no entrepreneurs, no startup founders. There's no venture capital or angel investing, to speak of. And in the broader equity market too, nobody invests in stocks because there's been no growth for 34 years, right? Why would you invest in something that goes nowhere? They just invest in US stocks. And that kind of environment is, I call it like a sanitization, right? Procedure. It's almost like, ripping out all the soul and the vitality and the youth and creativity of especially the young men, which are the founders and the people who are going out and taking risks and doing big things, right? It sanitizes them to the point that they're even unable to to take those risks or do anything because the infrastructure just isn't there for them to do it. If they want to do anything big, they have to move out of Japan. They have to leave.
So you're saying in a lot of ways, in a monetary policy sense, in a cultural sense, Japan is a canary in a coal mine for us. They're relative to us in the West. They're further down this path. So I wonder what you think we could learn from them. Let's say if we were like, okay, this is where they're going. What's happened to their young men? What's happened culturally? If you were, let's say, I don't know, president of the United States or whatever, right? Like, what things would you try to do to pull us from the path? Like, what are they doing? What have they gotten wrong? And what would you try to shift so that we don't have to go as far down that path as they have?
So one of the biggest things that you need to change is this idea that busts are bad, right? That the credit bust, that the deflation is a bad thing. Hayek said it best, right? The credit boom lays the seeds for the bust. And that means that the bust is also necessary for the boom to happen in the first place, because the bust gets rid of the unnecessary projects, right? The vanity stuff, the NFTs, right? The rampant speculation on, like JPEGs of rocks, right? All this BS, right? Pardon my language, needs to be flushed out every once in a while. And Japan never allowed that to happen. And as a result, there was a study done by Bank of America that estimated that 23% of the companies on the Nikkei are zombie companies, meaning they're only surviving by 0% debt financing that's been just being rolled forward forever. So they would have collapsed back in the late 90s, early 90s. And because of 0% rates for 34 years, they just kept rolling it forward and rolling it forward and rolling it forward and rolling it forward and never actually turning the lights off and sending everyone home. And so all those people are working in unproductive jobs, doing unproductive things. And the people who made those loans and the people who run the company are too ashamed to admit that their company doesn't really do anything productive anymore. So they never call in the loan. They never declare bankruptcy. They never just let it collapse. And so,
so they're just in the business of rolling debt
over.
just
rolling debt over. So it's extremely financialized. So what I would do if I was in the West is to prevent that. You need to let businesses fail. You need to let things collapse. You need to let, when Silicon Valley Bank has gone, too over its skis on treasury bond purchases and now is in the hole for $80 billion, you need to let them die. And then those depositors will lose money. And then you tell people, be careful. audit your bank. Make sure you're not just investing in whatever, right? If Anthropic wants all these tax credits or government handouts, you tell them no. You have to survive as your own company. You're a business now. Go find customers, go create revenue. If you can't create enough revenue to offset all your expenses, you lose. That's capitalism. Sorry, this is just how the game works. You can't win if you don't allow people to lose. And that philosophy, the antithesis of that philosophy is what Japan's done for 30 years. Because nobody ever truly loses, everybody loses. And there's no growth and no escape from then on out. So what I would do is I would allow things to fail. Obviously, a ban on 0% rates, a ban on QE, those things would be hugely possible. But it's also a mentality shift, right? Like, how can we allow people to take risk and tell them that it's okay if it fails and their business goes under?
Does it seem to you like we're past the point of no return when it comes to that? When I think of in terms of where we would see big collapses, we looked at 2008, the housing market collapse. Eventually it seemed like it would be systemic, like total systemic collapse if we didn't prop that up. We have all these indicators flashing the exact same things that they're flashing in 2008, in many ways worse in 2026 in terms of the housing market. So we're primed for exactly something like that to happen, yet it seems to me that 2008 proved that they weren't willing to let that happen, and I think that stems from the fact that we would basically have, a contagion event that ultimately ends with like the total collapse of global debt markets. So does it seem like there's a possibility for that to actually happen, or do you think we're pretty guaranteed to go down the continue printing, follow the same sort of path that Japan has taken?
Obviously, we're going to go down the continue printing, kick the can down the road path. And the reason why is actually very simple. The people in control of the system, the people who actually make the decisions, have the most to lose from the system dying, from the system failing, right? They're multimillionaires, billionaires, hedge fund managers. They profit from Cantillon effects, Besant and Warsh both were former hedge fund managers. And Treasury Secretary Mnuchin under Trump also was a former hedge fund manager. All these people make money buying and selling, arbitraging, front-running retail investors, front-running other people, profiting from Cantillon effects. That's all they do. And so if you're asking somebody who's paid to continue to keep the system alive, to turn the system off or to let it fail, at least in some large part, like you said, like let's say equity markets collapse by 80%, real estate goes down by 80%, bonds basically all go to zero, all the pensions are wiped out, we all start at ground zero. Well, the person who lost, let's say 500K of equity in their home, that hurts. The person who lost 500 million, that's something, and they're already 65, that they spent their whole life, making this money either morally or immorally. They can't ever get that money and power back, right? So they have the most to lose. They do not want to lose any of it. And so they're going to,
and they're in the driver's seat.
They're in the driver's seat. They're going to continue to perpetuate the system. And this is the unfortunate truth. Like, I wish things were different, but this is just how it is. And so they're going to keep kicking the can down the road. And they're going to do whatever they can, including stealth QE, which I've written about on my Substack, in order to achieve that.
What do you think are the closest historical analogs to this present moment that we're looking at, and what happened in those situations?
Obviously, I think one of the biggest historical analogs for the U.S. where we are now is the 1920s, right?
Okay.
You look at the booming in radio stocks and railroad stocks in the early 1920s, and it very closely matches, right, what happens now. There's that famous Jesse Livermore saying. Jesse Livermore was a stock trader in the 1920s, became a multimillionaire. He said, when the shoeshine boy knows about your stock or knows about a stock, it's too late to get in. And that was because on Wall Street, like, by the time the common people knew about a stock popping off, all the gains had already been made, all the smart money was out, and it's only the dumb money that kept chasing it. And if you look at what's happening with AI stocks, you look at what's happening with semiconductors, you look at what's happening with, high tech, same story today. The one difference is this time it's an everything bubble that's funded and financed by the Federal Reserve. And the Federal Reserve needs to keep the illusion alive. And so if there is a crash, the Fed will just print money to bring it back up, right? That's what we saw during COVID. The market collapsed 30%. The Fed opens the floodgates, prints $120 billion a month of QE, changes the SLR ratio, the bank capital ratios to 0, so they have to hold no reserves against anything, and just started printing money like mad, brought interest rates to 0 as well. And so all of that floods the system, the stock market goes back up. And if this happens again, if NVIDIA collapses, if any of these, AI tech companies collapse, they'll just print the money needed because they need to perpetuate the current system in order to maintain their power.
So that sort of plays into a lot of our underlying thesis around Bitcoin, right? And in terms of that, if that is guaranteed, that's how so many of us lunatics are so damn sure about this, that we're, all in or close to all in or whatever, right? And that seems to be guaranteed to me, although I'm always trying to look for gaps in, could it go, is there a potential outcome that I could see that I haven't anticipated, essentially. But that, since that seems pretty guaranteed to me, and then since it seems like there's that problem replicated in many ways on another level, you have the dollar that's replicated on the yen, essentially. Thinking of Metaplanet, I wonder what you think of that company. Do you think that they're exceptionally positioned in terms of building a Bitcoin treasury because they kind of have that, that edge built on top of an edge? I wonder if you've been paying much attention to them and what you think of them moving forward.
Yeah, of course. The documentary we made was sponsored by Metaplanet, right?
Oh, very cool.
And the one that's on my channel is not a Metaplanet documentary, it's my own, but Julian Figueroa of Exit Manual will, I believe in September, be releasing the doc. Has been delayed a lot. There's been a lot of, things changing in Japan, so they had to update stuff, and editors have been moving around. But yeah, Metaplanet is one of the few treasury companies I think is pretty well positioned because they're the only publicly traded Japanese Bitcoin treasury company. The problem with treasury companies in general, in my opinion, is that too many of them focus more on acquiring Bitcoin than they do on their own fundamental business. And if you want to own Bitcoin, the best way to do that is just to own Bitcoin, just to buy some, put it in cold storage, right? Take it off the exchange, and
be productive, store your excess economic energy.
Exactly. Like I put out a tweet that said, I was like, radical treasury company idea, create goods and services, sell them for more than cost you to provide them, use some of that profits to buy Bitcoin, repeat. Like that's the actual genuine treasury strategy, not issuing, infinite amounts of converts, infinite amounts of equity, financial engineering. All that stuff will work in the short run. But if your company is just a Bitcoin holding vehicle, then people can just buy Bitcoin instead, because the likelihood that your company will outperform Bitcoin in the long term is basically 0.
And that's a dangerous game. That's a dangerous dance. You have some of the best in the world doing that dance right now, looking at strategy and stretch. And, it looks to me like they're pretty out of the woods this cycle, but they're playing a similar game that a lot of the central banks are playing. Yeah, it's just a dangerous game is all that is, right? And they're playing that similar game in terms of like, okay, we're having this, the values are dumping here, we need to increase our rates. But there's a dangerous dance in that. And so I think there will be a few people who do it exceptionally well and come out on the other side and they're like, we crushed it. I think there's a lot of people who would be a lot better off, a lot of companies doing exactly what you're saying, being productive, storing their excess economic energy. And I think eventually we'll end up in a place where Mark Moss, co-host of the show, he always talks about when he was, back in like 97, maybe 99 or something, he was like, I was always talking to these people about internet companies. I was buying internet stocks, and now every company's an internet company. And I think what you're saying will be like the end game of this, where it's just like, you're just a business that stores your excess economic energy in Bitcoin, and then you're not a Bitcoin treasury company. You're just everybody, using the money that everybody uses.
Well, it's that phrase from The Incredibles, right? When Syndrome, the bad guy, was revealing his plan. He's like, if everyone's a super, then no one is, right? If everyone's a Bitcoin treasury company, then no one is. And the irony of the Bitcoin treasury strategy is that it is very effective for the first movers, but as it proliferates, as more and more people copy it, it becomes less effective. And it actually becomes more of like a Trojan horse to, inject Bitcoin into companies' balance sheets rather than to just pump one specific company's stock. And actually, that's better for the ecosystem. It's better for Bitcoin as a whole. That's what we actually want to see. But it means that this Bitcoin treasury thing is not a free money printer forever. It's not an infinite, money glitch. It will work for a while. The premium above NAV will compress, eventually go to 1, and you won't get any excess return from holding any of these stocks, in my opinion. Which is why I've warned people like, hey guys, if you want to trade these things, go for it. Do it. Go have fun. I traded MSTR options back in November 2024. I made a killing. It was fun.
They're getting tempting right
It
now. I
is.
tell you what.
I believe it, man. I believe it. And I think it's actually a good play on leverage Bitcoin. But like for long-term holdings, when you're thinking about like your portfolio, your life savings, just buy Bitcoin. It's an easier, simpler version of the trade, and there's way less counterparty risk.
Yeah. Yeah. And you don't have to, I mean, just even, I've been eyeing some of those, some MicroStrategy options. I was even trying to figure out where could I buy Metaplanet options. But you have to weigh the stress cost of it as well, right? If you're ever getting into leverage games, if you're ever getting into buying options or whatever, it's like, okay, maybe even if your thesis does play out and you end up with more dollars, more Bitcoin, whatever, but you were like super stressed out for 2 years, was it worth it? You got to weigh those intangibles in that as well.
Yeah, exactly. There's like as a portion of your portfolio that can be for fun, but my rule is that if you can't sleep at night, it's too much. And so you don't want to sacrifice your health, your longevity. I've never known a trader that has made a lot of money that was consistently stressed and like, really anxious about their position. There's always a comfortable, like, moderate position that they knew had asymmetric upside. It does really well. They cash out, they feel good. Right. And hindsight's always 2020. You always could have put in more Bitcoin, more into Bitcoin in 2020 at 5,000 a coin. We could have all bought Nvidia at, $30 a share or whatever it was before it skyrocketed and split like 50 times. But that's not the world we live in. So just, be prudent, be careful. And Bitcoin, in the long run, obviously is going to go much higher. And this yen scenario is a perfect example. You look at the price of Bitcoin denominated in yen. That's a much more bullish chart than Bitcoin denominated in dollars. Like the drawdowns for the last few cycles are much lower in yen terms, and then the cycle highs are much, much higher. Because the Japanese obviously are trying to get out of their currency. The problem is there's a very high unrealized tax gain on Bitcoin in Japan, so it's hard for Japanese to own it. But if that law changes, or especially if the currency continues to devalue, even if 50% or 55% unrealized capital gains tax on Bitcoin won't be enough to deter them from buying it. And that will just drive more and more of this excess liquidity that they've built up over generations into Bitcoin, driving up the price and obviously increasing the adoption in Asia.
Do you ever think much about the fact that the creator of Bitcoin's name was a Japanese name, Satoshi Nakamoto? Do you think there's any like important relevance to this? Do you think that they saw the canary in the coal mine in terms of Japan, that there was any, it seems that they were like a native English speaker from my review of the emails that we assume sent and those sorts of things. But yeah, do you ever think much about that or think there's any important correlation there?
It's hard to say. I mean, part of me wants to say yes, that, Satoshi saw that Japan was the canary in the coal mine. It was the, monetary experiment proving ground. Like naming it a Japanese name is like the perfect, like, screw you to the central bankers, because nowhere have the central bankers run more amok than in Japan, right? Like we said, 0% interest rates in 1999, QE in March 2001, basically suppressing growth, suppressing volatility, suppressing any sort of, debt default for 34 years, zombifying the entire economy, emasculating millions of young men, not allowing them to find jobs or create businesses or do anything, which just destroys your, future generations. All of that points to the fact that he could have known all this. The other idea is that, he just simply wanted a name that wouldn't tie back to him. And as you're right, like the emails I've read, it looks like he's a native English speaker, but also British in terms of his accent. The way he spells certain words, like color, is the proper British spelling. So if he was British and he wants to throw people off as to who he is, he would name himself a Japanese.
Or maybe from a British colony or something like that.
Potentially.
So, people
Potentially. Just wants to throw people off. So it's hard to know exactly the intention behind it. Either way, Bitcoin's still the same, and it's still an option to, opt out of the fiat system.
Yeah, so I find speculating about Satoshi's identities, somewhat fun to do in private circles, but at other times I feel like it's sort of done in bad taste publicly, because there was clearly this desire for anonymity, and if you are like grateful for the gift of Bitcoin to many people, to humanity, then maybe it's maybe you're better off not speculating. But it's fun sometimes. Sometimes I wonder, I pick up some patterns and go, maybe it's this guy, maybe it's that guy, who knows?
Well, I can tell you, I don't think it's Craig Wright.
I can tell you, I don't think it's Craig Wright. That
Yeah.
sounds right.
Yeah,
I'm with
yeah.
you there.
But the beauty of Bitcoin, and one of the things I love about this space, is that it honestly doesn't matter who it is. It doesn't
Mhm.
matter if it was a group of people. It doesn't matter if it was 4 guys in a basement. It doesn't matter if it was one lone genius. It doesn't matter even if it was Hal Finney, right? Just sending emails to himself. Doesn't matter, because the virus has been released, right? The anti-fiat virus has been put out into the wild. The code is open source, right? Everyone can run it. Everyone can audit it. Everyone can check the blockchain and see who has made transactions, when they settled, how they settled, how many confirmations they are. It's all public, right? It's the most auditable financial system in the history of the world, which is pretty extraordinary. So that kind of a cat can't be put back in the bag. And so even if Satoshi's still alive today, even if he sells his coins, even if he's dead, right? If it was Hal Finney, and now obviously he passed away from, was it ALS or Lou Gehrig's disease in 2014, it's over, right? It doesn't matter. The creation of Bitcoin has already been done, and that can't be, rolled back. So I think what's best for us as Bitcoiners is to focus on what do we do moving forward, right? How do we increase adoption? How do we increase education and get people to, understand the problems of our fiat system? And nowhere are they more prevalent than in Japan.
What does adoption look like on the grounds? You were talking about how in Japan, from your time you spent there, like, I know you spent some time in South America. El Salvador is kind of one of the leaders in terms of this, but there's been mixed responses in terms of some people get really into it, right? But some people just don't have the time. I know, you were talking about the capital gains rates on Bitcoin changing there. When you were over there, is it similar to the West and the US? Is there more interest? What are you seeing?
So in like 2013, I believe, Japan actually legalized cryptocurrency for payments, including Bitcoin. So Bitcoin's actually been an approved method of payment for most merchants in Japan since 2013. The problem is adoption still remains pretty low, right? And again, that was because up until 2022, 2023, the yen basically was pegged at 100 to the dollar, and it fluctuated only by like 10 or 15% every decade. So it really didn't go anywhere. And because prices...
There's a chart I saw this morning. I'll have my editor toss it up here, but it's been on an exponential since then. It was pretty stable for quite some time, and then it's just ripping since.
Well, yeah, because again, 2022, look at March of 2022, that's when the Fed starts the hiking cycle, the fastest hiking cycle since Volcker. Japan was pegged at 0. Right? So what happens when Japan's at 0 and the Fed's hiking 50 bips every single meeting for, 8 meetings straight? Well, you get a 400, 500 basis point differential in interest rates. And the other thing is that because Japan hadn't moved rates in so long, that also cuts out the volatility on the funding leg, right? Because as a carry trader, you're borrowing in yen, but you're also worried about like the cost of borrowing going up. Well, in Japan, the cost of borrowing hadn't gone up for, again, 34 years, since 1998, 99. So what do? You lever up as much as you can. And that's exactly what happened. The carry trade, ballooned to trillions and trillions of dollars in 2022 and just started putting massive amounts of pressure on the currency. And, until you resolve that differential in interest rates between the US and Japan, that that story doesn't go away. And like we said, it's very hard to lower it from the Japan side, because to lower that spread from the Japan side requires hikes. They've already hiked to the highest since like 1995 at 1%, right? An astounding 1%. And that hasn't really put enough of a dent in the market to impact anything. And the way to cut it from the other side, right? Oh, and hiking further from there would cause interest rates to blow out, interest expense to blow out across Japan, both in the public sector and in the private sector, by the way, because the private sector is at 120% debt to GDP, so very high private sector debt as well. If you go to on the other side of the ocean, right, the U.S., they have to lower rates. Well, the May CPI was 4.2, and the June just came in at 3.5, both hot inflation readings. We just had a hold at the last FOMC with 3 FOMC governors dissenting to hike, not to cut.
Right.
So
right.
Warsh is, running a new Fed that is basically wanting to hike more, not cut, because of inflationary pressure from the war. Japan can't hike, so how do you lower that gap? You don't. So the problem, you can't resolve it. It's an unfixable problem. And so that will just cause USDJPY to continue to devalue and to test the limits of the BOJ, every few months, until something meaningfully changes.
What assets do you think? So we're thinking maybe $2 to $4 trillion are wrapped up in the yen carry trade. Wrapped up where? Like what assets do you think this borrowed money are mainly flowing into? And then assuming there was an unwind, like where do we think we would see that capital flow back out of?
U.S. equities and U.S. government bonds are the main ones, but also U.S. corporate bonds, and then foreign government bonds. So British gilts, French BEGs, German bunds, Italian bonds. Because again, Japan, in a rate of 0%, 0% interest rate, interest yield, anything looks great. Anything looks good. When your funding cost is nothing, or your return that you could get for lending is nothing, a 4% yield in France is amazing. So the Japanese went out and bought debt all around the world. And as a matter of fact, they're basically the largest lender to every single country in the G7. And I think the only exception is Italy, but they're like the second or third largest lender. Like they're the largest for the US, for Canada, for England, for France, for Germany. They're a huge lender. And so an unwind of the carry trade means a selling of all those assets. And we obviously already have a template for this. August 5th of 2024. That's when the day after that is when I wrote that thread that got 2.5 million views. That day, or leading up to that day, Japan had basically done an emergency rate hike, right? And the Fed had a very, very dovish meeting and promised to bring down rates, which would lower that spread that we talked about that funds the carry trade. Carry traders started to get worried, and within 24 hours, the Nikkei collapsed by 12% because carry traders sold Japanese denominated assets to raise yen, to pay off yen loans, and then the Nasdaq and S&P both fell like 4 or 5% intraday, and kept falling for a couple days afterwards, slightly, before they rebounded and came back. So total move was several $1 trillion in market cap lost across multiple indices, and that means that, like, if this trade were to unwind in size over long periods of time, U.S. equities especially, but also U.S. corporate bonds and U.S. government bonds would be really hard hit, because those have basically relied on the yen carry trade for a large position of their funding, of the purchasing for the last, let's say, 20 years.
And the government bonds piece of that brings in that's where the nothing stops the strain argument comes from, right? Because if there's massive selling pressure there, the buyer becomes the Fed. The buyer becomes the United States government printing a bunch of money to cover that, so the whole thing doesn't collapse. So doesn't seem like there's many ways out of this. It seems like there's one expected way out of this.
Exactly. And that last thing you brought up is also exactly why the Fed has been so keen to help Japan. I mean, Besant said that in that famous Sunday tweet. He said, "This is just what allies do for each other." No, it's not. Spending $5 to $10 billion just to help out a friend, that's crazy. That's not something you just do for anybody. That's something you do when you're scared that the Japanese will dump their treasury holdings to raise dollars, and that will spike U.S. Treasury yields by, let's say 1 to 2% at a minimum. That kind of a terror is enough to make the Treasury and the Fed move. And to maintain the stability of the bond market is basically like their unspoken priority, right? That's their hidden mandate, is to keep the system running, keep the auctions flowing, keep the cash flowing into the government coffers so that they can continue to operate. And Japan selling that amount of treasuries, especially if it was, on a low liquidity day, would be disastrous for the U.S. So as a result, that's why we opened the FEMA repo facility. That's why we did the $5 to $10 billion of euros that we sold to buy yen, right? That's why they've pledged to potentially even expand and upgrade the facility, upscale it, so that they can do more and more, FEMA repo transactions, like repo loans to Japan, to continually lend them more and more cash so they can just keep bailing themselves out. All those are just indications that the U.S. itself is also getting desperate to help Japan because they're worried about what happens if they don't.
So what are you looking out for, let's say, in the next 6 to 12 months? What things are you looking for / expecting from the Bank of Japan and the U.S. in terms of continued intervention? And then first that, and then maybe after that, like, how is that affecting your personal investing strategies for the next, let's say 6 to 12 month range, and maybe with a specific attention put towards Bitcoin strategies as well?
Sure, absolutely. So next 6 to 12 months for the Bank of Japan, there's definitely pressure for the BOJ to continue to hike rates, mainly because of the inflationary pressures from the Iran war that are starting to bubble up in Japanese CPI, which has now been above 2% for I think 52 consecutive months or something like that. It's like the longest time within, the last, again, 35 years that they've had high inflation for a consistent period of time. There's expectation that they will start to, hike meaningfully again, and try to do so in a way that they can hike and then bring it back down before the carry trade really starts to unwind it to hurt U.S. assets, and before the interest expense problem emerges, right? Because hiking rates to, let's say, 2% for 1 or 2 meetings for a quarter or two, and then bringing them back down is one thing. Hiking them there and keeping them there and letting more and more of the debt revalue at that rate is really, really unsustainable. That's probably most likely for Japan, maybe 1 or 2 more rate hikes, and then trying to keep, bring it down. What they're really trying to do is they're trying to wait out the U.S. cutting cycle. They know that if the U.S. really cuts meaningfully and starts easing meaningfully, that flood of dollar liquidity and that cheapening of interest rates in the U.S. will alleviate a lot of the pressure. Not all of it, obviously, but some of it. And that will help, because right now they've been running into a worsening situation where more and more yen buybacks, more and more of these yen interventions have had less and less of an effect every single time. The effectiveness of the interventions right now in 2026 is about half as much as it was back in 2024. And so that just should give you an idea of the scale. Like $20 or $40 billion back then could move you, from 160 to 153. And now that same amount of money moves you to 157. So it moves you half as far. Instead of 3 yen, or instead of 7 yen drop, it's a 3 yen drop.
It's so funny how there's just these currency games that have been played for so long. Swap out one currency with another, swap out, we're going to print more, we're going to pull more out of circulation, blah, blah, blah. And it's so fascinating to watch this economic constant be introduced through it all, which is Bitcoin, which is just like, there's no, it's playing in this game, but there's no supply fluctuations. So there is this this is where Bitcoin has come to this source of truth, this economic truth in that game. It's so funny because it's just such a convoluted game to hear you talk about like 2022, 24, 26. This is what they're doing. And all throughout this time, you have this constant predictable variable in there, which will be really interesting to watch as things get more and more chaotic as well.
Yeah, absolutely. No, that's definitely true. And the currency fluctuations are just crazy because they're so arbitrary, right? There's no real reason why it should be 150 or 160. It's just the amount of yen they printed. And if they print more, it'll be 200. If they print more, it'll be 400, right? It's just the nature of how things are. But for me, like directional trades, I've been short USD JPY for 3 years now, basically, which has been a great trade. Obviously, like borrowing yen and buying dollars has been a really good idea. And especially when your funding costs are near zero. You can do so on Interactive Brokers, actually, by setting up a foreign exchange account. And actually have a PDF in my link tree, I think, that's like $70 that people can. It teaches you how to do the yen carry trade yourself as a retail investor in the US or in the EU or Canada. So people want to learn how to do that. You can go check that out. But directionally, obviously short USD JPY, but long US equities and I would say like gold, Bitcoin, any debasement trades. So anything that would benefit from the carry trade continuing to be put on, I keep those in my portfolio. The reason why is, again, I don't believe the carry trade unwind can happen without major things changing systemically in both Japan and the US. And since that's not changing anytime soon, since the Fed's not cutting tomorrow, and since the BOJ is not hiking to 3.5% tomorrow, I'm going to keep the trade on. I'm going to keep holding US equities, US tech stocks, and US ETFs, as well as majority of my money, which is in Bitcoin.
Do you have any strong expectations for Warsh and the Fed for, let's say, the remainder of this year up until the midterms, which are pretty soon, actually, and then maybe the remainder of the Trump administration?
I think Warsh is going, because, well, Warsh has a difficult problem, right? Which is he's trying to do this balancing act of lowering interest rates and not increasing the balance sheet, which normally that's functionally impossible, right? Easing means a lowering of interest rates and an increase in the balance sheet, and tightening means a hiring of interest rates, right? Or an increase in interest rates and a lowering of the balance sheet. So he's trying to do two combating monetary, halves of the same of a different monetary policies at the same time, which is very, very hard to do. Now, can you do it temporarily? Sure, right? You can set the policy rate lower and lower, and then you can, continue to acquire bonds or do reserve management purchases, right? Which is what they've been doing since December 2025. But long term, it's untenable. Long term, I don't think you can do it. But what Warsh's main goal is obviously to maintain systemic stability, keep markets going up, but also keep inflation at bay. And so as a result, I think what he's going to do is keep the reserve management purchases, so the RMPs, keep buying, $10-20 billion a month, or increasing the balance sheet by that much, buying treasury bonds, doing, helping to basically offlay, especially the longer tenor bonds. And then he's also going to most likely hold rates for, I would say, maybe the next meeting or two. I mean, even with these dissensions hiking rates, he was obviously a stay. Unless inflation gets really high, I don't really see him hiking, especially with how high our interest expense is already. I think he's probably going to hold rates for a few meetings and then finally try to bring it down once inflation has cooled off. But I think the main worry that the Trump admin has, and the other people who are gearing up for these midterm elections, is that you need to keep the American consumer happy, and the way you do that is by keeping energy and food prices low, and that's hard to do when you're trying to fight a war in the Middle East, next to the largest, basically oil and gas choke point, trade choke point in the world. So you can't have your cake and eat it too. And so the next best thing you can do is try to stem the bleeding from the other side, which is to keep rates where they are, right? Keep them artificially high just because you want to stem inflation.
Yeah, that makes sense. Yeah, it doesn't seem like we're going to have any real meaningful progress on the inflation front until we can figure out how to wrap up this conflict in Iran. And that's like, hopefully sooner rather than later, man. It's been going on plenty long, if you ask me. I wonder.
Keeps ending
Go
and
ahead.
restarting, man. It's like it's ridiculous. It's like
it's happened like 25 times.
it's like
30
Groundhog
times.
Day. It's like the war's over. No, it's not. We're starting it again. Oh wait, no, we got a peace deal. No, it's not. And the stock market has just been a roller coaster since then.
Yeah, it's a total boy who cried wolf sort of situation now where you hear it. I hear it now and it's just like nobody believes it. When it finally ends, it's not going to settle in for months because everyone's going to be waiting for it to start again, I feel like. Is there any, you sent me some great articles I was looking over before we started in your Substack. Is there any key points from any of those that we haven't touched on that you'd like to refer to? Anything we missed?
I think we hit a lot of the main ones. I mean, yeah, I would just say like Japan is truly like that meme that Japan is the canary in the coal mine is true in many more ways than people realize. And my concern is that that sort of financial repression, that sort of like inability to allow actual busts to take place and deflation to take place and the system to reset is what is going to be rolled out in the West in the next 20, 30 years, right? There was already proposals by the ECB and by others to basically create a digital euro and peg everyone's interest rate at zero or even negative rates, so you're forced to spend it, and then that continues to circulate it in the economy. All these things will be tried in Japan first before they're rolled out, and so just keep paying attention to it, and keep being aware that this is unfortunately this is like our harbinger, right? Our canary. This is like the future of the US. If we don't change things, we will face all the same problems that Japan is facing now.
Yeah, well, we'll link your X account. We'll link your Substack underneath. You've been a great resource for me, just staying on the loop on this. It's been a constant, important variable in global markets from the past couple of years since you really started focusing on it. And I'll be keeping an eye on that. It's good to have an expert like you just to be able to keep me in the loop on it and everything. So yeah, appreciate that. Where can people find you besides Substack, X? Is there anything else you'd like to refer people to so they can stay in touch with your work?
Of course, my YouTube actually. So I had a YouTube channel for a few years, didn't really know YouTube strategy, didn't understand how to do it. November 2025 rolled around and I deleted my old channel, restarted from the ground up, brand new YouTube videos, macro breakdowns, like market, basically like market analysis. And actually recently we've decided to full-time pivot to Japan only content. So if you're interested in Japan macro, if you're interested in what the BOJ is doing, what their forecast is for the next meeting, what's going to happen with the yen, are they going to do more yen interventions? I want to be covering all of that on my YouTube channel, which is called Peruvian Bull. And my documentary about the yen is there as well. It's called Something Big Just Broke in Japan. You can search that up on YouTube and you'll find me.
Awesome. And we'll send you a collab link as well, so you can just click right around there and you'll be able to subscribe.
Sweet.
Thanks for coming on, man. This is super cool. Yeah, I appreciate your input, and it's always good to chat.
Of course. Thanks for having me, Jake. I really appreciate it.
If you're not at the table, you're on the damn menu. I think we're pretty spoiled right now. We may find out very soon what it's like to be on the other side, and I don't think we're gonna like it very much.
I've got questions lined up for these gentlemen, but first I want to ask them about maybe the bigger question, which is that when we think about Bitcoin, it's decentralized, it's permissionless. The ethos of Bitcoin is very independent. Some would even say libertarian, and they think it's Bitcoin versus the state. So what are we doing up here on a panel, kind of getting into the weeds on what DC is doing? How do you push back on that cynicism and that nihilism about today's politics? So we'll start with Stephen. And feel free to introduce yourself.
Yeah, Stephen Pollock, Signal Ridge Partners. We're a consulting firm, works with Bitcoin businesses. Before that, was at Bitcoin Policy Institute for a while. And before that, I ran campaigns, state, local, national, all over the country in issue advocacy. So to tee that up, why should we not be cynical? Great one to start with here, Pierre. So I would say, I think I am cynical, first of all, and that's why we should be involved. The reason we should be involved in national politics, or we should worry about what's happening with Bitcoin on Capitol Hill, and this is a conversation I've had with tons of people outside of corporate Bitcoin, hardcore Bitcoiners, everyone across the spectrum there. The reality is that if you're not at the table, you're on the damn menu. And so I think we're pretty spoiled right now. I think we're fortunate. And there's some people here in this room, in the room next to us adjoining, that I think we have to thank for that. However, I think and we can get in this later, we may find out very soon what it's like to be on the other side. And I don't think we're gonna like it very much.
Good afternoon, everybody. Steve Baum, Managing Director at CBiz. I head up the crypto division at CBiz. We're the 7th largest accounting and audit firm in the country. I focus primarily on helping companies get to the public markets that have digital asset businesses. So the question, I'm not in politics, right? So I'm more on the compliance side. But when you talk about the kind of last 15 years of Bitcoin, we look at revolutions, right? And how do revolutions start? And whether it's this technology, blockchain technology, or how the internet started, it's always people pushing for the next level of innovation. And I think when that began, you had this libertarian view of Bitcoin as this free money and something that would be outside the government's control. But then over the last 15 years, I think that the technology became so strong that people started to realize that this type of tech actually is so innovative to be used in financial institutions that it had to have some sort of oversight by government. And that shift has pushed people out of the industry, but also has brought a lot of new faces in. So I think overall it's a good thing, because this technology is going to get broader as we kind of see it evolve over the next decade or so.
Paul Tarantino with Byte Federal. We are a Bitcoin-centered fintech platform. We have 2 different divisions. One that is our retail on-ramp through our kiosk network, so Cash for Bitcoin. And then our other, which is payment processing. We just launched the very first US regulated casino transaction in Vegas with Circa. So we are funding bets in the casino with Bitcoin. To answer your question, I'm probably the least political person on this panel, but I have also been impacted by it directly with our business. So we definitely have some opinions. But I got into Bitcoin because I believed it was a tool to really fix a lot of the problems that we saw with this combination of the political and financial mechanisms of the world. So Bitcoin, from that libertarian perspective, was for us a way to solve or heal what we long perceived as a lot of deep problems within those 2 systems. So the adoption of Bitcoin at the larger scale, both Wall Street and government, is a double-edged sword, because we came to this with these sort of idealistic goals in mind, and the political process is obviously a negotiation that will continue for some time. And so I think that we sort of struggle with that internally. We want it to be done right, and that fight to get a proper policy crafted it has been challenging and difficult, I think, for all of us to achieve.
Excellent answers. I'll give my own answer, which was my experience with Bitcoin mining in Texas, where we saw legislators who were opposed to Bitcoin mining, and by a process of engagement and education, they actually changed their views. And so as much of the cynicism there is out there about politics, I actually came away with that almost idealistic. Maybe I was in ideal circumstances to have that experience. But now, Stephen, we saw the Genius Act for stablecoins kind of sail through, seemingly, because they want to finance the deficit. So let's get back to cynicism. But it seems like the Clarity Act is kind of stuck in some mud here. The odds online are saying 50-50. Depends which website you check. What's the sentiment like in DC around the Clarity Act, and why should we care?
Yeah, big question. First of all, legislation, clarity, ARMA, whatever. I don't know. I don't know what's going to happen. I don't think anybody knows. Maybe somebody out there, if you know what's going to happen, I'd love for you to raise your hand. But I love that it's a coin flip on Kalshi right now. And I think that what I'm more interested in, obviously it'd be great to get something done. I think we have 5 weeks is what they're saying, right? And I think the question behind that is really about the House and the 82-18 odds that we're seeing on the House flipping. Because I think where we're at is we're on the cusp. Some would say we're almost there. Some would say we may be there soon. And some would say that we're now, which I would probably say we're there now in the midst of crisis as an industry. As far as, Bitcoin's down. I'm not talking about that. I'm talking about the political realities. And I think we also have a massive opportunity. And so if you don't mind, unpack that a little bit. The crisis is that, well, first of all, we have Senator Ammous, who's been phenomenal. Senators like Senator Blackburn, Tennessee, let's go. They're about to be gone. And I don't know if any other senators really could have pulled off what they have with clarity, with market structure, because they've been there a long time. They have seasoned staff, and they've sort of danced through the hula hoops to still give this a chance. It's still at 50-50, which is unbelievable, because it really doesn't feel like it should be a 50-50. It feels like it, and so they're going to be gone soon. And I don't think there's any heir apparent. There's people who, we have fans in the Senate and in Congress, but I don't know if we'll ever have another Senator Ammous. I mean, maybe. I hope so, but we may not.
She's a one of a kind.
She's one of a kind, and so that's about to be over with. We're going to lose the House, apparently, right? It's 80% odds the Republicans lose the House, and I say we because the Republicans have been the ones who are supporting us and dragging us all of this forward. And so, we've got a massive opportunity that's about to be, the window's about to be closed. And on the other side of that, you're going to have a Maxine Waters on the House Financial Services Committee, dragging everybody in front of the committee and embarrassing them on national television. So yeah, it's a little bit of a crisis, but I think the opportunity here is that there's still a 20% odds that the Republicans keep the House. And I think that there's a lot that we can do. There's a lot that has been done. Are you guys familiar with there's this thing we used to have. I'm from Southwest Missouri, like 30 minutes away at this small high school. This guy grew up, went to school there. His name was Brad Pitt. And we had this thing we called the Brad Pitt rule, which is basically if you ask someone out on a date and she makes up some reason or says some reason she can't do it, and you're like, I don't know. You're like, well, if you were Brad Pitt, would she say the same thing? And if the answer is no, then she's just not that into you anymore, or not into you at all, right? And I think what we need to realize is, as an industry, we're no longer Brad Pitt. If we ever were, we're not now. And AI is Brad Pitt. And our mining companies are going to AI, and our Bitcoin Policy Institute, which I was at for 4 years, their new summit's about AI, and I think it's fantastic. I think it's smart. It makes sense. But I think we need to realize we're no longer Brad Pitt. And so if you're not Brad Pitt, what do you need to do? You need to figure out how to impress this girl. And so I think at the midterms, we have an opportunity to impress her. And I don't think we're doing enough yet, but we can talk about it more. I don't want to dominate the time, but I think there's some, Nick Begich, for instance, is a fantastic advocate for us in the House, and I think we need to do more to support him. Anyone in this room, anyone out there who hasn't maxed out, them, their wife, their dog, probably needs to do so. And I doubt that we're doing those sorts of things. And anyway. Yeah.
He's representing Alaska, is that right?
Yeah, he's in Alaska. Yeah, but he's essentially solely responsible for ARMA.
Yeah. Tell us what ARMA is and kind of what the impact of that legislation would be for the reserve.
Well, yeah, I mean, U.S. government buying a lot of Bitcoin and holding on to it for 20 years is, that'd be phenomenal. I think it's the top of my list. I think it should be the top of most of our list. I think it's a stretch, but I think it's great. So, I think Lund, we have advocates in the House side that we need to take care of, and I'm not sure that we're doing it.
Yeah. Now, Paul, let's shift gears to Bitcoin ATMs, not the at-the-market offerings, but the automated teller machines, the hardware. This administration has been pushing back on issues around fraud. Our vice president himself is in charge of this anti-fraud task force. I've seen headlines of fraud busts abroad, like in Thailand or Cambodia, where these call centers are defrauding people, sometimes using Bitcoin ATMs. And so can you kind of get into kind of what the landscape is there and what the legislative and regulatory pitfalls are and what is kind of legitimate in terms of making sure that we go after the bad guys?
Yeah, sure. Thank you. The Bitcoin ATM space, a lot of people may not be aware of this, is been under a misinformation attack that I think is pretty akin to what you went through with mining. I'm not going to sit here and fool anybody that we do have some bad operators in the space, but there are a number of us which we consider best-in-class operators that go way above and beyond what's required by law to legally operate, because we want to stop fraud before it takes place at our ATMs. But the state legislators specifically have been led down a path that the Bitcoin ATM companies themselves are the fraudsters. That's simply not the case. As you mentioned, the vast majority of this high dollar fraud starts in the telecom and voice over IP industry, where you could get a phone number for $100 and very light due diligence. They have a protocol in place called the Stir-Shaken protocol, where they're ranking these calls on legitimacy. But the fact of the matter is that the highest rated calls make up 48% of the fraud. So they just don't do enough. And the FCC's filed about $208 million in fines and collected $7,000. So way to go. That being said, that architecture of fraud does not just affect ATMs. There was well over 200 and something billion of fraud last year just in the banking system, all starting from those calls. The ATM industry is about 247 million last year. So we're a very small drop in the bucket of total online fraud. And if you look at this fraud, it's not just hitting the banks, it's also Zelle, PayPal, gift cards, credit card fraud, ACH, wires, you name it. It's across the system, and it's growing at about a pace of about 25% a year because of the AI. So the attack on the Bitcoin ATM industry in specific is really misguided because they don't take the time to understand that not all operators are created equal. We have a number of protocols in place inside our terminal that are sorting out and confusing people that are being coached, so we can find out if they're not reading our terms of service, if they're not properly addressing the fraud questionnaires that we have built into our terminal. And everybody over 60 is getting a live phone call from a trained US customer support staff to specifically verify that they're doing this transaction for their own investment purposes and that they're not being coached or being sent to the ATM in order to make a payment to somebody. That's all on top of full KYC, BSA compliance, AML, SARS, CTRs, on-chain analytics, verifying your wallet, tracking your money after you've bought it. All of this is to say that the ATM bans that are taking place across the United States right now, we have Minnesota is banned, Tennessee is banned, and Tennessee actually made it illegal to actually even own a machine if it's off, right? You can't even have it on your premise even if it's turned off. You can go to jail for that now. And then, we have a bunch of pseudo bans where they've restricted the operational profitability to the point that it just was not profitable to operate. So we have been, like you, through the mining debacle, have been trying to educate lawmakers. We've combined with two other operators in the space. We just had a great call with Durbin's staff. We're trying to make sure that they understand there's a right way to do this business so they can preserve access for the 26 million and underbanked Americans that need it. This is the group that's underserved, that suffers most from inflation. That's the primary customer for the ATM industry, and we want to preserve access. So that's crucial that we get in front of these people and we have time to educate them. They're passing laws without understanding the way the network works. They're passing laws without understanding all the protocols that are in place voluntarily in order to prevent fraud. And frankly, we have a much lower rate of fraud taking place on the ATMs because of our protocols than any other part of the financial ecosystem.
All right. So I will continue not answering my phone calls because it's fraud.
52.8 billion calls, robocalls last year in the US.
That's crazy. I feel like half of them went to my phone. Steve, all right, let's kind of go on to a rosier topic. Although with the Bitcoin price doing what it is, it's not that rosier. I put on my red tie today because we're down. Fair value accounting. So it used to be the case that you could only write Bitcoin down on your balance sheet. Now you can write it up, hypothetically, in the future. So that was removing a major obstacle for corporate Bitcoin adoption. What now do you see as kind of the obstacles you're encountering with your practice, or is everything kind of streamlined compared to other assets?
Look, I mean, we'll talk a little bit about accounting, and I could talk about the ATMs, or I could talk about the Clarity Act as well. Obviously, the ASU that got passed a few years ago allows you to now mark-to-market digital assets, all digital assets, including Bitcoin. That was a big change because the financial reporting that you saw of public companies, specifically 10Ks, 10Qs, didn't represent the true value of those assets because you would have to drive them down to cost and you wouldn't be able to remark them if the price recovered. It doesn't have that big of an impact overall because most investment vehicles require fair value accounting regardless. So it really didn't have a huge impact except if you were really just a public company that wanted to report digital asset holdings. So we see that change now, simplifies the accounting, but does it really change much? I don't necessarily think so. It just gives a little bit of a better picture of the fair value of those coins. Now, some of the bigger topics probably are around revenue recognition. If you're, taking Bitcoin, doing different strategies, whether it's covered call strategies or if you're mining Bitcoin, they're still dealing with how do we report this properly from a rev rec perspective. And I think there's a lot of diversity in practice that continues to be there with digital asset transactions that generate revenue or income streams. It's an area we see typically that the SEC is pretty involved in, as well as the PCAOB, which is the oversight committee for public accounting firms.
All right. Now we're running short on time, so I'm going to try to kind of provide a wrap-up question. Stephen, how should people really get engaged? We've got these midterms coming up. The primaries were very interesting in their results. We could lose the House. What do you think the Bitcoin community should be doing more of and less of as they engage with politics?
Sure. I think simple. Double down, triple down on your winners. So Nick Begich, like I said before, Zach Nunn, max out to these guys. Call up the NRCC. Say, hey, put me in, coach. As an industry, or you individually, we should call the NRCC and say, what can we do to help? And then, engage, grassroots, ground and pound. Top down's not going to work. We're going to have to, really roll up our sleeves and do what many have done before us and learn what it's like to really engage, like at a local, state level, congressional district level in the upcoming midterms.
Yeah, and that's something I've seen in Texas is that we've got the Texas Blockchain Council, which has been really effective in engaging at the state level. So I'd also encourage people to find their tribe, find the people around them that are working on these issues. And Paul, do you think the Bitcoin ATM kind of outlook is that going to be an opportunity to orange pill more politicians, or at this point is it really just damage control?
It's a little bit of both. I mean, the educational process through the meetings that we're having with the state lawmakers has really lit the light bulb for a lot of people, right? It's sort of split. It's those that are not taking the time to understand, and then the others that really dig into our fraud protocols that instantly a light goes off and we commonly hear, how come I haven't heard of this before? and then they want to share it. So we are having traction in regards to that educational process, both stopping further damage, and also they're now starting to think like, I can re-implement new legislation in the future that addresses this in a way that's pro-consumer and pro-business and eliminates fraud. So I do think we're having a good impact. I'll just leave you all with this. If you're interested, you can go to bytefederal.com/fraud-prevention. You can see the architecture of scams that affects the entire financial industry and exactly what we're doing to prevent it. You can also find a petition there that you can sign to preserve access to Bitcoin ATMs for people that so desire it. So yeah, I guess I'll leave it there.
Great. Well, thank you to our panelists, and thank you to the Bitcoin for Corporations team for organizing this symposium. So yeah, well, also, I want to make a shout out for the Bitcoin for Corporations show. We've got a podcast and YouTube that everyone should go check out and subscribe, including some conversation with Paul on this topic. So thank you all and have a great afternoon.
Thanks, Pierre.
Welcome. This is BFC in NYC, the premier institutional Bitcoin adoption event. We are here with over 300 decision makers from across the industry. We're excited to welcome you, and let's get into it. So the people in the room are what makes today an incredible event. The top companies who are allocating Bitcoin to their balance sheet and leveraging Bitcoin to run their businesses are all in the room, having conversations and making deals happen. All the decision makers from across the Bitcoin ecosystem who have anything to do with corporate adoption, institutional adoption, are in the room here at BFC in NYC. Thanks for coming, and we hope you enjoyed the event. We'll see you in Hong Kong.
I think commitments to not sell Bitcoin is actually not valuable, it has negative value. You've had this option, now you've, by your own actions, decided, okay, I no longer have this option. You're kind of cutting off some of your own limbs, cutting off your own resources.
Welcome to the Bitcoin for Corporations show. I'm your host, Pierre Richard, and today we're joined by Allard Peng, research analyst at Bitcoin for Corporations. Welcome to the show, Allard. Good to have you back on. All right, so you put out a research report recently. We want to get into that and kind of get your observations on what is currently going on in the capital markets and kind of the macro environment in which we find ourselves and of course, Bitcoin's price action. So yeah, you want to kick it off by kind of diving into the research report you put out and kind of what your motivation was for putting that together and what your findings were.
Yeah, sure. So the report went out like end of June. It's called Quant Framework for Digital Credit Risk. The main thing I was trying to do was kind of educate the space on how to think about digital credit risk from a quantitative perspective. I think there's a lot of frameworks out there for looking at these assets, and they're obviously a very new asset class as well. So just being able to like quantify that risk using objective metrics, I think, is an important contribution to the discourse. So just to kind of get into it, like the main thing I'm starting off from is the concept of BTC rating, right? So this is something that I think has been introduced for should be about a year now, since like Strike came around and Strife, and then Strategy came out with the BTC rating and a bunch of other frameworks, right? They have their credit dashboard that kind of goes from BTC rating into BTC risk and BTC credit. So starting off from that, and I think the unique approach that I'm taking towards this is I'm saying that like the BTC rating could be thought of as a starting point for measuring the Bitcoin risk. And then from there, you can actually use the Bitcoin, or rather specifically for this paper, the Bitcoin ETF option markets to quantify that risk. So this is largely what the paper goes through, the methodology behind doing that, and behind like chopping up the risk premium that these digital credit instruments pay you into the different risks that you're exposed to. So like that would be what you're compensated for, right? Like the type of risk that you're compensated for, and that becomes your return. So that's kind of what the paper does. And yeah, it's just meant for, it could be allocators, it could be investors, it could be just anyone who's interested in digital credit and Bitcoin-backed credit markets, to just give a quantitative framework for looking at it objectively.
Yeah, it's really interesting. We've seen in the discourse a lot of, among the critics of Bitcoin treasury companies, suggesting that the equity should trade at a discount because of all the risks associated with that equity position in the common stock. Do you agree, kind of on a not on a day-to-day basis, but from a valuation kind of theoretical perspective, should the common stock be trading at a discount or a premium for a company that's amplified Bitcoin?
Yeah, I think in general, like if we were to look at it from just raw valuation, if it got to a discount, I would say like you have a bit of a margin of safety there. And if it got to a premium, then I would say like this is probably, like I think some premium is more likely to be fair value. That being said, like the way I view the common equity of, I'll just call them pure play Bitcoin treasury companies that like don't really have a meaningful operating business, but they actively engage with the capital markets to grow Bitcoin per share. Let's call that like the core goal. So I think if you were to look at the common equity of this type of enterprise, you should think of the common equity as a call option on the underlying Bitcoin stack, right? And I think so it's kind of like a Bitcoin call option that is perpetual in its duration. And if we were to think a step further about how one would value such a call option, or how one would think through abstractly what the features of this call option is, well, a call gives you convexity, right, towards the upside. And you actually pay a cost. You might have heard of the term like theta, which is the time decay. But in reality, theta is not exactly time decay. It's actually the cost for gaining convex exposure to the underlying asset. So theta is actually the cost of gamma, vana, and volga. So those are three sets of higher order Greeks. So they're like second order derivatives of the first derivatives. And these are all convex exposures to volatility, to price, and to the volatility and price like cross, the cross derivative of those, that would be vana, right? So basically, theta is paid for you to gain exposure to those three higher order Greeks. And in the case of this common equity, your theta is your perpetual preferred stock dividends. That's what's being paid, right? So like the common equity is constantly bleeding in order to pay that theta off to maintain that convex exposure. And so I think that's really the right way to value this. If we were to go from like Graham and Dodd style, like securities analysis, from the core classics of investment valuation, like you could probably use a framework like SEEB, common equity Bitcoin exposure, right? You take the Bitcoin stack, you subtract out the notional value of your prefs and your debt and all of the credit instruments, everything that's not common equity, and then you say like, oh wait, this would be the common equities Bitcoin exposure, right? Now I think that's a fair way to do it. If we were to tie it back to options, that would be kind of like the intrinsic value of that option, right? That would be like if the option was in the money and you're saying like, okay, this is how much is in the money, and everything above it, your quote unquote premium, that would be your extrinsic value of that option. So I think that would be like the framework that I would use. And frankly, for this digital credit report, it kind of lays the foundation for starting to think along those lines. And I will have a part 2 and probably part 3 that kind of elaborates on these like quantitative valuation methods.
So in Bitcoin bull markets, we've seen, for example, Strategy's MNAV expanded, I think, to like 3.5x. So within that framework, is that just reflecting the amount of volatility, the forward expectations on upside convexity, or was that like really a bubble that was overvaluing Strategy?
Yeah, I mean, I think both those things can certainly be true. The way I think I would interpret it in hindsight is probably it was more bubbly than it was the other things that you mentioned. But, you know, like both of those things can absolutely be true, just because in a bull market and in these events where prices ripping to the upside, obviously the price of convexity goes higher, right? And obviously the implied volatility of these of all underlying instruments within this stack, right? If we're claiming that the common equity is a call option on the underlying Bitcoin, then there's necessarily an implied volatility attached to that asset base. And the common equity's premium to its net asset value reflects that implied volatility. So the market has a view on that implied volatility and the convexity that the common equity can give you, and it can place a pretty high bid under that, right? And I think I would say, like, speaking along this line is like, you know, this will not be within my decision making anyway, but like for a treasury company to take advantage of these situations, like when their management team views that the securities that they have are let's say priced above fair value, then they absolutely should issue into the market, and that would be an accretive transaction.
And you know, wouldn't that reflect kind of the supply and demand for amplified returns on Bitcoin, that these vehicles will grow their balance sheets when there's a lot of demand? Do you think that the balance sheets will shrink in bear markets, or is it really just about paying the dividends, as we saw most recently? Strategy sold a fairly small percentage of their stack just to prove out kind of their business model. Is that do you think that's going to continue, or is that kind of a one-off just to prove that they can?
Yeah, I think in the future, like, this is absolutely something that we could see more of, just because if you're looking at it from the perspective of I want to maximize the value generated to the common shareholder, right? Then the name of the game is to sell stuff that is overvalued or relatively overvalued, and then buy stuff that is undervalued or relatively undervalued. That's it. Like, if you can consistently do that, everything else will kind of like work itself out, and then value will accrue to the common stock. Okay, like that's it. Now, obviously, all of this is somewhat contingent. All of this is contingent on Bitcoin like actually outperforming, right? Like, it's all contingent on that. Everything's downstream from that. But assuming that is the long-term case, then yeah, everything else from then on really is just about selling stuff when it is relatively overvalued and buying it when it is relatively undervalued. So from the perspective of Bitcoin versus the common stock versus all the other preferred stocks versus the cash reserve, amongst that set of assets, amongst that like Rolodex of assets, there's always going to be something that's relatively overvalued, and then there's always going to be something else that's relatively undervalued. As long as you can make the trades properly, then the value will eventually accrue towards a common equity.
And you know, to that point, I think that as strategy kind of discovered this menu of options over time, because they didn't start with all the options on the table, even though obviously in theory they were there. They were kind of going through the idea maze, and now that I think that they have made clear that they can buy or sell any of these different assets or equity instruments, it seems to have caused like a perception that they are not holding to promises that they would have made in the past, right? Of say not selling your Bitcoin, but obviously it seems rational for them to say that all options are on the table, and that's kind of how maybe you keep the short sellers away. It's how you keep demand for the preferreds coming in, that you have that full optionalities. Is that the same way you see it, or do you think that commitments to, for example, not sell Bitcoin are valuable?
Yeah, I mean, I would say I would actually take the opposite stance of what you said last. Like, I think commitments to not sell Bitcoin is actually not valuable. It has negative value because it is a short option, right? Like, you are now short an option, and now, like, if you had this option, now you've, like, by your own actions decided, okay, I no longer have this option. Like, you're kind of cutting off some of your own limbs, right? Cutting off your own resources. So that's how I see it. Like, I think ultimately it just comes down to what is in the best interest of the common stock, right? Like, that is what every company exists to do, is to accrue value to the common shareholder. And yeah, like that's the bottom line. So it doesn't matter about anything else really. I mean, obviously we'd like to see more companies buying more Bitcoin, and we'd like to see, we'd probably rather not see more companies selling Bitcoin. But at the end of the day, like, the companies, like, they're beholden to their shareholders and beholden to value creation, not beholden to, some random idea saying like, oh, we cannot sell ever. Like, that's just not good and not how you do business.
And if we look outside of kind of the Bitcoin treasury space and we look at other companies, it's pretty common for them to be buying and selling assets depending on what the valuations are of those assets, whether they're doing stock buybacks or issuing more stock, and doing M&A and spin-offs, et cetera. So this is kind of the new phase of active capital management that we're entering into. Do you think that another possibility for, let's call it, ideological flexibility would be on the question of using derivatives? We have not so far seen Saylor or Strategy implement derivative strategies like we might have seen with Metaplanet, for example. Do you think that's going to enter into their menu, or is that would that create too much noise for them?
Yeah, I mean, I think right now the company has a lot of like an identity crisis of sorts. Like, maybe it's not that way to management. Like, maybe they have an idea of what they want to do. But I think in public perception, there is that identity crisis. I think anything can really be on the table. To the point about derivatives, right? Like, obviously, Saylor has made it clear, like, he probably wouldn't want to put more structures on top of it that, potentially generate like income on the Bitcoin via derivative strategies or staking or whatnot, right? And that's very reasonable. He doesn't want to make the investment case more complicated. But that being said, like, here's one easy example for where derivatives could be a value add, right? Imagine if they have, so obviously they have a bunch of prefs, right? But imagine if they set aside some Bitcoin, they hedged that Bitcoin that was set aside for the prefs. I think that would probably like instill more confidence in the backing behind the prefs. Like, if they set aside, so right now there's about $10 billion notional of stretch, right? And so they're like, okay, we know there's $10 billion notional for Stretch. We're going to set aside $10 billion of Bitcoin, and we're going to hedge that with puts, right? So they pay money for these puts, and if that Bitcoin that is set aside for Stretch, again, it's not like encumbered necessarily, but it is set aside like at least nominally. Like the company does say like this much Bitcoin has been set aside, and we're going to put a hedge on it to make sure that its USD value doesn't fall below a certain point. Like, would that be positive or negative for the digital credit? I think it would be fairly positive. It probably would be viewed like something akin to a cash reserve. Functionally, it's kind of like a cash reserve if you're saying that, you know, it's not going to go below this point. So the flip side of that is if you buy a protective put on some Bitcoin, that is logically equivalent to just buying a call option at that same strike, right? It's the same return profile. So if you've justified, okay, well, we're going to set aside this money for this Bitcoin and protect it with puts, now you've obviously also justified, like, we'll set aside this cash reserve, but then we'll use call options to have Bitcoin upside exposure. And so now you can clearly see, like, simple derivative strategies certainly can make total sense, right? What I probably would not see happening is something where they're like, okay, we're going to do a sophisticated options market making kind of deal and then use our Bitcoin as marginable collateral to open these trades. Like, I don't think we're going to see that. But, you know, again, I think anything could be on the table.
Yeah, that makes sense. You know, you mentioned on kind of the protective put side, they already have these cash reserves for future dividends. That is credit positive for the preferreds, but it's also introducing cash drag for the common. How do you think about that trade-off in terms of maybe their cost of capital on the preferreds versus the drag?
Yeah, so I would say mathematically, and I've written about this like on Twitter and whatnot, but mathematically, they are not going to maintain a N-year constant amount of dividend coverage. It's impossible because, like, just think about this. If you're going to keep issuing more digital credit, and let's say you issue at, let's just keep numbers simple, at a 10% cost of capital, right? So every year you issue this share, and the share is worth $100. Every year you got to pay $10, right? If you wanted to maintain 3 years coverage on that, like, you know, like now you have, that's 30% of your value is 10% times 3 years. Now that's 30%. So every $100 you raised selling this thing, you have to set aside $30, which is kind of like a, you know, it's not exactly this, but it's kind of like a loan origination fee of 30%. So this is like, you know, like there's an extent where this is like, okay, this is unacceptable. I will say, to the point of the discourse around the USD reserve, the true origin of like where this all came from was the S&P credit rating. They did the S&P credit rating like October of 2025, and in the credit rating, the agency specifically said, hey, it would be nice if you guys had a cash reserve. That's where the origin of all of this comes from. Okay? It wasn't like an idea that they just like thought up of. It was something that, you know, was specifically prescribed, and then they decided to act on that prescription, and now they have that reserve. And so the point of this reserve was always to just get your foot into the credit rating agency's door so that you can get a good rating on your prefs, and then this way you can sell more prefs, hopefully at a lower cost of capital. That was always the plan. It could have been, you know, now it might have, like, because of a lot of market fears and whatnot, things could have shifted towards like, hey, we need to make sure this cash reserve is always up and at all times. But I'm just saying, like, just trying to sound the bell here is just like, it's not going to happen in the long run. Like, if you are of the position that more and more digital credit will be issued, then you cannot simultaneously be of the position that this N years of dividend coverage will be maintained, where N is a constant number. Like N has to start going down over time as more credit get issued, right? So I think that would be how I view that. I think a lot of fear is in the market right now, and the company unfortunately has to also respond to that. So that's kind of how I see like what's going on with that.
And do you think the cash reserve should be set aside for situations where companies simply don't have access to capital markets, and so it's their last resort, or to use it more strategically, like Strategy did earlier this year with paying off part of their convertible debt?
Yeah, like so this one I kind of want to take it away from just Strategy, right? Because there's companies in general that like have Bitcoin, and they can also have some cash. If a company just had Bitcoin and cash, the cash should obviously be deployed. However it is that would be most value accretive at that moment, right? And given the facts and the long-term time horizon as well, right? So incorporating all of those facts, what is the best course of action right now? So, in general, that's how you should always like use cash, period. And then also, if a company had an operating business that was throwing off a lot of cash flow, and they also had liabilities that they needed to pay because they were financing their Bitcoin purchases, well, now they don't really need that cash, right? They don't need that cash to keep it to pay coupons or dividends or whatever, because they have cash flow from their operating business that they can use to pay that. So that question and the results of that question kind of change when the parameters change. With Strategy, like, unfortunately, they don't have that operating business that is able to throw off that much cash flow to pay all those dividends. So to the credit markets, it's like having that USD reserve is an insurance policy of some form. And because of that, like that's why they're stuck in this kind of situation. If they were to take that cash and deploy it, the deployment logic still is the same with any operating company. It's just whatever is most value accretive at that moment, given all the facts.
Yeah, that makes sense. And then there's also kind of the sequence of returns problem, right? Where even if we're long-term bullish on Bitcoin, outperforming the preferreds, in the meantime, we could have a very long sideways bear market and cause kind of issues. How do you think about the sequence of returns issue for Bitcoin Treasury companies? Is the 4-year cycle over? Is kind of the other big underlying question there. But
yeah. I mean, sequence of returns is ultimately the main variable and question mark whenever you're dealing with any kind of leverage, right? Or amplification. I know there's, people make that distinction, but, for our purposes, I'll just say leverage, right? So anytime you're dealing with leverage, you have the sequence of returns. When it's margin leverage, your sequence of returns is just super time sensitive, right? It's like within a day or two. And if you're doing these kinds of like perpetual preferred equity given leverage, then you now have more time to be correct about something, and you've given yourself more time. But over this time, right, like given a poor sequence of returns, you will see the common equity get absolutely crushed. And this just comes back to what I was saying earlier, like the common equity should accurately be thought of as a call option, and that call option throws off decay of some form, like some kind of cost needs to be paid for access to that convexity. And so if you got access to that convexity for, let's say, 3 years, and 3 years, no big event happened that allowed you to profit from that convexity, well, then you would have been paying a lot. You would have been bleeding a lot, right? So, of course, your call option would be severely degraded in value. And that would be a common equity that got crushed by a poor sequence of returns. In terms of the second part of your question, the 4-year cycle, like for me, it's like I mean, I think we cannot deny that the 4-year cycle came on time, at least for the top. Like as far as like this time it was concerned, like it came exactly on time. Going forward, I do think like it's eventually going to fade because I don't see any like economic reason for why it needs to continue. But I cannot deny that empirically it has held up so far. If I were to guess, I would have to guess like, hey, most of the market's probably thinking that October of this year will be around where the bottom is. I don't think the bottom is going to be as extreme as in prior bottoms, right? Just like the top this time wasn't as extreme as prior tops. So that's kind of my view. It's like kind of, we'll more or less follow in lockstep this time around. And yeah, but things will be fine in the long run because I think the fundamental properties of Bitcoin really haven't changed at all. And if anything, the surrounding like political, institutional, and other kinds of backing behind it have only gotten stronger. So I think the long-term future is very, very sound. It's really these like, intermittently you have these kinds of issues. So that's my view on the 4-year. Yeah.
So on the point of cycles, there's kind of the diminishing returns thesis that every Bitcoin cycle has underperformed the previous one. And then we saw gold have a massive generational run over the past few years. And it's obviously much bigger than Bitcoin's market cap. I think it's 20 times bigger than Bitcoin's market cap. So in my mind, at least, it kind of invalidates this rule of thumb of saying, hey, the bigger the asset is, the harder it is for it to move. On the other hand, gold has been driven by central banks buying, and we don't really have that on Bitcoin's horizon just yet. We'll see how the strategic Bitcoin reserve develops. But what do you think have been kind of the catalysts for this bear market? Is it just the OG selling, or are there other macro factors that we should be looking at?
Yeah, I think it really does not have to be more complicated than OG selling. If you look at other macro factors, I think the last time we were talking about AI. Like AI can draw attention away from Bitcoin. Like, and I said, look, even poly market can draw attention away from Bitcoin, and all of these things kind of pull together insofar as factors that can influence how a cycle plays out. We have 3 very big IPOs, like the biggest of all time this year, right? That's going to pull a lot of capital out of assets. Whether we like it or not, like Bitcoin is still roped in broadly, largely, as a speculative asset, right? And so that is going to, new and hot and like really fashionable IPOs is by definition going to compete with that same theme for Bitcoin. So I think that's just what's been going on. But it doesn't really have to be more complex than OGs have sold. And them selling doesn't really have to be more complex than, hey, look, they've done the 4-year cycle like 3 times now, and they're just like playing in lockstep with how things have happened as they've seen it. So I don't think we need to ascribe more complex theories to that than just, things are just following the prior lockstep.
And so this will come off as 2020 hindsight, but you'll hear people say, strategy, these other Bitcoin treasury companies, they were buying a lot at the top when they could raise a lot of capital, and they were immediately putting it into Bitcoin. They should have raised the capital and then DCA'd in or waited to time the market. Do you think that there's some truth to that they should be market timers, or should they be pretty agnostic as to when they're buying?
I mean, so I think there could be some truth to it, but I think the real mistake people make is that they're kind of taking on the perspective of what they should do as natural persons and then extrapolating it to how a corporation should be. Like if you were a natural person, and let's say you were just borrowing money or whatever, like you might want to like DCA it, right? And that would probably like smooth out your returns. With a company, it's not real. I don't think it's that big of a deal with a company because at the end of the day, like the less moving parts, the better. And you want to keep things simple. If your policy is to buy Bitcoin or if your policy is to increase your cash reserve, then whatever money you have coming in would just go towards whatever standing policy you have. And then you can kind of leave a lot of like variables out of it. And I'd also propose that the flip side of this is, people are basically just talking a lot of trash during a bear market. And so, of course, every week, you bought in the prior week and this week it's a little lower. It looks like you had a terrible entry price. But on the flip side is if this was a bull market and every week it was lower than, the current week, now it looks like he's buying below spot, right? So it's like if you just look at the perception and like did not really think too much about it, you'll always get the wrong and more biased view, and that'll always be your conclusion. But if you just think about it a little bit more, it's not really that bad. If you get the money, just use the money towards whatever policy makes the most sense for the company right now. The bigger question is like, is the money being deployed correctly between cash and then should we even be issuing prefs at this time or should we even be issuing common at this time? Like that's really the bigger question. I think like I would probably have liked to see the discourse more focused around that.
It seemed like the prefs STRC when it hit $100, they were issuing more. It seems like there, as a practical matter, wasn't really a ceiling on how much they were willing to issue, and then they started trading at a discount. I've seen rumors that it was because people were leveraging up on top of the prefs to capture some spread with margin loans on their stock portfolio or something like that, and then they get liquidated and are forced sellers. Do you think that the trading band and the communication about the $100 par value that needs to evolve? Or that there's some kind of game theoretic changes that need to be made to the instruments themselves?
Yeah. This is a great question, and it's a very, very deep topic. I don't know if I'll be able to fully cover it like here. So I think the bottom line up front is, they were ultimately contending with something called the impossible trinity, right? And this is a topic that is very, it predates Bitcoin by like decades, right? It basically states that within any economic block, you can only have two of the following three things, right? You can only have either, you can peg I know it's not like a true peg, but I'm just going to use that word because that's what the textbooks use. But you can have a pegged or a fixed exchange rate. So in STRC's case, this would be the promise that it would trade at around $100. And again, I know it's not a promise, but this is like the implied. Okay, so you have the fixed $100 price. You can have free capital flows, which means people can freely buy or sell, exit the system, which is always going to be true because it is a security that trades on the NASDAQ, right? You cannot impose capital controls there. And then, of course, you have the third thing, which is sovereign monetary policy, which in this case is just the ability to control the dividend rate. So that's the impossible trinity. Of those three things, you have to pick two. You cannot have all three. You've already said you're going to keep it at $100, so you've picked the fixed exchange rate. And you've already listed it on the NASDAQ, so you've picked the free capital flows. This means you no longer control the dividend. Now, if that's the case, then you're completely up to the whims of the market. And so if the market's going to push the price down, you will now have to raise the dividend. And there's no choice. And the only choice you have would be to compromise on the first thing, which is the $100 stated amount, like having it trade there always. So what has ended up happening? Well, I think the market, quite frankly, has pushed it down. And, like you remember, I think back in, back when Stretch had first started, it was trading at around 92-ish, and they suddenly raised it like 100 basis points. Remember that? Like they raised 100 basis points to like force it back towards 100. And now we have Stretch at like, at the time they made this decision, it was like below 87, right? So below 87, they only raised it 50 basis points, right? So you can kind of see how there's already starting to become a compromise on the dividend side of things. Or the statement that was issued, might have been 2 weeks ago or 3 weeks ago, but basically it was the one where they had that new policies, like new everything, right? And part of that statement said, we will no longer raise the dividend on Stretch just because it is trading below 100. So when I looked at that, I'm like, well, this is clearly the company saying that, like, hey, look, we're not going to guarantee that this $100 fixed rate is going to hold. So this is them reclaiming control over the dividend, right? So in the impossible trinity, this is them saying, okay, I'm not going to do number one anymore. I still have to do number two, which is because it's listed on the NASDAQ. And then I am going to reclaim control over number three, which is the dividend. And that's perfectly okay. That's perfectly okay. They have every right to do that. It's their pref. It's within the rights of like the prospectives for the security. So that's fine. But I think in many ways it was needed. Like this was going to happen sooner or later. Now, the other thing is like, should we materially change the security? And I think this is probably even more interesting than everything we had just discussed, because like personally, I do think that there is room to make some changes. First of all, this is a floating rate instrument, or rather, it's a variable dividend instrument. If you look at the market for floating rate notes, for example, they tend to have about like 2-year maturity. So in 2 years, something has to be paid back. The principal has to be paid back. And then the way the coupon is adjusted is every day you snapshot the SOFR, and then you put a fixed spread over it. Okay? So the spread itself is fixed to the value of the principal, the face value of the note. And then SOFR, of course, is what floats. SOFR is the only thing that floats. Okay? So to all of these other instruments that are floating rate, SOFR is really what makes them floating rate instruments. It's by virtue of the fact that SOFR floats. That fixed spread isn't floating. Okay? If you look at digital credit, it's completely different. Digital credit, it floats by virtue of the fact that the price, we are trying to keep the price stable. The price is not at $100, then we change the dividend. That's why it floats. Right? So that's potentially a problem, because like it makes this thing a little too different from the others. So that's potentially a problem. Another thing is, and this part, it almost pains me to say this, because I do view perpetual duration as a good thing. But I think to a credit investor, right, the fact that something has to be repaid at some point is an anchor point on objective value. Like if I know for a fact, like 2 years down the line, I am going to be paid the principal, and like this is their obligation to do so, then I have that objective anchor point. If all I have is this promise that this dividend will be paid, but then the dividend can also be suspended if something happens. Like now you can see where, to me as a credit investor, I would either have to attach a huge spread onto it, like a huge credit spread, or I would really not treat it as credit at all and treat it as something that should trade with more volatility. And if everyone else in the market kind of thinks that, you will have the volatility that we just had, right? So I think like this is a natural outcome of the economic incentives, and if we want to change this outcome, we have to change those incentives. So one thing I would like to see them at least consider is perhaps put some kind of investor put into these instruments. Okay, like if the stated amount is at $100, they could put the put at like 85. And then every 5 years, every 5 years, like let's say, the investors are allowed to put the security back to the company, force the company to buy at 85. What that's going to do is, first of all, it now creates the objective anchor point. So it kind of mimics what the floating rate note does, right? But also, it keeps the perpetual duration. It's just no longer like a Macaulay duration anymore, right? It's more of a, it's duration by virtue of the fact that, this thing doesn't expire. But then again, if it gets putted, then it's done. So that's kind of the new game theory. And if we then look at this new game theory, as we approach that 5-year put date, what's going to happen is the price, if it's below 85, will go towards 85. And once it goes towards 85, you also have the perception that, hey, if I don't put it to the company, then I earn the dividend. And so maybe it goes to premium to 85. And if it goes to a premium to 85, they wouldn't put it anymore. They would just sell it if they wanted to get their money. You see? So I think something like that could create more stable dynamics to digital credit. But that being said, like, is it even possible to amend Stretch to that extent at this time? Like, I don't know. But I'm just saying for other like companies that might be looking to issue these credit instruments, these are things to consider, right?
First on your point about the put, couldn't the investors overlay the derivative on top of the instrument? I think that now there are options chains on the perpetuals. Do you think that's a reasonable approach, or it really has to be the issuer to put in this protection?
I think the issuer would have to do it because the options market right now, I mean, it definitely got a lot more liquid after the sell-off, but it's just not enough to accommodate the size, right? Stretch is a $10 billion notional value asset. There is not that much options trading on it, so it would be nice, yeah, it's true. Someone else could buy the put, but when you're talking like a really large scale, money manager managing a bunch of money, like this is not an option for them, right? And ultimately, those are the pools of capital that we were looking for in the first place. So I think creating that accommodation of the investor put would probably fit that bill a lot better. It'll make them feel a lot more comfortable, right? Because then it feels just like one of those floating rate notes that they would otherwise buy. So yeah, those would be like my two addendums, right? Like, forget the variable rate that's based on the price. Just like make it SOFR plus spread. You make it SOFR plus 700 bips. That's more attractive than any floating rate note. Okay, like SOFR plus 700 bips, and then we can go from there. And by the way, if it's really SOFR plus 500 plus 700 bips, like, you will eventually get it to trade above 100, because these things, it's not going to stay like that forever. Like, once the market like wakes up to it and they're like, yo, this is actually a good instrument and the risk isn't really that bad, it will like break the peg, but it'll go to the upside now, right? And so, of course, implied within this is also just remove your 101 investor call. Right, remove that $101 strike price to call everything back at 101. Allow it to trade above par if needed. I think like SATA did something like that. They were like, yeah, we can suggest that. But what they were doing was more so like saying, hey, like this will deter the shorts from putting on short positions at 100. Which of course, right? That's a reasonable deterrence. I just think long term, it's probably better to not target a stable price and better to just act more like traditional floating rate notes.
Yeah, and so that's a really interesting proposal with the SOFR plus. I think that makes a ton of sense. The protective put just it sounds expensive for the common stock to underwrite that.
I think it's like this. Like, I think ultimately, with something like that, the company will not issue as much digital credit as they did right now. Right? Like, imagine if they knew 5 years later, like we might be on the hook for 85 cents on the dollar, right? Then they'll be more careful about it. But and so what that would lead to is A, they buy less Bitcoin in the meantime. But B, like they probably have higher quality buyers. And this is the part where I think no one's really talking about. Is that like right now, I believe most of the buyers, first off, we know most of the buyers is retail. Okay, like Strategy has their own deck. It says like for a stretch, about 80% retail ownership. But here's the other thing, okay? And this is the part that like people don't really think about that much. The 20% that's not retail, at least 6% of the 100%, about like 600, like $600 million of Stretch was owned by these DeFi protocols. Now that's probably I'm gonna assume, right? That's gonna come across as institutional. So, but like, that's institution ownership, but what's really behind it is just retail. It's like no institutions really use DeFi, okay? So like, what you really have is probably about 90% is all retail ownership, and they're all trying to do these like leveraged looping kind of things, right? And so that's the quality of the investor that you have under this current model, right? Because they think like, oh, you actually are going to make sure the price goes back to par, and you're just going to keep raising the dividend. So as long as I can like maintain this margin position, I can keep pocketing a spread. Those are the incentives at play. Whereas if you had other buyers who see that there's the investor put, they will come in, and they're not going to be the type that does those kinds of those games where they leverage loop something. And now the behavior of your investors is necessarily going to be different, right? So when you have a first wick down or something, everyone isn't getting margin called. They're just looking at their investor put and they're like, yo, like we're going to be okay. Like worst case, we hold to when this put expires and then we just exercise it. And that becomes the new dominant mentality for that market, right? For the market on that instrument. So I think there's something there. Like there's something to consider about that. You won't sell as much, but your buyers will be probably quality buyers that's not trying to play these kinds of games that'll ultimately just make everyone look bad, right? Because look, if you promised that this, I know they didn't promise it, but if you're marketing it as like, hey, this will more or less stay at this trading range, then it doesn't for an extended period of time. That looks terrible. That looks awful, right? So these kinds of faux pas just won't happen as much because the investor base will be different, and I think the credit looks more like traditional credit and less like something too new and too like out there. And I think there are benefits to doing it that way. But to your point, it is going to be expensive, right? And it's expensive on the one sense because, we cannot issue as much. But it's expensive on a different sense because, look, if we have to accommodate like huge lump sums of exercise, then, we'll have to be much more disciplined with how we manage cash. But again, I will say, right, assuming the asset coverage is there, the exercises should never happen. Does that make sense? Like assuming the asset coverage is actually there, it will always go above 85. Once it goes above 85 or whatever the strike is, right, it'll always go above there, and it'll peak a little bit over that because there's a dividend yield in the future if you don't exercise. Because it peaks a little over that, they will never exercise because they're going to just sell on the spot market. The other thing is, if they end up having to, if investors exercise anyway, and the shares are trading above spot, you can ATM to just like raise the money and just give the money back. Like you could do that. So I think I know the put is it could be more controversial, but I think if you think it through, it's like there's actually some optionality there, and the upside to it and what you gain from it could make it worth considering. So that's kind of my idea.
Yeah. Okay, just to pressure test it a little bit more, because I think it's a really interesting idea. If in 5 years you see this kind of flash crash, right, where there's stress in the market, not for any underlying credit reasons, not due to a lack of coverage, but purely because there's more sellers than buyers, does that kind of force the company's hand when really they should have been able to ride through it?
Yeah, it does. In that case, it definitely does. But if that happens, right? Like, there's literally no problem in just selling the Bitcoin and then meeting those exercise needs. Like, there's literally no problem with that. They can also preemptively, like, if it goes below the strike, like, let's say we are 3 months out, right? 3 months later is gonna come the exercise date. And then it falls way below. It falls to like 75, or how it fell like this time, right? At this time, the company is like, all right, so 3 months later, we're going to have to pay back 85 cents on the dollar. Right now, it's at 75. Let's just scoop up as much as we can at 75, right? Like, this becomes at that point, you're accretive. You're 100% accretive because you're buying something below the point where, like, you're going to be obligated to pay that money. So that would be an action to do, and this would be exactly what the cash reserve would be for, right? Like, for stuff like this. Frankly, the cash reserve isn't for paying dividends because they sell Bitcoin or common to pay the dividends anyway, and the cash doesn't get depleted. So it's like this is the type of thing where you can deploy cash in like larger quantities.
Yeah, that makes a lot of sense. It's a really interesting idea. The other question I would have along those lines is, the effective yield increases as the price of the preferred goes down, and doesn't that just naturally attract more investors or even just short-term traders who kind of see that it's mispriced, and so the issuer doesn't need to do anything, or do they have, again, promises made to keep it close to 100, and so they have to do something?
Yeah, so I think it's valid to assert that as the effective yield goes up, it draws in more buyers. But then I also think like that mental model only works within like your plus or minus 1.5 standard deviation type of event, right? Like once you go outside towards the tails, you have no idea what's going to happen. So this is something that we have to be very careful and precise about, because like ultimately the way normal credit assigns the value is because there is that repayment date. That's what anchors the value. If you just have an instrument that throws off dividends, but then it never has to like pay the principal, you have a situation where everybody in the market now knows that the next time I can get out and get my principal back is completely up to the whims of all these other people that are playing around in this market, like I am. Like which one do you think gives more confidence? Like the first one where like, hey, I'm definitely going to have to be repaid at some point, like 2 years from now, or like 6 months from now, or some specific date from now. Or the second thing, which is like, oh yeah, I can do this right now and it would be a high yield play, but when I have to exit, I am completely subject to whenever that future spot price is, and I have no idea what it's going to be, right? So that is clearly, yes, that could attract traders. That could attract people who are like long-term, short-term, right? Who are more short-term than long-term. But now think about it. Like if your entire premise was we were trying to sell to the credit markets, but now you're saying, hey, now we just want to attract traders who would leverage up and who would like try to go in for the high yield. are you really targeting credit anymore? Or are you targeting people that are more short-term traders, right? Not that it's wrong to like sell instruments to short-term traders, but if the stated goal was to like sell to traditional credit investors, and then in fact you are not doing it because of the way you've structured the instrument, then I think something is wrong there, right? Like maybe it's not legally wrong, maybe it's not like even wrong for the company to do that, but something is wrong in terms of like how you're presenting it, and then like what's actually going on, and there's a disconnect about that.
Like a product market fit issue, really. So this raises an interesting question, which is that rather than positioning the preferreds as better than a money market fund, for example, or kind of like a savings account where you do have kind of par, create, redeem, right? You don't have to worry about the principal. Positioning it as more akin to buying a piece of real estate, home, let's say, to rent it out, and that you'll earn the income stream of rent, which will be stable, but your ability to sell it at par is not guaranteed, right? So really the decision-making process should be about, do you want this stream of income, and how confident are you about the future dividend rate, rather than trying to worry about, can you get in and out of the principal at par? Does that make sense?
So are you asking me like
the marketing, the product market fit is of a longer duration than what kind of has been floating out there of, oh, this is like cash?
Yeah, I mean, I think if you're talking about it and like you're marketing your security as the issuer, yeah, you shouldn't use the kind of like cash thing. I think that's not the best like legally sound way to characterize it. But then also like it is hard to do marketing, and it is hard to like grab people's attention. And so I understand like there are incentives at play that just because of how attention starved everything is, right? It's just like you have to try to grab people's attention, and then you have to make outstanding statements in order to do so. This is just, I think, how things are in the social media age, right? So it's one of those things where we could wish it were different, but I don't think things would change that much. That being said, like the larger point is absolutely correct. Like I think something like Strife, for instance, right? The most senior pref that just like it's basically a perpetuity, with of course a risk, with a credit spread that needs to be attached to it. But like that's a very good security, like all things considered. If you are truly a retiree, then you've like did your math and you're like, all right, from today until when I retire till the day I die, like I'm only gonna need this much money per year. This is how much Strife I'm gonna need to fill that part of my investment portfolio. Perfect. Like then you don't have to worry about the price. So like if you're truly a retiree, like yeah, there is a point to be made. Like why bother if the price like collapses below your entry price? Because as long as you're still getting paid the dividend, that's what you bought it for, right? Sure. Like what's the problem? But again, like I think the pain that is felt in the market, like at least over the last month, it's just frankly because those were not the buyers. The buyers were people that were leveraged long. They were probably trying to earn some like carry spread, and they're probably trying to like be the first ones out as soon as anything went wrong. And then a lot of them just got caught flat-footed, and that is how we saw the cascade that we saw. So I think that's really how it is. And part of it is also like, the super conservative investor that's just buying this for retirement, they're probably not looking at something like this that isn't rated, right? Like you just have to think that like there's just all these other variables at play, and strategy is in a very hard position to have to balance all of this, right? It's a difficult thing to need to balance everything and make as much people as possible happy. So I think that just also needs to be something that's considered, right? Like it's hard. It's genuinely hard. Not that it's an excuse for anything, but it's just difficult.
And on that point, as people kind of get more educated and see the track record for these over multiple years, is that how you change kind of the investor base for these instruments from short-term to more long-term income, or do you stick by your thesis that there needs to be product changes?
Yeah, I mean, I want to clarify. Like, I'm not saying there necessarily needs to be. I think what I'm suggesting would be very helpful. Like very helpful certainly in the next like 2 years. Long term, I don't think like these instruments are dead unless the Bitcoin thesis that we all have is wrong. Okay.
Right.
Like that's where this is all downstream from. So as long as like I think ultimately what happens is once the bear market ends and the bull market returns, like all of this stuff will be bailed out at the end of the day by the rising Bitcoin price. Okay? That's just what I think would ultimately happen here. Like we can suggest all of these things, like Saylor can and his team can put out these like new frameworks and whatnot, but this is all to just try to, outlast the bear market.
And on that point, do you think there will be instability introduced in the bull market by people selling the preferreds to buy the common because now they think that's going to outperform, and then vice versa in the bear market, them at the beginning kind of just dumping their common stock to pick up the preferreds, and we'll constantly see this back and forth rotation? Is that destabilizing?
I think it'll happen. I don't think it'll be destabilizing. And the main thing is during the bull market, you'll just have so much more demand anyway. So, and remember the flexible load here, right? To use a Bitcoin term, right? The flexible load here is really just the ATMs. Like if a lot of people want to buy this thing, but then also a lot of people want to sell it, then the ATMs just won't run as hard. But if a lot of people just want to buy it and the demand is like gushing and overwhelming, then the ATM will run however high it needs to run, right? So that is how I think it is. Like the flexible load here is the ATM. And so I don't view that as a destabilizing factor.
Yeah, that makes a lot of sense. Allard, I've really enjoyed our conversation today. Is there anything that we missed? I want to encourage people to go check out your research report and to dig into it. But before we sign off, are there any major points that we didn't address?
No, I think we've covered a lot. We probably need like another hour or so to talk through like all the stuff happening on the protocol side. Like it's also lots of stuff going on. But yeah, on the corporate side and digital credit, I think this has been comprehensive.
Awesome. Well, thanks for coming on the show, and thank you to our listeners for joining us for another episode of the Bitcoin for Corporations show. As we travel through this bear market, I think now's a great time to be learning more and absorbing kind of what's going on. So we hope you'll join us on the next episode, and don't forget to like, subscribe, leave a review, and share it with your friends and family.
Is quantum computing a threat or is it overblown?
It's both.
I am fascinated by quantum computing.
I think there's definitely a lot of unknowns with quantum computing.
It is a theoretical risk on the Bitcoin network.
The big threat, in my opinion, is the discovery and unlocking of wallets that have been lost forever. Bitcoin is a scarce asset that you can make more of, but you can find more of it by unlocking these old wallets. that could pose a threat to Bitcoin.
The quantum concept is, what do you do with the Satoshi coins if they are not quantum resistant and they don't move? It's a really interesting philosophical debate because you could argue that if quantum computing is a real threat and it can come and crack the Satoshi coins, I mean, obviously there's a probability of having a bad actor that wants to tear down the entire ecosystem, but the game theory would suggest that there's more incentive to break the Satoshi wallet, keep the coins, and build on that into the future.
I don't know what the answer is, but I do know that there are a lot of teams working on protecting Bitcoin against it. Teams like Blockstream have a lot of PhD engineers currently working on upgrading Bitcoin to stave off those threats.
I do believe that the technology, as all technology does, will progress and get better. The Bitcoin network has the ability to upgrade and change and morph, and I think that's really the beauty of Bitcoin, is that it's distributed network of nodes. Frankly, I'm currently unconcerned by quantum.
The question is still if and not when. Still, it is important to take that question into consideration and most importantly, not add changes to the protocol with rushing into a solution in search for a problem.
There are people in the Bitcoin community that don't want to see a change to Bitcoin. They believe Bitcoin will be fine as is, and it's designed the way that Satoshi envisioned, and it would be a bastardization of what Satoshi viewed if we make a change to the Bitcoin protocol.
And my view is that Bitcoin will win. Bitcoin will actually be the best prepared for the future of what could be quantum. And you have already solutions that are being proposed by the market, and the best will win. And my view is that the best will be an optional one where people can opt in over time as they perceive a potential risk.
I do understand why people have the fear. I think it's an incredibly complex topic. We're literally talking about quantum physics, and I'm no expert, but from the people that I've listened to and the people that I trust and the research that I've done, I do not think it's an immediate threat. And if it were to become a threat, there are things that the Bitcoin network can do to protect itself.
I would say the threat is less imminent than the headlines suggest, and work being done already to address any potential threat in the future is more robust and diversified than people think. And what I mean by that is there's lots of different work already underway that they range from changing the protocol itself or updating the signature scheme to post-quantum proof signature schemes versus, say, having contingencies and plans that would allow somebody, in case in the future they need to move or migrate to that signature scheme, they can. And so there's a lot of work being done, and the community is already discussing and debating ways that this could potentially happen, but it seems like the threat is more theoretical in nature right now. And I think people underestimate Bitcoin's resilience. Bitcoin is the most secure computer network in the world. It's decentralized. And so what that means is there's a ton of eyeballs looking at this open source code. They're maintaining it, looking for vulnerabilities, making proposals. There's a ton of discussion, and that hive mind is one of Bitcoin's biggest strengths. And that's why its uptime is 99.9%. Despite it probably being the biggest honeypot for any potential attacker to go after. So I think Bitcoin is extremely resilient, and people shouldn't underestimate it.
I think it makes for a great story. It is incredibly interesting tech. It'll continue to move forward. We saw this back there with the Y2K bug back in 1999, where the world was going to implode. Technology marches forward, and Bitcoin continues to adapt for it. And if anybody's worried about quantum breaking Bitcoin, they should be more worried. Quantum will break everything way, way before Bitcoin. And Bitcoin's already adapting to it because that's the nature of open source software and something at this kind of network scale. So it's actually going to unlock incredible possibilities. So I'm not one of these people that sees the progression of tech as dangerous. I see as we adapt to it, Bitcoin will adapt to it, already is. The discussions are great around it. And we're going to see many, many great things unfold from quantum computing.
There's multiple attack vectors for quantum on Bitcoin, but There was even just a paper that was released a couple of weeks ago where, without even having to go through a protocol upgrade, we know how Bitcoin and Bitcoin wallets and the consensus mechanism can be completely quantum proofed. So is it a threat? Yes. Are there ways to alleviate that threat such that it will not destroy the Bitcoin network? Absolutely. Do we have to come to a consensus in the Bitcoin community as to what we need to do to protect Bitcoin? Absolutely. Do I think that's going to happen tomorrow? No, but I think we have some very smart people in the community that have figured out ways to make this work, and we have a couple of years before quantum really becomes the true threat that it may be. And at the end of the day, I'm more worried about what quantum and its threat will be on the global financial system as a whole, more so than just native Bitcoin.
There are 25 million un- and underbanked families in the United States. These are sort of the folks in our universe that need Bitcoin the most, right? The folks that live paycheck to paycheck, are unbanked, and are faced with ever increasing inflation rate and debasement of their purchasing power.
Welcome to the Bitcoin for Corporations show. I'm your host, Pierre Richard, and today I'm joined by Paul Tarantino from Byte Federal. Paul, how are you?
I'm great. Thanks for having me, Pierre.
Yeah, thanks for coming on. So for those not familiar with Byte Federal, do you want to kind of give us a bite-sized overview?
Sure, absolutely. So Byte Federal started in late 2016. 3 guys in Venice, Florida, started the company with a couple ATMs, decided early on that they really wanted to build their own ATM and write their own software, which they did. So we're the only operator that we're aware of that both has written and builds their ATMs from scratch here in the United States. We have about 1,400 ATMs in the US, covering about 40 states. I think we're well over 100 now in Australia with Byte Federal Australia, which is a licensed operator of our network. We have a couple ATMs in Suriname. And the ATM business makes up about 98% of our revenue. But we have launched a wallet, and we have launched a payment gateway late last year, and are developing those market segments as well.
Now, people might have a first reaction of, well, ATMs for Bitcoin, that seems a little unusual, right? It's supposed to be just a digital currency. But what connects Bitcoin into the physical world? Why is there a market need for ATMs?
Yeah, that's great. So there are, according to the latest research, about 25 million un- and underbanked families in the United States. And these are sort of the folks in our universe that need Bitcoin the most, right? The folks that live paycheck to paycheck, are unbanked, and are faced with ever increasing inflation rate and debasement of their purchasing power. So, and these folks, not only are they dealing with that, but they just have a hard time accessing the digital economy. Just a simple things we take for granted, like being able to shop at Amazon, right? So those folks, and we can see it in our data. I'm happy to go through the transaction data with you, but we see those folks coming on a weekly basis, lots of volumes on Fridays, payday. They get their cash, they do their shopping, they buy Bitcoin, either for savings, or perhaps they're buying Bitcoin so they can convert it to, like a Bitrefill card that they can use for online shopping. They can pay bills online at that point. So getting access to that digital infrastructure when you don't have a bank account is really crucial. And that's sort of like the major use case for our ATMs.
Yeah, really interesting. And what got you kind of zeroed in on this part of the market on Bitcoin ATMs? Did you already have a Bitcoin journey beforehand?
My Bitcoin journey started in 2017. I joined Byte Federal in business development actually in 2020, and then became the CEO in 2023, late 2023. So, but the founders, right? I knew those guys from early on because we started the Blockchain Business Association here in Florida, and that's where I met them. And so their initial thing was that in the early days of Bitcoin, right, you if you wanted to acquire Bitcoin, you might meet somebody at Starbucks and hand them cash, and hopefully they're sending your Bitcoin to your wallet, and hopefully the person you meet is a safe and friendly individual. So the initial use case was saying, how can we make this safe so people can do a peer-to-peer transaction with a trusted corporation, in somewhat private in a secure location, as opposed to meeting somebody you don't know, disclosing your wallet address, and hopefully things don't go awry. So that was sort of the initial use case, is kind of replacing that human ATM where people were buying Bitcoin from in the early days. And it's just evolved over time.
Yeah. Now, when you think about kind of the other ways of buying Bitcoin, what do you see as kind of the key advantage of the Bitcoin ATM? You mentioned that there's folks who don't have access to traditional banking infrastructure, but also, the locations of them. How are you able to locate and deploy so many of them to be able to meet that market demand?
Yeah, that's a great question. We're constantly searching for locations. We try and find locations that are have long hours. 24 hours is great because there are, the unbanked are doing a lot of their transactions after banking hours. So we see a significant portion of our transactions between 6 p.m. and 6 a.m. So to the extent that we could find a 24-hour location, that's helpful, or at least a location that might be open to 10 or midnight. Also, we're looking for a place that's like safe, secure, good parking, well lit, that's in an area that's easy access, say on a commute in a high volume driving area. So that lends, or I should say, the convenience stores lend themselves to be great locations for us. And so that's where we, convenience stores, but then also we might find a liquor store or a gift shop, a local market. Those might also be locations, but in general, convenience stores tend to be the most widely used location for a Bitcoin ATM.
And how much activity does an ATM need to have to be economical?
Yeah, I think a good rule of thumb is about $10,000 a month. We're constantly, so like when we put an ATM in a new location, we need to give it 6 months to really season itself. That a lot of SEO optimization and telling people in the community that this is near them. So the average person is going to say Bitcoin ATM near me. They're going to find out what pops up, and we try and guide them to our ATM. So we don't want to have massive concentration, because then we're just stealing from our own pocket. We also have to be aware of like what other ATM providers are in that area that could be diluting volume. And so once we season in a machine, if it looks like it's not picking up, then we'll just pull it and move it to another location. And so we do that frequently. And as you probably are aware, there's been some legislation that has made it difficult to operate in certain states, and that means we're picking up those machines and moving them to other locations as well.
So I want to get to the public policy part of this soon, because that is really interesting. The other question I had in mind was the ratio between buying and selling. How does that work out?
It's about 99% buying only.
Okay.
I can come up with give you a few reasons for why I think that is. From an operator's perspective, we started with a lot of two-way machines, and the sale of Bitcoin, it just wasn't happening. And so when you combine that with the cost of the infrastructure to have a two-way bill feeder, it's like, this just doesn't make sense. I would assume that what people are doing is they're accumulating Bitcoin, and then if they want to get out, they're going to a stable coin in a wallet. And we just have not seen that as a viable use case. It also kind of coincides with like the JP Morgan research that came out, I believe late last year, where about 80% of every dollar that leaves the banking system and goes into Bitcoin never comes back. And so we're seeing higher numbers than that, at least on our ATMs. We don't know exactly what people do with their Bitcoin after, they've held it for a certain period of time, but there's certainly the few machines that we have out there that are still two-way, they barely get used.
That's really interesting.
Barely get used for sales.
Yeah. Okay, so now why have Bitcoin ATMs kind of entered into the regulatory crosshairs for, I don't want to say recently, because I know that there's been a trickle of articles over the years.
Yeah, there has been a trickle, but certainly late last year, it became a very significant movement. And the messaging behind the movement has mostly been around elder fraud. And the scams and the fraudulent activity that targets seniors, that ends up driving them to an ATM to do a transaction, which of course a Bitcoin transaction is irreversible. So it becomes a significant risk if they get to the point where they do a Bitcoin transaction. And unfortunately, we believe in that goal, and we do a lot to prevent elder fraud, which I'll go into. But to answer your question more specifically, I think that's sort of the messaging. But when you look at the specifics in the legislation and you look at the laws they're trying to change, it's hard to see how that prevents elder fraud. And it also is attacking a segment in the chain of fraud, right? Where elder fraud doesn't just happen at ATMs, right? It's also happening in gift cards. It's also happening at PayPal, Venmo. It's happening at banks. And we are just a tiny little fraction of the total fraud in that chain. So it does seem on the surface to us, when we look at the data, to be an unjustified attack on our specific industry. And so we have been kind of proactively talking to legislators, trying to educate them about what we do to prevent fraud and the chain of fraud. Like, where does it start? How does this person get led through the financial system to get cash and then end up at the ATM?
I have friends and family who have come to me and said, hey, I tried opening an account at a crypto exchange and they won't let me. Pierre, can you help me out? And then I start digging into it, and they got flagged because of their age. That they're too old to open a crypto account.
Wow.
And so then they have to work through like the fraud department because there's obviously, lots of situations that lead to a bad outcome. But
Sure.
How do you balance kind of the financial inclusion and accessibility with preventing fraud so that we don't have so many false positives?
Yeah, that's a great question. So first and foremost, right, we KYC AML everybody from $1. So unlike some of our competitors where you could do, say, a transaction up to $1,000 or $999 with just a phone number, we don't permit that. So you do full KYC AML, just like you would if you're going to open up an account at Fidelity or an account on a crypto exchange, before you're allowed to do a transaction. After that, obviously, our terms of service, our fraud disclosures, there are numerous documents that you have to read through and agree to in order to do the transaction on our terminal. And we have all the fraud prevention stickers on the outside of the terminal as well. And then specifically for people 60 plus, when they're doing a transaction, they get a live phone call from our trained support staff. And so like that exchange that this just says, hey, you're of a certain age, we're not going to allow this. We just take it a step further. We say, if you're over 60, we're going to give you a live call. And what we're doing in that call is we're confirming that you're making this transaction for your own investment purposes, that you're sending it to your own wallet. You're not buying the crypto to send or for somebody else's wallet. And then we ask them specifically, what wallet are you using? If they don't know the name of that wallet, we go, okay, well, can you explain what it looks like? Can you give us the colors in the wallet? And if they hesitate or they have questions there, we dig deeper and we confirm again the purpose of the transaction. At the end of that call, which is recorded, we're asking them twice, are you absolutely sure today that you're not being scammed and that this transaction is for you going directly to your wallet? So through that process of doing a live recorded phone call with the customer, we determine whether there's any suspicious scam or fraudulent activity. If that's the case, then we simply block the customer and we do not allow the transaction. Our data, we started doing this in January of 2024. When we first turned this process on, we actually blocked 84% of the people that were over 60 years old. They said, can't do a transaction. And that's not to say that they were all being scammed, but they at least didn't have the cognitive capacity that made us comfortable with this being a legitimate transaction. We just ran it again at the end of 2025, looking backwards 6 months, and that number has dropped to 50%. So what that is beginning to show us is that potentially scammers are not directing these people to a bifederal ATM because the transactions are being stopped. And so we continue that process. We've got amazing recorded calls where customers discover and are very thankful that they discovered they're being scammed. Ask us directly, what should I do with this money? And it's like, go put it back in the bank account. So we play these phone calls for regulators and legislators, and they're blown away. They have no idea that we go to this extent. I've talked to big exchanges that we're all aware of. They have the same kind of difficulties with elder fraud, which I suspect is why they just block your mom. But we, because we're dealing with cash and we have people standing in front of the ATM, we think the live phone call is the most beneficial way to address the problem and to stop the transaction in our infrastructure.
Yeah, that makes a lot of sense. And I've also seen some recent news articles that upstream, these scam centers in Southeast Asia are actually getting raided and shut down by the authorities. And so they are getting to the root of the problem rather than trying to address all of the secondary and tertiary impacts. But do you think that some of the public policy pressure might also be coming from competitors, from traditional banks that see these ATMs as alternatives that they don't like?
Yeah, it's hard to say because I don't have any proof of that directly, but the biggest group that's pushing this message and having a lot of effect on the lobbying front is AARP. And what's interesting about AARP is that their model, right, is their model of fundraising is to work with banks, insurance companies, telecoms, et cetera, and to brand products and services that are geared at the elderly with the AARP brand in exchange for this royalty fee, to the tune that's giving them a budget or earnings of close to $9 to $10 billion a year.
Wow.
Yeah, it's pretty significant. Yeah, so they're a very, very powerful force. They've been spending, about $6.5 million a quarter lobbying, and of course, those lobbying efforts are going to be geared specifically towards the companies that are supporting their endeavor. So, you could sort of say that's highly likely that maybe they're working with entities or they're funded by entities that would like to see us go away. But I can't say that for sure. But I think the most important thing is that the legislation that's coming, their messaging is leading to legislation that is that's either banning ATMs directly, making it impossible to operate profitably, or make it impossible to operate profitably. And this is just leading to a loss of access for the and underbanked, a loss of access for people that want to do legitimate transactions, and it's not preventing the fraud. I mean, you mentioned earlier about going to the source, which we think is brilliant, right? We should be attacking fraud at that source. For banks, gift card providers, payment providers, and crypto ATMs, the source is the telecom and voice over IP providers, right? That's the gateway. That's the front door that's completely unlocked that allows these fraudsters to get access to your mom, your dad, all of us, right? I don't know about you, but I get dozens of robocalls a day. And in 2025, I think there were something like 52.5 billion robocalls received by Americans. And
Wow.
that led to 14.5 billion in fraud losses. Now, if you roll that into like out of that 14.5 billion in losses, how much of that was through the ATM? Well, it's about 250 million. So it's a tiny little fragment of the total fraud that's being implemented through the telecom voice over IP providers. And that kind of shows you right away that they're going through a lot of effort and a lot of energy to go after the smallest loss in the chain. And TRM Labs, which is a chain analysis company, it's a direct competitor to Chain Analysis, that's done research on this problem, says that about 1.25% of all ATM transactions are fraudulent. So out of our total volume, it's a very small percentage of our transactions. Whereas the banks, we're talking about a couple $1 billion in fraudulent transactions just through wires, not to mention ACH and other things that happens, right? So.
Well, it's astonishing that the telecommunications industry is not the one being regulated, and instead, they're looking at other things. It reminds me of Bitcoin mining.
Exactly.
They were talking about, we're going to regulate Bitcoin mining when all of the environmental issues are at the power plant. They're not at the consumer level.
That's exactly right, Pierre. I mean, think about it today. Like your argument for Bitcoin mining years ago, when that industry was being attacked, is so clear today when AI is going to use 10, 20x the amount of energy, and nobody's, the legislators aren't complaining about it, right? So it's very similar. It reminds me a lot of that phase of Bitcoin, where you're just like, you feel unfairly attacked because you're just a drop in the bucket compared to the scam and elder fraud that's happening across the entire financial ecosystem.
Yeah, and getting a phone number. I mean, I think that should not be permissionless.
It shouldn't.
I'm sorry to say, folks, but creating a Bitcoin wallet, that's permissionless because it's cryptography, right? But when it comes to the phone network, they should be able to trace who is trying to scam you by giving you a phone call. And it's even worse if it's coming from a foreign country where they might not even be able to arrest that person, and yet they're letting their phone calls through.
Oh, that's absolutely correct. So it's $100 in filing fee to get a phone number, and they do very light background check. You basically fill out your information, right? So it's there's documented cases. A great one was in 2024 election. It was called the Mario Cop scam. This this company that was named Mario Cop, whose address they figured out after the fact was a Hilton hotel in Canada, created a robocall that was an AI duplication of Joe Biden's voice. And Joe Biden's voice was calling all these people through these robocalls and telling them they didn't need to vote in the primaries. And they later got in trouble and they were later fined. But the reality is that there are, well, let me just get you the specific data because it's really astounding. The telecom industry was levied since 2015 $208 million in FCC fines. They've only actually collected $6,790.
Wow.
And now the Supreme Court is having a hearing here, hopefully this month. It was supposed to happen in April. It was postponed. That could make all FCC administrative fines unconstitutional.
Oh, wow.
So there's this issue in the telecom voice over IP segment of this issue, which leads to where they're not monitoring the content, they're not doing proper KYC. They do have a protocol called the stir shaken protocol, where when they do their light identification, they say this is likely an A-rated, call, B and C. So the A-rated calls are obviously the best, what they deem to be the most secure, but you can scrub whatever your ranking is. So let's say you get a C ranking because you're high risk. You can scrub that digital ID off by just routing your call through the old copper networks that can't carry the tag. So that's one way they get around it. The other problem is that 48% of all the 48% of the illegal robocalls had the highest A-level trust signature.
Oh, wow.
Right.
So it doesn't mean much. Yeah.
So it's just data that's showing us that the due diligence that they're doing on these corporations that are buying these phone numbers is weak at best.
Right, and they're allowing it because they make money as a telecom on this activity, even though it's a negative externality on the rest of society.
Exactly,
enabling fraud for the most vulnerable segments of the population, and then scapegoating other industries like yours. That is astonishing. So you mentioned that one avenue they're legislatively banning Bitcoin ATMs. Others are making it uneconomical. What does that look like when they do make it uneconomical to operate a Bitcoin ATM?
Yeah, so it's basically they do it through limiting our ability to charge fees that will allow us to operate profitably. The two most aggressive currently legislative proposals out there are Massachusetts and Maine, both that want to restrict our fee to 3%. And 3% probably works for an exchange that's software driven, but it's totally unfeasible for an ATM where we've got to build the hardware, we have to pay rent for wherever that hardware is placed. And then we got to hire Brinks, Loomis, Garda to go pick up that cash. Then we have to have a third party that verifies all of our KYC AML before those dollars get deposited in the bank. So we have a lot of overhead in installation, maintenance, and then management of that remote physical network. So that 3% fee limit per transaction is just it's unfeasible. You can't operate profitably and make that. If you go, Bitcoin Depot is publicly traded. You can look at their financials. If you look across the industry, we're all charging right around 20% on average. And if you look at what their bottom line is after that 20%, it's pretty evident that 20% leads to about a 1 to 3% margin at the end of the day. So we need to have those higher fees in order to operate this kind of infrastructure. So it's not gouging to put money in our bank account. It's just the nature of the business that we're in that requires a higher fee in order to operate.
And making it so that even if it was a 3% fee, that doesn't address the elder abuse issue at all.
Exactly.
So it just seems like it's a anti-competitive type measure.
That's right.
And so, have you found that there's lawmakers that are willing to engage and kind of work through the issue, or do they have kind of some prior misconceptions?
Well, definitely a lot of misconceptions and a lot of misunderstanding about the way the Bitcoin blockchain works. So education is key, and a key point to that, right? So a lot of the legislation is mandating refunds that exceed 90 days or 90 days past the transaction day. A refund means you generally get the product back, right? Like if you go to Home Depot and the doorknob you bought doesn't work you're going to return the doorknob to get your money back. These are refunds that do not require the return of the Bitcoin. So it's taking a fraud and enlarging it, because we would be returning the full fee plus the cost of the Bitcoin, and we're not getting anything in return. So it's sort of like, they're building regulation that might work in an ACH type of environment, a credit card type of environment, but doesn't work in with a bearer instrument. So, I don't know if that answers your question specifically. I might have lost the course there, but
then, with that education process, how do you see kind of the legislative momentum going? Are they going to get more wins, or do you think that the industry is going to be able to rally around and get, at least reasonable regulation, right? That actually makes sense.
Yeah, so it's very divided right now. So for the most part, every once in a while we find somebody in the House or the Senate, on Democrat, Republican, we find somebody who understands Bitcoin and they know that these laws make no sense. When we share with them what we do for fraud prevention, they get very excited and they want to help us move this process into the state legislation. So there have been some very friendly, very good legislators that are taking the time to learn, that want to learn, and they're being very proactive to work with us and help us. But I would say on the most part, the vast majority are voting without that education, without that understanding, because they want to do what's right from the messaging they've heard. That, because what they're being told is that there's no use for Bitcoin ATMs, there's no valid use for Bitcoin ATMs, and that we are the scammers, that we're the ones implementing and facilitating the scam. And so that's the biggest misconception that we run into. Of course, when we tell them we do KYC AML on everybody who touches the machine, their eyes open up. They're like, really? So that tells us immediately that they've been told misinformation. When we talk to them about the phone calls, they're blown away, and they immediately say things like, why is not everybody doing this? Because it's not mandated. Because we're volunteering to do this because we want to do what's right for our customers, and we don't want to see people get scammed. So they figure out right away, if they're honest with themselves and they're being honest about trying to prevent fraud, that there's a way to do it, and there's a way to do it right, and that having a profitable operator who's doing the proper due diligence and preventing the scam is actually a benefit to the whole system. So those that get it, pick up the ball and run with it, and they've been very helpful in supporting us. Satoshi Action Fund has been very helpful to us in getting our message to individual state legislators. So they've been very supportive, and they've been great to work with. And we're sending letters to everybody we can. Hopefully, in the near future, Satoshi and Bifederal will have a letter writing capacity on our website, so that you can come to our website and push letters out to legislators in your state. So we're working on that, because it's all about the education. But to answer your question directly about like the impact we're having, it's been tough. They're moving far faster than we can educate people. Indiana and Tennessee have already banned ATMs in their states. I don't know if you just saw recently, the entire country, Canada, banned ATMs. Minnesota, New Jersey, and Massachusetts are very close to implementing a ban. And then Massachusetts and Maine, with the 3% fee and the refunds. And there's a whole bunch of other states that are working on refund legislation that would make it difficult to operate as well.
Now, how does, there's the legislative process. On the law enforcement side, how does that relationship work? Because, they've got investigations, they find out somebody's been scammed. they find out that it was through a Bitcoin ATM. How does that process work out?
Yeah, we get we get frequent calls from law enforcement, and we share all the information with them that's required. They're misinformed as well. They don't have it in their they don't have the time to learn about the Bitcoin blockchain, right? They're busy doing law enforcement. So that there again, once we educate them, we deliver them a recorded call. We show them all the transaction data. Then they understand the process and what it really means. So by and large, most of the phone calls start very aggressive and end very understanding. And so we work with law enforcement on a regular basis as well. We consult with the FBI at least twice a year, sometimes quarterly, to review with them what we're seeing and educate them on how to prevent fraud across various blockchains. It's a great relationship we've had with them over the years. I think unfortunately, when we've shown up at legislative teach-ins at different state groups where they're discussing these kind of things, and when law enforcement shows up, they're very negative towards Bitcoin ATMs, because I think the big thing that they misunderstand is that when this transaction is done, that Bitcoin is not recapturable; it can't be returned, and so they don't think it should be a viable instrument. It should be used by the public.
Well, also their perspective is completely skewed because they only hear about Bitcoin ATMs in the negative,
Yes.
right? They don't talk with happy customers.
No, that's exactly right. If we've done some look back, right? We through our transaction data, because we've had hundreds of thousands of customers over the years, and if you look at these people, most of them are making small transactions. Like our average transaction, our mean transaction is about $300. About 80% of our transactions are $500 or less, or excuse me, $1,000 or less, and they buy repetitively. So 70% of our transactions are repeat buyers, mostly happening about every 24 days and mostly happening on Fridays. And so if we look at a customer's transaction history, many, something like 30 or 40% of these customers would be millionaires if they had held all their coin. We can't prove that they've held all their coin, obviously, but if they have, they'd be millionaires based on the amount of time and how long they've been buying. And then additionally, we actually ran this research report when Bitcoin was in the low 70s. 85% of our client base was net positive on their purchases. So it does achieve the goal, right? I mean, Bitcoin is performing for these people, and it's the first time in history that the unbanked have had the ability to buy an asset with a CAGR of 40+% that could change their life, right? This is game changing for the people in our society that need it the most. And that story doesn't get told enough. Law enforcement isn't meeting and talking to those people, like you said, and the legislators are looking past these people, because some lobbyists are telling them that there's no valid use case for a Bitcoin ATM.
Yeah. Now, something I like a lot about ATMs relative to other ways of buying Bitcoin is that you get the Bitcoin logo out into the real world.
Yeah.
I wish that the crypto exchanges would do, billboards and more marketing in the real world.
Yeah.
At best, it seems like they sponsor a Formula One race here and there, or sadly, the FTX stadium.
Right.
So to me, I think it accomplishes a crucial marketing function for Bitcoin that otherwise we wouldn't really have. That's why I want to see y'all win and to keep doing the right thing for your customers and to kind of push back on these legislative initiatives. Do you think there's regulatory changes that would be positive for the industry?
Yeah, I mean, we would like to see legislation that is fair so that we can operate profitably and provide our products and services. We would like to see our competitors adopt our elder fraud protocol of calling everybody over 60 and recording those conversations. The refunds would be okay to an extent. If it was done properly, it would look something like this. You do a transaction, the Bitcoin is held for 2 or 3 days, and you during that time period you can change your mind, right? I was being scammed. I just talked to my daughter about what happened, and she said, "Oh my God, Mom, you were scammed." Whatever that might be, but some window of time where we hold the Bitcoin back, and a refund could take place during that time period, so that we don't we're not out the Bitcoin, because we're not. I mean, I guess this doesn't make too much of it, but I mean, the Bitcoin we're selling is from our own inventory, right? We're not just linked to an exchange and just pulling it from a third party. It's actually our inventory. So, I think something like that. So the elder fraud, a holding period where people can cool down, reevaluate the transaction, get a refund if they discover fraud within that time period. But this 90-day refund stuff is just untenable. And we are doing things right now too, which are sort of suggested but not really mandated. We're using technology to scan the wallet that they provide to make sure it hasn't been used in fraudulent activity in the past. Obviously, we're doing all the OFAC sanctions screening, and then all the KYC AML. But most of the operators that we all would be aware of are doing something similar in that regard. So that's sort of standard practice.
Yeah. And, you mentioned Bitcoin being irreversible. The caveat to that being that law enforcement has seized private keys from criminals in the past. And that's kind of formed the basis of the strategic Bitcoin reserve. Mm-hmm. But how common do you think that is, that they actually get the criminals' wallets at some point? Or is that
we're not aware of any of that happening for our customers. I think that, obviously there's a big cost to doing the chain analysis to recover $300, $500. That's, yeah. So I don't know how feasible that is. But I mean, you bring up an interesting point, which I've always found a little odd, right? That, we're recovering these stolen funds, but we're not returning them to the people they were stolen from, right? So that's an interesting dilemma.
There needs to be some due process around that to make sure it's equitable. Mm-hmm. The most recent one, actually, the fraud victims were in China. Mm-hmm. And so the dispute is with the Chinese government, where the U.S. government has seized the Bitcoin, and the Chinese government is saying, "Hey, give us the Bitcoin," not because they're going to give it back to the victims, I think, but because they want the Bitcoin. Yeah. So it's going to become increasingly complex geopolitics, these Bitcoin wallets and the criminals that are using them.
Yeah, absolutely.
So, what do you think that the industry's at this point, is it saturated? Is it still in growth mode? How do you see the prospects of it outside of kind of the regulatory headwinds?
Yeah. I mean, in the United States, it's I would say fairly well saturated. We have, I think, I'm not up to date on the current data, but roughly 24,000 or plus or minus ATMs active across all 50, well, probably not in New York, but most states. And so the United States, at least for us, and I think for a lot of our competition, it's sort of like putting new machines in is just kind of moving your money from your right pocket to your left. So, of course, we're only operating in 40 states, so we have growth ahead of us. If we can find the right location to put a new machine in there, we still are growing organically into these new states, new locations. But I think in total in the U.S., it's pretty top heavy right now. Overseas and internationally, we're seeing a lot of growth. Australia, our partners there are growing phenomenal. We're the top ATM operator in Australia. They're rolling out our payment gateway as well, and they're growing as fast as we can send them ATMs. We just got a license in the UAE before the war started, so we're eager to go and start operations there. We'll be the first licensed and approved kiosk operator in the UAE. That's licensed from the central bank, and we're very excited about that market. And I think there's still lots of opportunity in Europe, Asia, Latin America, et cetera. So we're working on that international push as far as where our growth is going to be, and then our other verticals in the wallet and the payment gateway.
And how do you think about like horizontal growth opportunities? Have y'all explored creating a wallet or having a web, brokerage or exchange?
Yeah, our software is, proprietary to us. So it's an on-ramp, off-ramp, custody, non-custody, you name it, right? So yes, we launched a wallet that's live in all 50 states here in the United States. And that's like the typical easy button, right? You connect via ACH, smash by your Bitcoin, it's held in custody for you. We also have another wallet that's called Byte Vault, and Byte Vault is fully non-custodial. You hold all your own keys. And so we're training and educating people that, once you've hit balances through the on-ramp, through Byte Wallet, that you want to secure with your own keys to transfer it to Byte Vault. The Byte Vault also becomes sort of the buddy or companion wallet for the kiosk, because those are all basically like peer-to-peer transactions. And so you have to have your own wallet to function with an ATM. On the payment gateway side, we wrote that software years ago. We beta tested with all sorts of different retailers. So we've had it run in restaurants. We've had it run at gas stations. We did the first gas transaction over Lightning at a mobile station here in Sarasota, Florida, a couple years back. That was really exciting. And so we've also done cars, real estate, et cetera. And what we've decided to focus on is the high dollar value lifestyle type purchases, where you want to take some portion of your growth in Bitcoin and convert it to a home or a boat or a luxury vehicle. So that sort of lifestyle enhancing purchase that would be a significant volume. And our reasoning behind that is that because there's no de minimis tax exemption yet, and because because Visa and Cash App and Stripe and everybody's getting into the retail transactions with crypto, we thought that our niche should be on-chain direct Bitcoin purchases for assets that are, life-changing for you.
Right. Yeah, that makes sense. And then on lending, we hear a lot about new lending products. Is that something y'all are exploring, or is it kind of just a different adjacent service?
Yeah, it is. It is something we're exploring. Actually, we've got meetings coming up in the near future about that, and we've thought about incorporating lending into the payment gateway, so that at the point in time that you are saying, okay, I'm going to buy that house with Bitcoin, you could instead toggle the switch to a loan and post collateral and get the loan to make the purchase. So we're working on those. We're talking to capital providers for that kind of lending. And then also the traditional Bitcoin-backed loans that everybody's familiar with, that would be introduced into our wallet infrastructure.
Do you have any heist stories for us with Brinks or other service providers?
We do.
Yeah.
I won't name the name of the company, so it's okay. If it's Brinks or Garter or Loomis, I can't tell you. But no, we've actually caught them stealing cash out of our ATM, and we have video cameras inside. We have cameras on the customer. We have cameras in the vault too, watching the cash. And yeah, so we've seen that happen. We have had, if you're familiar, like the typical company, right, has an ATM that's bought out of China that's plastic. Our ATMs sit on a 1/4-inch steel vault that is folded and formed and welded here in Bradenton, Florida. And then we bolt that sucker into the concrete inside the store. So we had somebody, throw a chain around it, try and yank it out the front window, and it ripped their axle off. So they didn't get away with anything. More recently, I don't know how many. I mean, let's just say that appears to be an inside job where somebody took a grinder and cut into the back of our ATM to get access to the cash box. Wow. So, yeah, I mean, it happens, and that's why we've built our own ATM, because the plastic stuff is just, you kick it and you can get in.
Right.
Yeah.
Well, I like that story of that guy losing his back axle, trying to take it. It's very Florida. I don't know if it happened in Florida. But
that's a good question. It was definitely in the Southeast.
Yeah. And I've seen, in fact, our local Target, somebody rammed their truck in to grab the not a Bitcoin ATM, but a normal ATM. And, it's pretty brazen criminality, but you've thought through the product to make it secure.
Yes. Yeah, we have. We're trying to make it secure for everybody all the way around. And, we even go, we have hosts, right? That, I mean, just these are the kind of feel good stories. They're so cool. We have hosts that have been with us since the early days that have been paid in Bitcoin for their rent. And they've done really, really well, as you can imagine, they're getting a payment, let's just say $300 to $500 a month in Bitcoin. And for just having our machine parked in 2 square feet inside their convenience store. And they've done very, very well for themselves. So it's a overall benefit to everybody participating in the network.
Yeah, that's awesome. I'd forgotten to ask what the rent is like. So it's $200 to $500 a month. Or so.
And we have some folks that are profit sharing with us. So and some of those folks have done really, really well. If you find a host who is very, very pro Bitcoin and wants to be helpful and provide education for their customers, those guys do unbelievable, right? If they've got staff that's trained and or they're in their own, running their own store, and they're like, hey, we got an ATM. If you need any help, I can explain to you how it works. And, they're always promoting the benefits of Bitcoin. Man, some of those locations just do phenomenal. And those are the folks that say, yeah, no, I want profit sharing, right? And they've done very, very well. It's been a great relationship with those hosts.
That's really cool. That is the front lines of Bitcoin education.
Yeah, for sure.
I love to hear that.
Yeah, it's very cool.
Is there anything we missed in our conversation?
The only thing I would add is that we have a really good website, bytefederal.com, fraud-prevention, where we go through the architecture of the scam, starting with the telecoms, going through the banks where the cash is removed, and then getting to the Bitcoin ATM. We give you all the data. It's all sourced data. You can see all of our references and where all the material came from. You can download and share the research reports, or you could just peruse the data that we publish on the website. Then we go through all of our fraud prevention protocols. So that's where we're leading people to learn about this problem. That's where we're leading legislators to learn about this and educate themselves on it. And then, like I said, hopefully within the next couple weeks to few weeks, there will also be a campaign there where you can promote, or you can send a letter to your local state legislator and cue them into the viability and necessity to keep the Bitcoin ATMs functioning in your state.
Well, thanks for joining us today, Paul. I think that whether it's podcasts like this or sending letters, the message will get out there, and the truth is on our side. Yeah. So I think that's kind of the biggest advantage we have. and the utility as well is on our side, right? That people are benefiting from these Bitcoin ATMs. So thanks for coming on to share about the industry and to share what the latest news is. We look forward to having you back on soon.
Great. Thank you so much, Pierre. I appreciate it.
Thank you, Paul. Bye. And to our listeners, thanks for joining us today. Don't forget to subscribe, leave a review, and share it with your friends, family, and coworkers. Have a great week.
Welcome. This is BFC in NYC, the premier institutional Bitcoin adoption event. We are here with over 300 decision makers from across the industry. We're excited to welcome you, and let's get into it. So the people in the room are what makes today an incredible event. The top companies who are allocating Bitcoin to their balance sheet and leveraging Bitcoin to run their businesses are all in the room, having conversations and making deals happen. All the decision makers from across the Bitcoin ecosystem who have anything to do with corporate adoption, institutional adoption, are in the room here at BFC in NYC. Thanks for coming, and we hope you enjoyed the event. We'll see you in Hong Kong.
All right, everybody, welcome back to another week on BFC Live. Lots to talk about today. Today, I am joined by two very smart gentlemen. Every week, I get to talk to people about Bitcoin that are a lot smarter than me. This week is no exception. I'm joined by Mason Foard, who is the director of Bitcoin strategy at Meluse and also a founding member of True North, and Allard Peng, our head of research and insights here at Bitcoin for Corporations. Gentlemen, thanks for joining me today.
Thanks for having us, Jake. Appreciate it.
Good to be here.
All right, lots to talk about today. Bitcoin is getting a bid. Treasury companies and equities are getting a bid. Scott Bezant had some news to share that the market enjoyed, but I want to start with BIP 110 for a second, Allard. Quick question. What is a BIP 110 and what do I do about it?
Yeah, I mean, like from the corporate level, and I think it also translates over to just anyone that uses Bitcoin. So to begin with, it was a soft fork. The soft fork happened on August 8th, and then it didn't really get anywhere. And the supporters of it are, I think, a population of those supporters they're now thinking about like doing a hard fork. So I'll just go over some terminology. So soft fork is a restriction of the network rules. And in this case, like BIP 110 meant to restrict certain rules to do with the, like restricting the transactions that are within the op return. And this is meant to amend a change at the mempool policy level with Bitcoin Core V30. So like the short answer of it is like it's meant to be this movement that node runners could run this soft fork, and it would give them some kind of say over how the network should run. And what ended up happening is like the discourse got very much wrapped up in a lot of heated debates. I think a lot of it, like you could probably ascribe it to just bear market makes everybody pretty angry about things, and they feel like something needs to be done. Yeah, like in terms of what people need to do about it, like it's really just where you stand on what you think like is the best course of action for you as a node runner. So if you're a supporter for the soft fork, then you have that right to run the software on your node, and therefore start signaling BIP 110. Of course, we have gone past that activation window, so now you're at this point where that fork is now no longer really in play. But it was just an event where people could have participated if they wanted to, and if you didn't want to participate, then you can just not really do anything with your node. One of the luxuries of Bitcoin is that your default action can just be do nothing, and normally you end up being okay, right? So that's the main thing. Like the real action is just based on whether you supported it or not, and if you didn't support it, you didn't really have to do anything.
So ignore it, business as usual, back to building in the bear market.
I think I think there's definitely a longer conversation that could be said about it. In general, I think like the supporters of BIP 110, and I wouldn't call myself someone who was like anti BIP 110. I was very much neutral. Like I didn't run it myself, but I just thought that the node runners have a right to do what they do on their node. But ultimately, I think like what I definitely disagree with is the hard fork discourse, like trying to advocate for a hard fork to brick the proof of work algorithm and replace it with something else. Like that part, I think that has crossed the line. But otherwise, like doing a soft fork, or at least attempting one at the node level, and then trying to get consensus for it, that there's like in principle nothing wrong with that. So yeah.
Okay, thanks. I appreciate the explanation. Switching gears here, Mason, before we started the stream, you had mentioned that Scott Bessent came out with some news on capping the yield curve. Want to hear a little bit more about like functionally, what does that mean? Let's assume like, what does the yield curve even mean? How does that affect Bitcoin? Bitcoin is obviously getting a bid right now. Yeah, I want to hear your thoughts.
Yeah, so this morning, Scott Bessent of the U.S. Treasury announced that it's going to be doubling the size of its long-term U.S. debt buybacks. And this has followed kind of a rapid surge in Treasury yields, particularly the 30-year, which I believe in the middle of June, it was around 4.8, and I think it reached as high as 5.3. So a really rapid surge in yields. And so they announced that initially there was a program of 2 billion will now be increased to at least 4 billion. And the wording that they use is the move is intended to provide liquidity support for bonds maturing in the 10 to 30 year range, and this is as the U.S. debt nears around 40 trillion. So essentially what they're doing is yield curve control, which the yields were rising, and on this news, the yields have, or the 30-year has dropped to around 5.19. So instantly it lowers because there is some buy pressure from the Treasury. Now, the Treasury has the ability to, and this is a simplification, they have the ability to essentially print money, right? And that is how the market is interpreting this, that the Treasury and will not allow the yields to go higher because it makes the interest payments and the debts that the U.S. governments owe particularly untenable. And as they get higher, the interest gets higher, and it can lead to a debt spiral. And this is really why we are seeing hard assets today. And let me check, so we're up to date. Gold is up 3.77% today, which is a huge move for gold. Yep. And Bitcoin is up 6.23%, which is also a significant move after Bitcoin has been ranging in the low 60s, high 50s for about 6 months now. And this looks like it's real first momentum, and a potentially a short squeeze. There was a lot of people who thought Bitcoin was going lower, and they get squeezed and they have to buy back at a higher price. And what's particularly interesting is equities like MSTR and ASST, which is Strategy and Strive, who are amplified Bitcoin, are also squeezing significantly today, with MSTR up over 14%, and Strive now at 15.5%, which is really an incredible move. And I think that's also due to a short squeeze. But to sum it up, and I'm sure Allard will have some more insights here. The market is, or investors, macro participants are rushing into hard assets, things that represent the quote unquote debasement trade, because Besant really sent a message today that similar to Lynn Olin, that nothing stops this train of debasement, of continuing money printing and financing the debts of the U.S. Let's pass it over to Allard. Allard, anything else there?
I think you got the main points. Yeah, and at least for Bitcoin, right, there's definitely a capital rotation angle over here. We're kind of closing in on that 1 year mark for the bear market, and there might be let's just call it like a jitteriness in the market to try to front run that event of the bottoming. So that might be some element of what we're seeing today. I think like just within the spectrum of macro assets, Bitcoin has been extremely oversold, and it's by far the worst performing one in the last 18 months. So you have, you have like basically any capital rotation from here, Bitcoin becomes probably the core possible and potential benefactor of a capital rotation. And I think these kinds of macro events, they could very well become catalysts that trigger that kind of thing. So I think that's another part of what we're seeing.
I'm curious. So is this move from the Treasury, you mentioned Lynn Alden's famous quote, "Nothing stops this train." Is this move from the Treasury, was it inevitable? Or are there other options that the Treasury and the wider federal government have in light of where we're at with rising debt?
Yeah, that's a complex question. I would say beyond austerity, something like Doge trying to reduce the spending of the government, which we've seen kind of fail spectacularly because there's very little political support. I think realistically, the mechanics of what they can do, they have a whole tool bag of things that they can do, whether it's QE, yield curve control, helicopter money, like we saw in COVID, swap lines, loosening regulations, etc. There's many things that they can do to quote unquote support liquidity, but at the end of the day, there's just going to be different acronyms or different mechanisms for creating more monetary units and perpetuating the debt-based fiat system that we currently are in, and that needs ever constant expansion. And if you understand this at a very high macro level, that's why people are so into things like Bitcoin and gold, because they protect you, as gold's inflation rate is very low, around 1 to 1.5%, and then Bitcoin is trending towards zero over time, and I think currently has a lower inflation rate than gold. So yeah, I mean, in my mind, this was always inevitable, right? Nothing stops this train, and it's a mix of just understanding kind of human behavior, incentives, and game theory. The government has the option to print money. They will never default on that debt. And I don't think that they are going to be able to bring in the revenues or the receipts that they need to diminish it significantly, or the debt to GDP. So yeah, I think printing is kind of the end result here, no matter what they do or no matter how long it takes.
I'm curious, Allard, you said Bitcoin, you said that might be the core benefactor. Mason kind of touched on that, but I want to hear a little bit about why you think Bitcoin, maybe gold, might be the core benefactors of this new like money printing and all these different measures that the federal government's taking.
Yeah, sure. So to be clear, when I said core benefactor, I meant like, it's the most oversold. Of all the macro assets, this one's the worst performing. So as soon as you have a capital rotation, like where is the money going to go? They're going to, like, the smart money is going to be like, okay, I want to buy low, right, and sell high. So, well, in terms of relative lowness, it's Bitcoin that's the most low, right? So that's why I say it would be a core benefactor of any kind of capital rotation along that logic. But for your broader question is like, inside this kind of long-term macro events, you're kind of at the tail end of a long-term debt cycle, and there's probably going to be some kind of restructuring of the US dollar. Like these kinds of restructurings happen every 40 to 70 years or so, right? And we're kind of closing in on that timeline. Like if you look at United States history, that's been how it is. And if you look at how long-term debt cycles last, that's usually how long they tend to last. And debt usually is a main catalyst for these kinds of big threshold events in history. So in those moments, right, you normally see that hard assets do benefit. Hard assets that are not beholden to any kind of country or any kind of like corporate balance sheet or anything like that. Like hard assets that are truly neutral and truly scarce, quite frankly. So of everything in the world, like Bitcoin basically fits that bill the best, right? Because at the end of the day, we have already entered into a digital age, and this is a scarce digital asset. This is like the only digital asset that is, provably credible and scarce and all of those things. So that's why I think, like, just in light of the macro, Bitcoin could definitely stand to benefit the most from that. Yeah, and then just overall, you have the adoption that has popped up at the corporate, institutional, and soon we'll probably see like more nation states, right? So all of those are potential tailwinds that really bode well for Bitcoin.
So for the Bitcoin operating companies, whether they're a treasury, infrastructure provider, whatever it is, if we're in this regime where there's now tailwinds, I'm curious, what's the view on, we'll think in cycles. What's the view in the next couple years for the companies that are holding Bitcoin on the balance sheet, like Milieu's, like Strategy, Strive? I'm curious, Mason. You're a director of Bitcoin strategy, so like, what's your view as you guys hold Bitcoin on the balance sheet?
Yeah, I mean, I think we think of it as a long-term capital asset that helps us save energy into the future. And of course, Bitcoin, as you said, it's very cyclical and volatile. And if we are following a cycle model, which I don't totally buy, but it does seem that way, right? Kind of the psychology of the market might make it so it is a cycle potentially, which is it kind of self-reinforces itself. But yeah, then the next few years are presumably incredibly bullish because we're nearing kind of the 1 year mark of the start of the bear market, which was I think October 10th. And right now it's August 19th. And I think Allard made an astute observation that there might be many people who are trying to front run the quote unquote bottom. And I really think if you look at the first major low that we had was in February, and we retested it again this summer. But we've really been consolidating for the past 6 months in this 60 to 64 or 58 to 64 range. And I think that's a significant number because that was really the top of the last bull cycle in 2021. It seems like we've come back and we're sort of retesting it. We're also at the 200-week moving average right now. We're bumping up against it, riding it. And historically, that's been a really consistent, beautiful place to buy Bitcoin and hold it for a few years. I don't think there's been a time where if you've bought it at the 200-week moving average that you haven't been up at least 100% in the next few years. So yeah, I think we are incredibly bullish, and having an operating company, we've been able to really dynamically ride this bear market out, and our equity has since October has really consistently outperformed Bitcoin because of the fact that we have an operating business and we're able to buy back shares. And in October 2025, we announced that we were going to start buying back shares, around 10% of the free float. And we just announced 2 weeks ago in our Q2 2026 earnings call that we had completed that buyback and that we were going to continue another buyback. And we're doing that for a few reasons. As the Bitcoin market is weakening, we think that we do have an operating business, and our operating business in October was severely undervalued. It was valued around about 10 million real, and that's an operating business that spit out around 40 million real in the past 12 months, right? So it was severely undervalued. So just from a valuation standpoint, we thought that it was a better opportunity as Bitcoin was beginning to kind of go into a bear market to buy back our own equity than rather try to catch Bitcoin while it's falling and buy back our operating business at a really cheap discount. And we've seen that in kind of our equity outperformance. Since October, we're up around 13%, while Bitcoin is down around, I guess, 40-ish% now. And that's kind of like a 50-point delta between what Bitcoin has done and a operating business stacking Bitcoin and also increasing Bitcoin per share by reducing the share count. So we're just one example, and there's many different models, right? Like Strategy and Strive, their equity is designed to be amplified Bitcoin on both the upside and the downside. And we've seen that, frankly. They both had kind of brutal drawdowns, but I think most investors understand that amplification works both ways. In a bull market, if you're bullish on Bitcoin, you will, in my mind, likely outperform because of the amplification embedded via the preferred equities. And that is a model that we really haven't seen in a bull market. We saw a little bit towards the end with strategy announcing, strike, strife, and stretch, and I believe stride before the last top, but I don't think it wasn't as nearly a robust strategy, and kind of the clarity and kind of the operational scrutiny that they have now is they're just in a very different place, and I would argue much stronger. But Allard, I saw that you posted a kind of report yesterday on MSTR, and I was able to read a little bit of it, but I would love if you went over it again.
Okay. I mean, Jake, do you want to go through that, or like?
Yeah, I want to hit
that
that. We're gonna hit that for sure, but I've got some follow-up questions here.
Okay.
So, okay, Mason, you mentioned the front running that's happening in the market, or perceived front running.
Mm-hmm.
It seems like, help me understand, and maybe help the average Bitcoiner understand that what's actually happening in markets, because it seems like Michael Saylor sells $15 a Bitcoin and then it drops 30%. He buys $500 million and the price doesn't move. So, like, I'm curious, who's front running the market right now? Who's actually buying Bitcoin? Is it a bunch of retail like cramming in? Is it institutions? And like, what's actually moving the price here? Yeah, who are these participants that are front running right now?
Yeah, I mean, I think today's the first indication of any front running. I think if you look at the past 6 months, what it's really been is a consolidation period, and it's not necessarily who's buying Bitcoin. It's the sellers and the buyers kind of meeting at a fair value price. And I think what people all consider the buyer's point of view, I don't think they often consider the seller's point of view, which is if you're a seller of Bitcoin, you want the highest price possible, right? Like I think that makes the most sense. And I think if you're a seller of Bitcoin, at this point, you might say, hey, I don't think we're going to go much lower here. And in fact, I think we might go higher. And so they might start raising the price that they want to sell at. And of course, it's a market, so there is a dynamic, but I think there's really been a negotiation the past 6 months. And I think maybe the sellers are looking at percent, and the buyers as well, and saying, hey, the buyers are like, hey, I need hard assets. And the sellers might be, hey, maybe I want to hold on to my hard assets. And that's how, the price goes up. And it could also be, trading momentum, leverage. It's so multifaceted and dynamic. It's really hard to pin down. But I think if we're looking at it kind of from a broad, big picture view, it is always a dynamic of a buyer and a seller and a negotiation.
Allard, Mason also mentioned the prefs, and this is a question that I asked you about previously, but I want to ask it again so our listeners can hear you kind of unpack it. This is going to be the first time in like a real bull cycle we have these digital credit products, and you spoke to me about the reflexivity and how this affects what the price that Bitcoin's trading at. tell me like your view. How do these digital credit products fuel the bull market, and how do you think they'll perform, especially given the pressure that's been on Stretch lately?
Yeah, sure. Yeah, we could probably talk a while about that. I guess the bottom line up front is like all of the pieces are being set into place, and that's really how I would frame things. Like every digital credit instrument out there, every way for other pools of capital in the capital markets to go into Bitcoin, that's all like a piece of like infrastructure, if you will, to just ultimately pipe more money into Bitcoin. So in a bull market scenario, uh, those pipelines that allow money to flow through into Bitcoin will probably run hotter than normal, right? It's just because people feel good about the asset, and people feel good about all of the derivatives that are on that asset. So digital credit would obviously be included within that category. So people just feel good about buying these things, and then now the issuers can run those ATMs, and they're able to raise more money, pile that money into Bitcoin. Okay, so does that actually have an impact on the Bitcoin price? I would say that at this moment and at these volumes and at these buy rates per week, definitely not. Okay, like definitely not. It's not enough money to really move the price, because ultimately, like Bitcoin has a huge amount of volume, and if you look at how much, so Strategy's biggest buy week ever was like Q4 of 2024. It was right after the Trump got inaugurated. No, not inaugurated, like elected. And you had that huge run up, and they were able to buy like 55,000 Bitcoins in a single week, right? That was their biggest buy week ever. Not necessarily like in dollar terms, but like just in Bitcoin terms, right? But maybe in dollar terms too. I'm not completely sure, but in Bitcoin terms for sure, it was their biggest week. And if you look at the Bitcoin volumes, trading volumes for that week, just on exchanges, so not even counting like all the OTC stuff, just on exchanges, it was a very small percentage of total trading volumes. So that right there tells you that like it frankly is not enough capital to really be driving the price. Same thing with them selling. When they sell like 30 Bitcoin or 3,000 Bitcoin, or if they sold 30,000 Bitcoin, that isn't something that would move the price, just given like how much their volume occupies over how much like total volume occurred over that week. So that's, I want to caveat things by saying that, right? But that being said, right, like, could we imagine a scenario where these instruments are at a level of growth and maturity that eventually they in fact do become reflexive? And I would say the answer to that is probably yes, because at some point, with all of this financial engineering and with all of this like structured credit and with all of these instruments that are just built on top of Bitcoin, eventually you can reach this state where Bitcoin just becomes this default go-to place that people want to park their capital, right? And this can be a very natural progression of like how things be. Like right now, it starts with a few companies that put it on their balance sheets, and then it starts with them issuing digital credit, and then it starts with people building on top of digital credit, and then it starts with banks issuing like high amounts of loans against that Bitcoin that they have custody within the banks. So you can see like this, it's a step-by-step progression. And when we get to, there will come a time when we get to a point where the volume of capital that moves into it actually does impact the price, like materially. So that is where I would say the reflexivity comes to be. On a more micro level, like the reflexivity can definitely materialize within the equities of any of these companies that have Bitcoin on the balance sheet, right? So I'll take MSTR for instance, right? Can reflexivity happen on just the equity, like to be localized to equity? Absolutely. And the way it happens is like if Bitcoin goes up, MSTR tends to go up quite a bit more, right? It's like a convex version of Bitcoin. And then from there, you're going to have options markets that are on that MSTR equity. And there's going to be like these second order Greeks that start moving into crazy parameters. And at that point, it forces other market participants to have to buy. And I'm, of course, referring to just options market makers, like their default behavior when they have to like hedge out the risk that they're dealing when they trade these contracts. So when you have a huge amount of call demand, right, a lot of directional options traders want to buy calls, for example, well, that actually creates this impact wherein the dealers, the market makers, have to hedge in the spot market, and then they will be buying shares. So these kinds of things definitely happen, and the chance of them happening and the magnitude of a move becomes much higher during those kinds of isolated instances. So, and that's another form of reflexivity. Like certainly when we're talking about a short squeeze or a gamma squeeze or anything like that, like that is definitely by definition reflexivity, right? So that's kind of how I would answer that. Like I wouldn't say reflexivity on the Bitcoin side is something big right now. It's certainly possible in the future within much smaller assets like MSTR. Obviously, MSTR is much smaller than Bitcoin, right? Yeah. So within smaller assets like MSTR or maybe ASST, like that totally can happen.
I want to talk a little bit more about strategy, well, particularly MSCI. Real quick, Marshall, Allard, could you talk a bit about what MSCI is, what the recent decision they made is, and kind of go back to how BFC engaged MSCI earlier this year, and why we're even having a chat with them in the first place? Allard?
Oh, that was for me. Okay.
Yeah.
Okay. Yeah, like I guess with MSCI, it started off with like this was around end of last year where they were saying like, hey, we have a consultation on digital assets. And at the time, they specifically called out digital assets and companies that were holding digital assets on their balance sheet. And I mean, at BFC, like what we did were we basically gathered together a coalition of entities, like including corporations, like DATs, institutions, and like individual retail investors. Right, we had a huge like signature sheet and everything, and we really petitioned against that, and ultimately we won. Like they decided to like withdraw that consultation, and basically digital asset treasuries were not affected by that consultation at the end of that conclusion. What's happened?
Real quick, explain for someone